Good morning, team. What's up? I know I didn't give you guys much of a heads up on this. I'm just getting things ready. Okay. A lot of stuff I had to do before I came on this morning, but that's okay. We're gonna specifically stick to these charts. I'm gonna start making a change here. Okay. I'm gonna start making a change. All right. We're gonna get this thing on and popping. So you guys have any questions, have any tickers, throw them in the chat. I'd be happy, I'd be obliged to check them out. I'm going to go over the news first, and we're going to see what we got. I think there's stuff with Coinbase, there's Google. So I'm getting my notebooks, I'm getting everything ready. I hope you guys got some sleep. I got my sleep. I think it was just about that time where it's just I don't think my body had just given up, and then I was able to get my sleep last night. So I hope you guys I hope you guys had a great night, was able to get your sleep and get ready, and are able to come in and do your due diligence. If you could, like, share, and subscribe. We're here 7:30 to 4 o'clock every day. Trading the markets. We'd love to teach you guys, give you guys some lessons from actual educated professional traders. All right. So first thing I'm going to do is I'm going to get all my stuff set up. Excuse me. So what do we have? What do we have? What's going on here? So we need to bring up CNBC. Let me turn up the squawk. Let me get all my stuff up here. We need to get the Fed funds rate up here as well. Come on. I hate that it does that. We need to know what's moving pre-market. We need to know where we open, close, where are the indices at. Okay, where's the VIX? Where are the treasuries? Where's the 2s and 10s? Where's the dollar? And where's the VIX? Those are the most important things we need to have up. So as I do that, CME Fed Watch tool, I guess that's it. I think this is it. Oh yeah. Oh yeah. Just give me one moment. Yeah, I'll have to start playing some stuff up here. So we got the Fed Watch tool. All right. God, I'm so ready for today. And I think a lot of people are getting a little overzealous on this and thinking they're going to get a ton of volatility, and I just don't think it's going to be that way. The last few Fed meetings have been not so volatile. The last couple CPIs haven't been that volatile. I was thinking last night. I'm going to get into it. We get a couple more people on here. I'll save this idea. Um, I was thinking about something last night. Like, what is it that Sorry, I just want to hear.
Notwithstanding the cool tensions, U.S. and Iran officials have had several sets of indirect talks in Oman. That from the Wall Street Journal.
Okay, so I was thinking about some things last night. Like, what could give us more downside? What is it? And I was kind of putting the pieces together. Okay, and I want to touch on that a little bit today. So, there we go. I apologize. Um, yeah, that's something I want to go over. So, all right, we got this. Let's go to. No, well, yes, we need that also. I'm actually going to just put this. Nope. I'm going to put that there. I'm going to put this here. Let's go to trading view. Let's cover where the. So the 2s and 10s have been rising. I don't know if anyone has noticed or not, but look at this move yesterday. This is the 2-year. All right, that's pretty crazy. You get a day like that. Usually the market has a down day. I love how they said Tesla could has to pull back. Well, Tesla's still grinding higher, man. That's institutional buying. If you can learn anything from this stream, please know, don't fight a trend like that. All right, there's a whole bunch of catalysts. Between the transportation sector as a whole, between this AI, between Tesla, and the fact that it was beaten down. Okay, do the fundamentals justify the ends, the means? I mean, don't it's not up to me. All right, it's not up to me. So we're gonna get ready to go through some charts, But when you just get, you have so many. This was a big move down. You get so many shorts caught in it, and look at this volume. Look at this. Look at that increase in volume. Boom, and look at it. It's only started to increase again. I think it's about there though. I think it's about done. If you ask me, I think it wanted to come up to touch. I think it's wanting to come up to test this, fill this gap here, right up here where the 100-day was. Right there. See where it's at? You have a nice double bottom right there, and that gap fill. Just seems like a good spot for it to cool its jets a little bit, And where it's at probably psych level 300 of some sort. No, 266. 266. I'm actually going to put a line there. That's going to be the target. And that is going to be my target. So, if you guys have any questions about Fed Day, anything, we're going to get it to you guys have any tickers, throw them in the chat. We're going to cover them. So, how are we going to play the day? I'm going to get into all that. I just need a couple cups of coffee, okay? So first is first, I need to go through and I need to see what's going on. I need to know where's 2s and 10s, where's the VIX. I need to know what news do we have going on. Novavax COVID vaccine maker Novavax sees a pathway to survival, but it won't be easy. Nothing has been easy for Novavax. I'm surprised Novavax doesn't know what's best for it and hasn't left this COVID shit alone. I forget what the ticker is. It's been so long. And NVAX, I think. Yeah. NVAX. So again, welcome to the stream if you guys are watching. Bring some friends, share it. I need to I think, like I said this morning, I'm gonna make a few changes. Look at this. What the hell? Yeah, Novavax was a fun stock to trade when it was like $200 when it was up here. This was a fun time. Now, I don't know. It's an $8 stock. Could you guys imagine if you just could grab some puts, like some leaps way out of the money? You know, $200 to $8, $10, everything just got beat up. You know, man. If they do get some news and can get through this 100-day, it's almost like a penny stock now, because penny stocks, you'll see they break the 50 and there's always that 100-day moving average that it runs into. It's like the same old song and dance. And it's a shame that Novavax is there. I mean, it is what it is, but, you know, it's there. So if you guys, again, have any questions or anything you guys want to learn about trading or anything of that nature, I'm going to run through these tickers. Let me get my headphones out and make sure I can hear everything. And I can put on some CNBC while we run through all this. It may be a little lagged, but that's okay. It's on the broker.
Of our national debt, which are entitlements.
All right.
And
so you
frankly,
guys can
my
hear
former
that.
running mate's position is the same as Joe Biden's. I mean, we have to have leadership that can just be honest with the American people.
Get it,
Kevin
gang.
McCarthy has said the same.
And say
We're not
we
going to say
got to bring about fiscal responsibility and reform. So that's whatever the Fed decides today, whether they tap the brake, whether they pause.
So where am I
it doesn't change
going?
the fundamental fact
Shell
that,
boost dividend
where
by
inflation
15%. I
rose
heard
4%
that. There was something
today.
with Coinbase,
Overall,
I think.
I pulled the numbers. We're
Before I forget.
16.2% inflation since this administration took office. In 2 years, they've increased inflation twice what it increased over 4 years of our administration. That's not a policy that signals the strength of our economy, the integrity of the dollar. And we just got to get back to a commitment to fiscal solvency and reform.
We're going to have Judy Shelton. We're big advertisers for the Wall Street Journal today. Another op-ed piece is that the Fed's monetary policy toolkit needs an overhaul. Her point,
You know damn well ain't nobody
when you
voting for
stay
your
at zero
ass. Not in a bad way.
things like MMT,
But it's just, it's either going to be Biden, Trump. I don't know who from the Democratic side. Like the other guy from Florida, maybe.
that they do sort of
Like, they just do this for like a cash grab. Like, they all go out. They know damn well they're not going to get voted for.
Well, they absolutely do. I mean, we
Like,
went
but they
through
do it
this
anyway
very
because they want to get that money.
where,
You know, I just want you guys to know that and see that.
with all due respect, sitting here
You know,
in
if you have a real shot
It's a good
at
thing for a
winning
lot of
is
people on
the
Wall
people
Street
that should be
what we're seeing
running.
with this inflation. It
I don't
was a
know.
very good thing for
I
people on
I just wish there was a way that people could
everywhere I
see
go
this
across the
stuff.
country.
Like, see through it. See for what it is.
Hurting,
Stop with that.
rising
Go out and vote. This and that.
people want
Your
to
vote
see
counts. This and that.
Washington, D.C.
No, you make your own
There's
decision.
growth.
If you want to vote, you vote.
And also has
If
the
you don't
courage
want to
and willing
vote,
to
don't
step
vote.
forward and be honest with
All
the
right?
American
That's
people
completely
about
up
the
to you.
real debt crisis
All right?
that's facing our children
But
and our
I just
grandchildren.
don't.
You got Father's Day coming up this Sunday, so I intend to
I don't know,
explore
man. I just
when I
wish
get back
people.
home to Indiana.
We need to stop with
One of our
this.
kids is actually
Like,
gonna
just
be home with a couple of our
continuously
granddaughters.
putting the same people in that
I just can't look at those
that
three
literally-
granddaughters of ours.
they ain't your
and
friend.
walk by on the other side of
I
the
mean,
road and say, "No, this is
they'll
gonna be
act like
your
it don't-
problem.
you know,
all are gonna have to deal
All
with
they
this
want
here."
when they
And
want
I
your
know
vote,
in our
you'll
time,
see a total different
if
person.
we would summon the will of the American people.
I mean, the guy
we would
now
change
taxed
the
everybody.
fiscal
Every
trajectory of
it's
this
brought up
country.
taxes.
That
Anything,
more than any of the
an item over $599
bad
is to be
or,
taxed. Like,
small
get the fuck
changes
out of
in
here.
Congress.
Oh, but we're worried about.
Path of
We're
prosperity
doing it
and
only for
security years to
the
come.
people that are doing illegal things. Like, it's such. It's so. It's sad. It's very sad. We need to get somebody in here that's just going to help. That helps everyone, or has everyone's interest.
The way it looks right now, it is
Corporate,
right at the top.
non-corporate.
It is surreal.
You know.
Well, but I have every
If you
confidence.
believe the polls.
So this goes into
Well,
a little
I have
bit.
every confidence in the American people.
All
I
right.
have every confidence in Republican primary voters. They're going to choose wisely. We're going to choose the right leadership fitted to this moment, and we're going to restore the security and prosperity of this country.
All right.
So help us God.
That sounds like a that sounds like a campaign speech, and we appreciate it.
Look at him acting all religious and shit. With your Indiana ass. I think he was from Indiana or something.
Thanks, guys.
So
An exclusive
you
interview
know,
with the CEO of British
this
Oil
has
Shell.
actually-
Fox will be right back.
this goes into what I was going to talk about. Was it kind of goes into policy on what we could expect for some more downside, and I don't think people are expecting it. I really don't. And it's going to hit us by surprise. So Coinbase is going to the upside. Let's see here. I want to chart this out. Where are we at right now? 50. We're at 53.12. 53.12. I can put time and sales away. So what's really going to matter for any of these moves and stuff is probably not until about 9:15 is when you're going to start seeing the movement. Is this the daily? No. And again, if you guys have any tickers, go ahead, throw them in the chat. Okay, there we go. So I noticed yesterday that the SPY kind of was looking like it was wanting to roll over. It's trying to top out, but it's hard to say. So look at Coinbase. It's got this. It's kind of got a reverse head and shoulders going on here.
AIN, Albany International, to acquire a Heimbach Group for 153 million euros.
That looks like. Now we're gonna. It's 8 o'clock, so we're gonna start getting a bunch of news. I'm gonna have to go get a cup of coffee. I need to be on my grind. So there was UNH news last. There was something with UNH. If anybody tells you again that you can't play Fed Day, that don't listen to them. You absolutely can. I do it every time. It's not a bet. It's not a bet. Okay. You just need to. There's just an understanding that's maybe some people don't have. So this is weird. Do you see this? This is like the most weirdest island reversal I have ever seen. Am I wrong? Like, in a sense, it's just not going up. It's like it's coming down and then it gaps up, holds this base, tries to gap up and go higher, and then, unless this is it right here, unless this could be your island reversal, in a sense, like right there, where it gaps up, boom, comes down, gaps down, it comes back up, and what does it test? It tails up there. So we'll have to see. We will have to. India, Oscar, Bravo, Tango, I think. I think this is it. This is the stock that is going off on the scanners, I think. Yeah, 288. So $3, yeah. Milestone announcement. Okay, $3 flat. Let's go see what we got. Oh shit! See how it went right to the 100-day and said, "Nope." Oh no, wait, hold on. $3. Holy shit! $3 is up here. It broke through all of it. This thing. I gotta put this on my IOBT. The life of a trader. You guys want to trade? Hope you don't have ADHD. So, because I do, and it's crazy. What's today? The 14th?
EWA Borg Warner announced July 3rd, 2023 as the
Borg Warner Turbos. IOBT. Okay, then we have Coin. We have UNH. We have Google. Big watch list, guys. Big watch list. Where's our $3 mark at? Right here. It stopped literally at 3. So I'm gonna chart this thing out and hopefully go back and not have to. So it's 307, 295. I mean, technically, this would be your flat. See this thing looks a little. It looks a little weird.
DLFS BioLife Solutions received College of American Pathologists accreditation for all high-state U.S.
And all this means.
That's probably not fine.
Sorry, let me get this closer. So I think we have here in about a half hour is when we have PPI.
Shell announcing a dividend boost. The company and its new CEO are hosting an investor day at the Exchange today, and Brian Sullivan joins us right now.
SLFI, SoFi, just broke the highs now, $9.01.
Good morning, everybody. Yeah, we are with Wael Sawad. He is the CEO, relatively new CEO, as you said, of Shell. And with the new CEO, we get maybe a slightly new path forward as well in their capital.
Man, fucking SoFi. I knew $7 wasn't going to be the end of it. I knew it wasn't going to be.
There was the expectation of a slight production cut. They're going to keep it steady. Low carbon solutions, 10 to 15 billion, maybe a slight trimming there. We'll get the
I don't know.
increase in dividend and at least a $5 billion share buyback. Wael Sawad at the New York Stock Exchange. Thank you for joining us. Thanks, Brian. Looking at this, a headline is slight capital spending cut, but yet you're going to keep oil and gas steady through 2030, where there was the expectation of a slight drop. How do you keep capital spending down, but yet oil and gas production up? How do you manage that?
Yeah, thanks, Brian. So indeed, as you say, today we announce a reduction in the range of our capital spend. We used to advise or guide towards $23 to $27 billion. Now we're down to $22 to $25 billion. The share that goes into our upstream and integrated gas businesses, which are our world-leading businesses, is unchanged at around $13 billion. We make certain cuts in businesses like our marketing business as we try to improve the returns in that business going forward. That $13 billion is sufficient to be able to maintain our liquids production through to the end of the decade, as well as to grow our world-leading LNG business by around 20 to 30% over the coming 7 years.
So the LNG side, which is Nigeria, Qatar, other places, is expected to grow. You heard coming into the segment, my colleague Joe Kernan saying the IEA, International Energy Agency, is saying oil demand growth. And that's maybe the key word, will peak this decade. But yet now I've got you, Shell, saying we're going to actually keep oil and gas liquids steady. It appears that it's easy to be confused on where the demand for oil and gas is going to be in a decade or 15 years. Where is it?
Look, to be honest, anyone who knows that will be making a lot of money at the moment. The reality is we don't know. What we do know is the demand in the short term and the medium term continues to be very robust.
So
We've seen that coming out,
there's
and we're back to
like I know like oh my gosh, this girl's gonna get you guys need to know that like investing is stressful. So if you guys think that like, you know, you guys are just gonna be able to buy stocks and hold them, you're gonna come across the time where you're gonna be up X amount and you're just gonna hold and it's gonna go down and it's gonna go down a lot further. You get a bad earnings or something. Now Nvidia and stuff like that, they're not going nowhere, you know. But I don't know. Sometimes you just gotta. Listen, it is not yours until you take it. Okay. There's nothing worse than letting a green trade go red, let alone a green investment go extremely green, and not taking some off the top and putting it somewhere else that could, you know, have some meat on the bone as well. Like it's not like that's the only place that's good for your money. You know, and again, I'm not a financial advisor. I can't tell you what to do with your money. But I mean, I'm just saying, like, you could take it and put it somewhere else. Maybe a little safer place. Maybe, you know, and I'm not saying to, like, you know, take half off or anything. Take 3/4 off or something. You know, you gotta take some of it, or at least have an area where you're like, yeah, if it gets here, I'm out, because I cannot let this get past this point. I'm not willing to just like be up all this money and let it just drop and something happen. All right. You can always get back in, set a stop loss, and then possibly get back in. The little girl's being a pain in the butt right now. So, all right. Again, I gotta run through these charts.
But all these innovations, right? Anti-lock brakes, seatbelts, you name it. Indy 500, right? NBC Sports, by the way, ratings up. I look at biofuels. What does that mean? What does that mean? Is that an alternative? Everybody's saying we're going all over here in EVs. What is the biofuel reality? Not for IndyCar, but for you and I, driving our family.
So biofuels is very attractive because it's a drop-in fuel. You can just combine it with your gasoline. Biofuels is particularly helpful for commercial road transport more so than passenger vehicles, right? With passenger vehicles, you can mix it, but for commercial road transport, a pathway to be able to decarbonize that sector is mainly
Is it
biofuels.
actually decarbonizing it? Or is it, you know, people say biofuel. I hear the word fuel. No way it's low carbon.
Yeah, fuel is more the drop-in.
Greenwashing, as they call it.
Many people will say many things. The reality is, of course, we are driving towards second-generation biofuels, which in essence use agricultural waste, residual waste, municipal waste to be able to produce these barrels. And very attractive then is to be able to simply drop in these barrels with your gasoline so that you can dilute the amount of gasoline you're using in your car.
I could basically take my garbage, make a fuel smoothie, put it in a car, drive it around.
That's exactly
low
right.
carbon.
That's exactly right.
And is that a where are we have to go? But where are we on that? Is that a reality?
We are today being able to distribute significant volumes of biofuels on the basis of that, with Brazil being one of the largest markets producing that.
You know, I hear a lot about Brazil these days. We got to get down there. Well, Sawad, Capital Markets Day at Shell, stocks up 2% in the pre-market. I know you got a busy day. We appreciate you taking some time for CNBC.
Thank you very much.
Thank you very much, Andrew.
Hey, thanks, Brian. We got a lot more coming up this morning. Breaking inflation data, a new look at producer prices. It is all on the way. But next, the newest chapter from serial entrepreneur and executive Marcelo Claure. He's going to be joining us after the break. Stay tuned. You're watching Squawk, and this is CNBC.
Love banking app.
Welcome back to Squawk Box this morning. Our next guest has held a wide variety of roles, and when we've spoken to him over the years, among the challenges he's taken on, stepping in at WeWork after Adam Newman was ousted, helping orchestrate Sprint's merger with T-Mobile, and leading SoftBank Group International. Joining us right now to talk about his next chapter, announcing this morning, Marcelo Claure is the executive chairman and managing partner at Bicycle Capital. Good morning to you, sir.
Hi, Andrew. How are you? Good to see you again. Exciting day here.
And we should also note that the Bicycle Capital's managing partner, Shu Nyata, is with you as well. Tell us about this next chapter, what you're doing, and then I've got so many questions about so many other things that are going on in the world. But this is your next foray.
I mean, first of all, it's great to be back at being able to work. It's great to be back at being an entrepreneur. It's been an amazing ride to be part of the SoftBank ecosystem for so many years, and it's just great to be back at being an entrepreneur. So we're launching I would say, our first act, which is a venture capital firm that's going to be focused on Latin America. I'm launching with my partner Shu, who's in the line with us, and we're very excited because we've always been incredibly passionate about Latin America. The potential of the region, and it's a place where a lot of people have not put a lot of focus. So we decided to launch a fund that is launching today, and incredibly excited about it.
And Marcel, I mean, just for the audience that doesn't know, go back to your history at Brightstar. I used to tell people when we first met, you were effectively selling, used phones out of your trunk, but I mean, it was more than that.
That's how it all started. Brightstar was the first venture that I started. It was a small distributor who ended up being the world's largest distribution and supply chain services company with pretty much presence all over the world. And it all started in Latin America. And after that, I went to Sprint, I went to SoftBank, I went to WeWork, and to many different places. But it all comes back to the place where what we're most passionate about, and that's Latin America. And this is why and now that I'm back, allowed to go back to work, the first place I wanted to go back was Latin America.
Right. They call that gardening leave. It's over for you now. You got to stop gardening this summer. Shu, how did you get involved with this?
Well, I'm Kenyan, so I'm not from Latin America at all. I just see an incredible commercial opportunity. I've been at SoftBank for 7 or 8 years.
Do you guys see see this range here? So you guys are going to want to put these targets up on your chart. Okay. These are the targets you're going to want to put on your chart.
So that's where we come in.
All right.
Hey, Marcelo, SoftBank question for you.
You want to give yourself a couple levels. All right. In case you do get that interest rate decision, you have a big gap fill here from Sunday night into Monday. So, you do have a gap here. There is a gap. We will revisit them.
By the way, it's now at 20 cents. It was once obviously $10 because it was part of a SPAC. How should the public think about that? How should investors think about that?
All I can give is my point of view, right? I love SoftBank. I think Masa is an amazing visionary. And people who always written off Masa have always been wrong. And I think Masa, it's always going to be strong. SoftBank is going to be incredibly strong, in my opinion. I'm a shareholder of SoftBank. And I believe that, Masa has always made bets in the right technology, right? You look at it. He started talking about what we are all talking every day, which is artificial intelligence 3-4 years ago. And that's what the whole world is talking about. So I'm sure Mazda will be fine. I'm a big believer in the future of SoftBank, as I'm a big believer in what we did together with Mazda throughout our journey in Sprint, in SoftBank, in ARM, in Fortress, in so many different companies that we managed together. So I only have a good vibes towards Mazda, and I hope he does incredibly well and the whole SoftBank family.
Dare I ask what you think is going to happen to WeWork?
I like not to comment on that. I just give you. I think WeWork's a great company. It's unfortunately what has gone through the pandemic and the whole real estate market, and I only wish good stuff to WeWork, as it is a great business that I believe it has the wrong capital structure, and I hope there's a future for WeWork.
Hey, Shu, Marcelo just mentioned the sort of AI, and we're all talking about AI. How do you think that works itself through in terms of the way you're thinking about investments in Latin America in particular? And I ask because I think there's a big question mark right now, given where AI is, whether the incumbents win that game or whether there's emerging companies that will come out of all of this that win that game.
The wonderful thing about Latin America, Andrew, like most emerging markets, is a vast majority of the population, consumers and businesses, are deeply underserved. So unlike the story in Western countries in the US, which is all about disruption, innovation in Latin America is much more about inclusion. It's about bringing simple technologies to people in the middle and the bottom of the pyramid. That's where the equity value is. And so it's less about what's happening with OpenAI at the cutting edge of research, much more about propagating AI and other tools, cloud, mobile, basic tools, deeper into the population. So it's much more of a distribution angle than an innovation angle. And that's equal opportunity. Incumbents and startups have a lot of room to run because, as I said before, most of this population is underserved. So it's really about inclusive innovation, not disruptive innovation in Latin.
Marcelo, why do you think that the incumbents have not invested as much in Latin America? Is it because the view is that the growth doesn't exist there? Too risky? What do you think it is?
We started investing in Latin America in 2018 and 2019. That's where we opened the SoftBank Latin American Fund. And since then, Latin America has seen a tremendous increase in investment. We went from $1.5 billion of venture to close to $16 billion in venture in 1 year. And that has not gone down to one. It's up in the $7-8 billion range. So I believe that Latin America has an incredible potential to develop amazing entrepreneurs. I think one of the greatest, there's some great stories. Mercado Libre is an incredible stock. It's an incredible marketplace. You look at companies like Nubank, who to me is bar none the best digital bank in the world, probably the most valued digital bank in the world today. So, and I can list a bunch of different Latin American companies who were developed during the course that we were there, who today are world leaders. So I think this is just the beginning of Latin America. Obviously, people like to focus more on India, China, and the United States. But when you look at Latin America's size, Latin America is just almost twice the GDP of India. It has half the size of China from a population perspective. So it has the size, and I think people have traditionally stayed away with it. And since we launched the Latin American Fund, we've created a step change, and now it's time to do it again. This is the beginning. It's the beginning of a journey. It's it's different when you're going to be running your own fund than when you're running somebody else's fund. So both Shu and myself could not be more excited to be back at being entrepreneurs and launching our own fund. And also, I need to say that it's amazing to be in partnership with Mubadala, which to me is one of the Middle Eastern best-run sovereign funds, and for them to entrust us and being a first-time fund and being an anchor in this fund with us, it's a testament that sovereign funds are now looking at Latin America, and it's great to partner with somebody like Mubadala.
Okay. Before I let you go, soccer. You used to own Inter Miami. Didn't you sell your stake? Am I wrong about this? Didn't you sell your stake back to David Beckham? And now Messi's coming?
Yes, that's a team I started a few years back. It was a team where I started from scratch. So it's nice to see from the logo and everything that we designed. And that's a team that I sold, of course, to a year and a half ago. Both Mas and myself were shareholders in Inter Miami, and we're so happy to see that the team had been able to attract the talent of Messi, which is going to make MLS even a more relevant league in a time where soon we'll have the World Cup in the US, we're having Copa America in the US, and now we have the best player in the world playing in MLS and Inter Miami. So fascinating times ahead for soccer in America.
Marcelo and Shu, thank you for joining us this morning. We look forward to following your progress and talking to you again soon. Thanks.
Thank you.
Thank you.
Joe?
All right, thanks, Andrew. Coming up, May producer inflation data. We'll bring you the number of the morning and then get reaction from author and economist Judy Shelton. Got an op-ed piece in Wall Street Journal this morning.
So again, if you guys have any questions, just throw them in the chat. I'm just running through my charts real quick, and we're going to get things going. We have PPI here in about 5 minutes. About 5 minutes, gang.
Coming up in just a couple of minutes, we've got the May producer inflation. We will bring you that big number right after this break. Stay tuned. Squawk Box will be right back.
consultation.
Welcome back to Squawk Box, everyone. Rick Santelli is standing by. He's got the next inflation data that we're waiting on, and that is the PPI after yesterday's CPI. Rick, take it away.
Yes, we're expecting our May read on the wholesale side of the equation on the producer price index, expecting down 0.1% on headline, down 0.3%, down 0.3%. And do remember, all the high water marks for producer prices on all levels were made in March of 22. The high water mark for this series was 1.6. Since then, this is the 4th negative read that we've had on headline PPI. And -0.3, well, in March we had -0.4 to put some context. Up 0.2 when you strip out the all-important food and energy, as expected. And if you strip out food, energy, and trade, it is unchanged. Now, let's go to the year over year, shall we? PPI, final demand year over year. So headline year over year up 1.1%. That follows up 2.3%, up 1.1%. 11.7 was the high water mark in March of 22. So this has come down a long way. When was the last time we were at 1.1%? Well, I have a 2.5-year database, and it's prior to January of 21. So a nice low number, 2.8 when you strip out food and energy year over year. We're expecting 2.9. High water mark there was 9.7. And finally, if we look at ex-food, energy, and trade year over year, it's up 2.8%. We're expecting 3.1. In the rearview mirror is 3.4. And, well, 2.8% is interesting because that is the lowest level going back, and I may have this one, yes, that is the lowest level since February of 2021. So these numbers are significantly less than high watermark. High watermark there, by the way, 7.1%. So unlike consumer price index, we are coming down much more brisk, much faster. And 10-year note yields haven't moved that much from 380 to 379. 2-year note yields, 462. They were 463 prior to the number. But it isn't necessarily the distance traveled here as yesterday. The issue really is how the market ultimately and investors think about this number and what do they do for the next several plus hours. Yesterday, of course, we saw a big reversal after the knee-jerk reaction. And if we look at what's going on with the pre-opening equities, not a significant amount of change. We still see down futures down about 75, 80 points. Ultimately, today's Fed decision doesn't look like a rate increase, but a pause. And to me, a pause is very important. Why? Because we need to ask ourselves, why are they pausing now? I'll tell you why. Because they really want to be done. They want to buy themselves more time. They understand that keeping a 5 to 5.25 rate over time will continue every minute of every day to exert pressure on the economy after decades of rates being too low. Becky, back to you.
Rick, you think the muted reaction today, both in stocks and in bonds, maybe just an indication that PPI is less important than the CPI, and what the number we got yesterday brought the market's reaction, brought the expectations for what we expect the Fed to do today? Just solidified it?
Yeah, I think that sums it up. I do think on many levels that the wholesale number isn't as significant to investors who are always trading in the moment, in the here and now, than consumer price index. However, I do think that the producer price index is giving you a good indication that ultimately the effects of inflation will continue to moderate. It's just a question of how comfortable the central bank is as these numbers are higher than, of course, they will tolerate, even though they may do more damage and less interaction in the interest rate complex by just moving rates higher. They're going to do more damage. I'm not sure they're going to change the course of these inflation numbers. So we'll have to wait and see what the press conference holds for us and what Jay Powell has in store this afternoon.
All right, Rick, stay right there. We want to bring in Steve Leisman. Steve, what do you think looking through these numbers?
I like the way Rick put it. You know, I think smart investors are watching the PPI because it's telling us that inflationary pressures up the supply chain are dissipating and dissipating rapidly. And I think that's a really important development. When I look at different things, it's more than just food and energy. So it's more than the volatile sectors here. Transportation and warehousing down
4% on a 12-month basis. So what you have is the things that pushed up prices. Now, the question we have to ask ourselves is the dynamic at the consumer end, which is, are companies feeling the competition and the competitive pressure as their input prices fall? Do they have the ability? Do they have the necessity to lower their prices? It's a different dynamic on the consumer end. Before, you had consumer-facing companies holding the line on price increases. Now we've kind of broken the dam on that. So we watch that very carefully. And Becky, I want to show you one more chart here from the CPI yesterday that we didn't get to look at. And this is courtesy of Tom Lee pointed this out in a note this morning. And what I want to show you is what's going to happen next month. And this is another reason why the Fed might pause. If you go back and look at this one-year bar chart of the inflation number, see that June number there all the way on the left side of your screen?
Yeah.
That drops out of the equation next month. And Tom Lee suggests that could bring the inflation number down from 4% to 3% just on its own, all else being equal. And that's going to be a big reason. That's another reason for the Fed to pause.
Why is there an empty space next to it? Is that so
I think
low
that's
you
a
can't read
zero.
it?
I believe
Zero?
that'll be
Yeah.
that was a 0 month. So you had that 1.2% number. That's a
That could
month-to-month
really change
number.
the picture. Yeah.
That could really change the picture. It's another reason for the Fed to pause. And I think these wholesale numbers suggesting less pressure up the supply chain is yet another reason.
Okay, Steve, stay right there. We've got two more voices we want to bring into the conversation. Julia Coronado, who is Macro Policy Perspectives founder and president. Also, Tyler Goodspeed, who is former acting chair of the President's Council of Economic Advisors. He's currently a fellow at the Hoover Institution. And Julia, let's start with you. There are some pretty positive signs to read into this. Again, the market may not be reacting too quickly to any of this, but does it change your perspective at all?
So when they jump out at you, they bite you hard. So I don't think the Fed wants to find itself in that lender of last resort position it found itself in March. That is not where you want to end up. And that is a key reason they are taking a breather in June. Inflation hasn't shown enough progress, but there are very positive signs in the right direction. And meanwhile, you've had a very tangible, serious event where the Fed is, had to expand its balance sheet and step in as lender of last resort. That's, again, not where they want to be. So I think they have a delicate task ahead of feeling their way to that right policy setting. The economy is doing a lot of, work for them. The economy has been just incredibly resilient. The labor market's been incredibly resilient, but they cannot take that for granted. So I think the balance of risks is definitely two-sided now.
Steve, can I just ask you, just thinking about this balance of risk, I don't know why, it just occurred to me, does the Fed have some sort of a Hippocratic oath where they think first do no harm, which I guess would push them to the point of stopping, pausing, and waiting to see until they have a little more definitive information? Or does that not exist at all when it comes to the Fed?
No, it definitely exists, but the question becomes the balance of risk, right? If the balance of risk tilt towards higher inflation, then the do no harm is to do more in terms of bringing down inflation, right?
But if the risks are balanced at this point, what does that argue for?
It argues for the Fed to pause here. But Becky, I just want to know if I could have a second here to draw Joe out. He's been hinting at this all week, and I'm kind of interested. Maybe I'm there. Joe, is this the party getting started that we've been waiting for? Is this the green light? We've been talking about the Fed pausing and stopping, and now it's time to go. Are we there yet? Is this the green light? I don't know. I don't want to miss it, but I don't want to be too early. Is inflation vanquished? Is the Fed on pause? Can we start doing IPOs and, I don't know, drinking the punch again?
What I want or
123.75, guys. 123.75. Well, this was like your prior high, and then look where the open was. It's right above it, just about. I guess you could say this level here that I've had, but it's kind of wide.
The Nasdaq and the S&P are totally oblivious to what is really happening and have a better idea than the Fed maybe what's happening,
right.
and maybe the bond market
They're sniffing it out.
Has a better idea of what's happening. And I like the way, I think you and Jay Powell, I don't know whether you guys talk, but you both seem to be more open to lags and that we might already be there. I don't really understand the other side. That seems like, I think that most of the people are really young and weren't around for the 70s. They always talk about Volcker in the 70s, but they weren't even there for it. So I don't really understand why they get locked in that. I sort of have a empathy for where Rick has been on whether they've already gotten to where they need to be. And
that's certainly been Rick's. That's been Rick's take for a while here. I've been a little more cautious, and you've
I don't
come
know,
around
Joe. You said Thursday, last Thursday. You know, Judy Shelton's going to be on.
This could be it. I don't want the moment to pass.
Does the Phillips curve even work?
I think the Phillips curve is a nice idea, but I don't want to miss the moment, Joe, if it happens. And we've been sitting here talking about the moment when the Fed would pause and it would be the green light for IPOs. I just don't want to miss the moment if this is it.
We've called a few pauses.
It was the last meeting. You missed it already. It was the last quarter point. You missed it. You missed it, Steve. Too bad. Happy Flag Day, though.
Happy what?
Flag Day.
Oh, good. That's right.
Thank you very much. All right, guys, we'll leave it on that note, but obviously we've got lots more to talk about all of it. Want to thank our panel, Julia, Tyler, Rick, Steve. We'll see you guys soon.
Coming up, reaction at today's, I'm cautiously optimistic. I can always say that, right? Coming up, reaction, that's my answer, Steve. Today's PPI data and a look ahead to this afternoon's Fed's decision, or am I optimistically cautious? How do we decide?
Cautiously optimistic is better.
Okay. We have talked about her 3 or 4 times already this morning. It just her ears are burning. Economist and author Judy Shelton. Next, though, the door to the IPO market cracks open just a bit. We'll tell you about the restaurant chain going public and what.
Sorry, my little girl is just going crazy. She's trying to get behind the screen. She's just trying to get up here with me. I'm like, there's no room. She's killing me because I have so much shit I want to go through.
Welcome back to Squawk Box. Mediterranean fast casual restaurant chain Cava is expected to price its IPO tonight. The public offering could set the tone for other restaurants looking to debut in the near future. We were just talking about whether the IPO window has just opened. Kate Rogers joins us now with more. Kate.
Andrew, good morning. The Mediterranean chain says it expects to price shares in the range of $19 to $20, up from its original range of $17 to $19. The company's taken a unique path to expansion, focusing on the suburbs. About 80% of its locations are there. Cava has comparisons to the Chipotle experience with drive-through and second make lines for its digital orders. It took the chain Zoe's Kitchen private in 2018 for $300 million, and it's been converting those locations into Cava restaurants. While not profitable yet, sales are rising according to SEC filings, with same-store sales for Q1 up nearly 30%. Foot traffic also much higher than the fast casual category overall, according to data from Placer AI, up 4.1% in May year on year, compared to a decline of around 5% for that part of the sector overall. Comparable names in terms of concept are Sweetgreen and Chipotle. Both have strong performances for the year, up 23 and nearly 50% year to date, which could give some sense of investor interest in similar companies, rather. But Sweetgreen, remember, is still well off of its IPO levels. Other names may get in on the trend, including Panera, which announced it would replace its CEO in July in preparation for an eventual IPO. No timeline there yet. And on the smaller name side, Fat Brands' Twin Peaks and Gen Restaurant Group have filed paperwork to go public. Timelines remain to be seen, but Cava could give an indication on investor interest in the space moving ahead. Andrew, back over to you.
So, I mean, we were just discussing sort of where we are in the economy, what's going on in the markets. Why is the time now, if it is, for these names?
Well, analysts kind of say Cava could really set the tone here. I spoke to Blue Shirt Group, which advises companies on IPOs. Did not work with Cava on this one, but that group said it could be a bellwether for restaurant IPOs, despite what may or may not happen with the economy in the back half of the year. We have to remember dining out is typically one of the last places that we see consumers pulling back. So the outlook for Cava looks good there, and it's kind of an attainable luxury, right? It could even benefit from a trade down if consumers are kind of shying away from casual dining, because this is a more affordable price point, but it's still higher end compared to like a McDonald's, for example, when you're choosing where to dine.
Kate, real quick, this is a money-losing enterprise in terms of so there's a speculative element for investors here about when does this company break even and get to profitability. I don't know if there's a real sense of when that takes place. But the other question I was going to ask is, we keep comparing it to Chipotle. When Chipotle went public, was it a money-losing enterprise?
I do not believe so. And obviously, as you said, Sweetgreen, too, is also still losing money, I think looking to turn a profit in 2024, Andrew. So a similar name there and another name in the same cohort. But Chipotle is doing much better, very different enterprise here, obviously, than a Cava. So it remains to be seen.
Okay. Well, we'll keep our eyes on it. I'm sure you'll be reporting on it all day. Kate, thank you. Appreciate it. Becky?
Thanks, Andrew. Up next, we'll get reaction to this hour's inflation data and what to watch when the Fed decides on rates this afternoon. Economist Judy Shelton will join us. We'll be right back.
What a rough morning already, guys. It's been a rough morning. This little girl wants to be with me. She wants to be right next to me. And I'm like, girlfriend, there's no room. So I sent out a watch list this morning. If you guys want to check it out, there's a couple things that are going on. I want to know what's going on with Coinbase. Kind of curious about Coinbase. So if you have like AMD, let's say, if you have Thinkorswim, you can go to like live news. Wells Fargo raises price target on AMD from 150 to 150 from 120. So AMD price target upgrade. You want to get that. I told you guys. What did I say? Oh my god, I can't even write it. I don't even know what the hell I'm doing. So, didn't I say that a couple days ago? I know you guys heard that. I'm like, watch, they're going to start raising price targets.
Welcome back to Squawk Box. Headline produced. The core rate was up 0.2% in line with estimates.
So, yeah, if you guys have any tickers, anything you guys want to go over, throw them in the chat. It's going to be, I'm going to change some things up here in the next, like, probably next week, towards this weekend. It's not going to change, like, it's not going to make any big changes, really, or anything, but I just want to change how I do this to get this more, you know, just to get it visually better, and I can stay on track, and I get better at this. So you have a gap here on AMD. Look at that. Now this is all after hours. So if I take this away, that top there will not be there. Come on. Okay, see how it's not there? I don't know where the hell. She makes a good point. Come on. She makes such a good point. But it's the system we live in, so it is what it is, to an extent.
SCHW, Schwab sees Q2 revenue decline of 10 to 11%
Schwab.
year. That's Cindy Charlie Hotel Whiskey, SCHW.
There's Schwab. There's Schwab on the list.
France wants Elon Musk to build a Tesla factory in the country, even as it threatens Twitter with a ban, according to CNBC. Take a listen.
There's news on Schwab, so we'll put Schwab on the list. This is crazy. I still want to go over Google. So what am I going to do with AMD? What am I going to do with AMD? I don't know what to do, honestly. I just don't see anything. Maybe I got to take all this shit off. And because I'm starting, like, everything's just starting to get so combobulated. I started taking everything off, like, on the SPY. So I don't want to get confused with, like, with having a whole bunch of shit on the line, on my charts. Okay, high of the day technically is right there, and we have the close technically right there. Let's see where 2 minute is. Boom, boom. Okay. All right. So what are our readings? Okay, we have a negative MACD. Let's just look at the 5-minute. It's actually positive, trying to go negative. Lower RSI, lower highs MACD. That's bearish divergence. Okay, we got some volume stepping in here, looking more like a sell. We'll wait and see. Okay, let's go to Google. I'm going to go back over these though too before the bell. So Google's kind of just flat. They have like a whole bunch of stuff going on with them that I guess, you know, creators and stuff, they just with ad revenue, they're not too happy with them. So they've got a list as long as, like, I don't know. They got indictments everywhere. It's like they're this like big tech company that's like the felon. You know. Flipping Google. It's just funny. Cause they are, and you can tell. Like, it's just funny. So Google also has been putting.
We trade shares pumping to the highs now with the Echo Tango Golf.
I gotta turn that down. Yeah, the camera was freezing last night, so I'm just like, whatever. I'm not even gonna mess with it right now. So it looks like, so here's what we got. Google, if we can't continue higher for whatever reason, okay, I gotta get rid of some of this shit. Like, it's really bugging me. We tried to break out here. We tried to break out and extend with the rest of the market. Google is still down. I mean, it technically on the daily it's up, but it's just sitting in a range. It's just sitting here in the range. I honestly think I should just remove all these lines and start over. So it's kind of just hanging on here. And the top side of the range is right there. So it's just stuck between this pivot and this base. You know, where you based from before. See how you bounced up. Boom, boop, boop, boop. And then you broke down to put in the new range. So that's what it's doing. Who votes for a pause, and who votes for a raise? Like who? Let's just start. Like, who would want a rate hike? I'm just curious.
UPST, Upstart, Texas Bay Credit Union selects Upstart for personal lending. That's from Papa Sandy Tango. RMNI, Rimini.
I gotta go over small caps and everything too. Like, Abby kind of just let me be me.
Producer prices and the Fed policymakers due to announce their decision, as we said, 2 o'clock Eastern today, followed by the chair's news conference. Jim, a lot of discussion on just how bad Fed days have been for stocks, especially, well, this year, but really under Powell overall.
Yeah, and what happens is you've got a two-part, just a one-two punch. Yet the statement comes out, and then immediately the futures go down, and then they try to recover, and then the press coverage comes down. I'll tell you, I don't know, I was the editor of the high school a lot of high school he's taking questions from people who are like, Columbia journalism school people. But that's when the market.
Okay, so Schwab's holding up. Okay. Okay, I see you, market. You want to play hardball? I see you. I just don't see a trade on Google just yet. Unless it's just me, unless you guys see something. I just don't see anything. I just don't see anything that sticks out to me and says short. Unless we get up here to this 126 level, 125.80. You know, this is what you want, man. This is the type of day you guys want to get on. Like this little chop fest shit, you don't want that. Alright, it's doing one of two things. It's holding the top side of the range here. See? It's holding that as resistance, and then it's holding this as support. When does one of them break? Alright, when does one of them break? And when you get that break is when you want to, like, take advantage of it. So, but for now, it's just sitting in a base, and it's kind of in the middle of its range. So, unfortunately. I want to check on IOBT. I don't know how. Oh, and this thing already just. Are you kidding me? Look at that. That's so funny. It wouldn't even. Oh my god. Let me take that off the list. That's awful. Yeah, that's not on the list anymore. SoFi is a top pick fintech and surged more than 45% of student loan payments resumed. That has to do with what I was saying about how I think we could have some further downside. Further downside could be because of like little things like that. Sophie. Good old Sophie. I know I can find something really good. I feel it. I feel it. I'm gonna find something that is a nice what the hell? That has a nice setup for us.
Hyundai Tucson versus will be revealed as the frauds that they are, and we will put them on and congratulate them because they will have amnesia. But I have no amnesia. I don't have amnesia.
Are you okay, Kramer? Kramer's a nut. Kramer's such a nut. So I might be just trading the indexes today. I'm gonna go get a cup of coffee, team. I thought I had this here.
I mean, you have a Nixon press conference, which is, if anyone remembers those press conferences, it's like, you know, why did you bomb Hanoi? Now you were referencing.
Hold on here. No. I had this, I thought, down here. I did. I for sure did.
They should have Pat Chase. Say, Jeff, he should run that moderate press conference. Fed pressers, right? What do you think? Sure, why not? Well, I mean, why not? He's going to have time in his hands. It's amateur hour.
I'm gonna go get a cup of coffee, gang. I'll be right back.
I think the Jeopardy is far more professional in the press conference.
Yes, it's a very professional show. Not as professional as it would have been had I been the host, but it is still professional.
Yeah, I knew we had to work around to that, didn't we? You know, you had to go there.
Well, you went there. I just followed.
Well, David, you wanted to talk about advanced micro, and
I did. I want to talk about advanced micro. I want to talk about the chips. I want to talk about NVIDIA hitting $1 trillion. Sure.
The $1 trillion.
Because we're at the 6-minute mark. It's important.
$1 trillion. You know what, David? It actually is. I mean, here's the come in. The $1 trillion club is not easy to get into.
No, it's not.
And
now,
to
be fair, it did hit it intraday last week.
No, but you see, this is a monumental thing that people refuse to realize, which is that this company has come out of nowhere, which is a gaming card company. And the Chinese, we have left this out. The Chinese are not allowed to buy their chips.
No, their chips are advanced.
So
gaming cards as in chips that powered games.
So the Chinese can do their Candy Crush all they want. But when it comes to nuclear weapons that are high-powered and can be targeted, actually, Jensen's not about nuclear weapons. But I'm just saying that the The H200. David?
When did they go from the H100 to the H200?
Well, you have to
Jim?
buy the Grace Hopper 200. That thing is so fast. Take a look at the flops that it has.
The flops?
Well, that's a unitive measurement.
Okay. I haven't taken a look at that. Do you want to elucidate us?
It's just a lot faster than what we saw yesterday from AMD.
Inform us? Okay.
Well, see, you put them together. You bundle them like what Larry Ellison did. By the way, Larry Ellison does have the fastest supercomputer. I mean, there's no doubt about it. Larry is close.
It's not like I feel like I'm on tilt, but I'm like, I might just have to trade the indexes. I don't see anything that I really like, unless somebody else has some like ideas out there. Maybe there's Ford hitting our target.
Hyperscale budgets are still going to be constrained in the near term.
Well, I didn't understand that. They talk about the height. I think that I have
MU looks like it's putting in a head and shoulder. You know.
that the amount of business that they have just from Jensen. Gary Dickerson was saying he talked to Jensen. You know, he talks to Jensen regularly. Jensen wanted being the CEO of
NVIDIA, yes. Anybody listening to this show hopefully knows that at this point.
You know, someone told me to cool it with NVIDIA. I said, oh, you know what? I'd like to cool it with companies that go from 300 billion to $1 trillion, but it turns out our viewers like it.
There is a reason we talk about 6 or 7 stocks consistently. It's because their market cap adds up to more than, I don't know, what are they, 20% of the,
almost 8,
25% of the S&P, the 7
From now
stocks.
on, I'm only going to talk about JB Hunt, Medtronic, okay, and Union Pacific. Would that be better? Would you like that?
No, I would.
I'm serious. We've had an amazing thing here. You know, to have a company come out of nowhere and be $1 trillion is as important as the 2 and 10. You want to go there? You want to go inside the yield curve?
Well, and now we're getting some interesting projections. McKinsey, this study they've done that looks at maybe 60, 70% of work hours could be automated in some way over the long term.
Interesting, because Benioff is saying only 5 hours, and because of that, 5 hours saved by AI.
I don't know, gang. Looks like I might be just trading the overall indexes. Okay, I'm not seeing anything that I.
It was a little less than they had hoped for.
Well, because Mark is not, you know, Mark's company, as opposed to Adobe. Mark's company is about selling something to another company, okay? Or like maybe.
I don't know why it keeps making that flipping noise. I know why it's doing it, but.
4 different people you're going to see that day. That's AI. Right. So that's me. You know, that's not exactly.
Oh my God. AMD had a nice run yesterday, guys. So listen, when you have a nice run like this, what's up, my guy? How you doing this morning? Usually the next day, it's just rare. It's not that it can't, but it probably won't give you a look at this high to low. You had a 133 to 122. You had a $10 move in NVIDIA. That's pretty insane. So it might cool off and consolidate today. It's hard, you know, doesn't mean it has to. But I am, like, I have no trade ideas, honestly. Like, SoFi is just going straight up. Maybe I can look at Amazon, Google. Google had news, but Google's just like, it's not moving off of it. There's no setup. And it sucks. Usually by now I have something I'm watching, and
Well, you were certainly right about AMD over the long term. Got at least
like I say, tomorrow and Friday, I want to see how positioning and stuff is tomorrow. It's obviously Fed day today, but so the only thing I could think of, like, would be to go long Google. Even with this news about the other countries trying to sue them. I don't know. I don't really see anything. I just don't see anything. I gotta remove all these lines because I'm starting to get irritated with all these lines and stuff. Maybe I'm gonna make a cup of coffee and see if that helps me kind of get there. Above all the other moving averages.
Now, I don't know if you noticed some of the things that Meta's been doing. I mean, they'll push you stories now that are exactly what you like on your watch.
Jesus Lordy.
Part of what they're doing. You get your stories on your watch that you like. Those are all pushed by Meta.
Yeah.
using this kind of technology.
But that doesn't exist yet, does it?
No, well, they've already broken through. And this is what you need
Olo
to buy.
announcing
This
reduction
product
of its
doesn't come out.
workforce by about 11%.
Doesn't come out tomorrow. And you think it really will rival in any way what NVIDIA is doing?
No, no chance whatsoever.
Okay.
It just doesn't matter. You don't need it to rival.
You don't.
We have such
It's
strong
for a
demand.
different. It's for a different.
Well, look, I mean, remember, Jensen said the new computers are going to be 95.
If you guys have any trade ideas or anything you guys want to look at, just let me know in the chat. So Amazon's been pretty strong. It looks like yesterday it just had a consolidation day, so maybe we look for possibly some more upside on Amazon. Where is it at right now? It is at 127.
Are you sort of
127.
the view that AI will be cannibalistic in some ways to legacy spend?
I just don't have anything and I'm nervous. Just don't have anything today. And sometimes it's like that.
Jensen says that $1 trillion is just going to be obliterated. He said obliterated.
That's over a long period of time.
So that's 127.
4 to 5 years. 3 to 4 trillion. Things work really fast, David.
We're just going to need some news or like a reason to move up to this top side.
Like what? Man on the moon? You know, the iPhone? I mean, Jensen struggles with how to get people like you to understand how big it is. So he uses iPhone.
Yeah, I seen, so like UNH, there was, I think it's not even just UNH, it's like, it's a few healthcare, it's a lot of healthcare stocks, that are down, like, there was something with like Humana or something, like Humana, somebody came out and said something about something, and, you know, it scared the whole, I hate that noise already. See? So you could probably, now this is more insurance, but MetLife it's more insurance, and it actually, okay, it didn't move. There was another one with Snoopy on it. You could play
What do you want? Slow and the Furious? He wants to slow and the Furious. He's living complacent.
XLV also off of it. But yeah, I seen that.
We come back. It's been a rough morning for some of the health insurers. UNH is warning about the medical cost ratios dragging that group.
Probably because it was an overreaction. I mean, you got to think that is crazy. They're like 3,000 to 4,000, and the puts are like $50. I'll have to go to the options chain and find out. But probably the reason is because it's going to go back up. You know, I don't know. There was a scare. Look, is it? No, it's still coming down. So unless it's the puts that are still up a lot, I don't know. It's weird. That's so weird. It could be the options chain still might be messed up. I don't know. We'll have to see. All right, it's 9:15. I'm gonna set up. So what I'll probably do this morning is, if there's really no small caps or anything to trade, it looks like I might just end up. I'm gonna sit on my hands. I mean, I don't know what I'm gonna do. It's not like I'm gonna deliberately sit on my hands and not trade anything. If there's a trade, I'm gonna be trading it. WETG. I should have already had these done. Dude, my cat was going crazy this morning. Okay, yeah, with WETG, I already looked at this one. So this has a gap up a couple days ago, and it's now working its way up. News. So I'm going to make a cup of coffee. 12 information on stocks moving Wednesday pre-market session. WeTrade Group launched large-scale language processing models to increase product applications in the field of artificial intelligence. Shares move higher. See what I mean? Why couldn't AI just say, or why couldn't GameStop just come out and say, yeah, AI, and that's it, and walked away, and their stock would have went up? They didn't even do a conference call. Like, what bums? What bums? You have the best news. Look at this penny stock. They're just like, yeah, we came up with some algorithms, bro. Like, that could mean anything. That shit could mean anything. Like, seriously. They could have an empty warehouse with a can of soup in it, and they're on their phone talking about, yeah, I just did some AI technology on my phone, and like they made an avatar or something, and they're like, yeah, we came up with some algorithms for AI. Look at the stock, dude. This thing was less than $1. This thing was an empty can of soup in a warehouse at negative 5 cents, and now it's $17, gang. You know what I mean? Imagine what GME could have did, or like the companies that haven't taken advantage of it. All you have to do is say AI. Yo, we got this algorithm, bro. Like, that's it. You don't have to get into like what all it is. Like, just say you got an algorithm. Something stupid, like for real. It's funny. All right, I gotta make a cup of coffee. I'll be right back. I guess I'm gonna take my time this morning. I want to see this become resistance. Previous, like this morning's pre-market QQQ. I made a live and said I felt like we could get a pullback, just instinctively, from what the chart's telling me. I'm trying to like think of something that like has a nice setup or something, and I just don't see anything. I don't know if I got to go through these charts and figure something out. Maybe we get coin to the upside. I don't know yet. But I do have to find something. I'm drawing a blank. Look, he's talking about it now. Dude, that noise.
Down 40. I mean, this is down 40. I mean, Humana on June 1 reaffirmed. Now, it's entirely possible we're on Flag Day, so it's very possible that in the last 13 days, Humana's fallen apart. I think that's probably unlikely. Humana does have the most senior exposure.
What's Cigna up to today?
Well, take a look at CVS is down bad.
Yeah.
But Humana is the one that would theoretically be the most impacted because that has the most senior.
Right.
And that's because they created an unbelievable senior package that is terrific to augment Medicare, which you find often when you go to the doctor, David, they do not take.
I've heard Cigna's telling all its employees, get back to the office.
Are they one of those?
By Labor Day.
So they're the 50.4%?
Or else you're...
Did you see the Boston properties?
Out.
There was a price target increase for Boston properties today.
Well, we got New York City back to 50% for the first time. That hasn't happened since the pandemic.
I think SL Green, I saw a price target boost yesterday. Can you believe that?
I can believe it. I mean, it's, these stocks of these REITs that are largely populated by office buildings that are half occupied have come down a lot.
Where are you on the idea that they're just going to tell you have to come back? Because right now, finally, there are a lot of, it's hard to get a job. So, like, why don't you, if you're Jamie, he could now go down the hall and say, hey, go try to get a job.
I think
they're laying off people.
That's the key in terms of leverage, why you have some companies saying, all right, that's it. Labor Day, everybody, back, 4 days a week. Nobody comes in on Friday, except us. But 4 days a week.
And first responders and garbage men. Yes.
Thank you. And everybody else out there doing that.
Sometimes Dave is off on assignment on Friday.
No, I just don't wear a tie. I'm here.
We'll get Kramer's Mad Dash, countdown to the opening bell. Take a look at the futures here as we kick off the open and await the Fed. Don't go away.
You could check out Plug Power. It looks like it's got some strength. The 100 days right here at 1150. I mean, it's at least got room to here to it's at least got room to 13, but I think it's already almost there. Yeah, it's got $1 left to go or so. My God, that noise is bugging me. That sound. I gotta stop hitting the thing like that. It sounds like I'm not the only one that doesn't really see any like setups or anything crazy, because there from what I'm seeing, like from what I'm a lot of the other stuff that I'm watching and like checking out, they're all saying the same thing. So just watch yourselves out there. Out, out. if them Canadians crack me up, we got out. They like dig deep into that thing. It's hilarious. If only we practice what we preach, and when we say we're short here, and then we buy here, we just swing it. Look where we would be at. We would have got. I went over this Monday, 220 to 208 right now. You know what a $12 move on CRM would get you with one contract? You're probably up about $2,000 on on 100, $200. You know what I mean? So I myself am gonna have to like watch that, because I'm telling you, it could be more. I mean, you'd have to go through and look at the options, but we called this out. We called this shit out. We said we're short up here, we're long here. You know, you can also swing trade things. So to go back and look at it, and it's kind of like, kind of hurts. You know what I mean? Kind of hurts to say, man, I could have a real nice trade right now at the close or at the open. I could be taking profits on a 3-day swing on SoFi. All right, gang. Here comes the bell. Let's get it, guys. Let's get it. Good luck today. Watch this WETG, guys. WETG. This is going to be the stock, I think, of the morning. All right. And what we say? What did we say? We were watching for Google. Unreal, man. Unreal. I need a bounce back. I need a bounce back on Google. in order to
United Health share is 445.68. 445.68, the low of the day.
wow.
About 8.5%. Again, the CEO on Tuesday mentioned
Come on.
of unnecessary surgeries. That's Uniform November Hotel.
Dude, what the fuck? What is going on right now? Dude, my stuff is like... Guys, Google. Google. Google, gang. You can try and wait for a pullback, but Google's just getting squashed. Okay? You got news with Europe trying to take them to court or do something with them. And then maybe Microsoft as well. You know, it didn't give you any idea that it was going to do this pre-market. And then kind of just off the bell, it just said, yeah, I'm going to just head to the downside. So, is there a trade there? I got to wait for the bounce. I got to wait for the bounce. That's just me. Okay, that's just me. Unbelievable. You have a small little area at 122 flat right here. Okay, that's a small resistance level. All right. So there are stocks you can be long and stocks you can be short. I think I need to have just two charts, honestly. I think I need to just have one chart up. Because I have other stuff over here to the left. Let's see here. What is this? Like, what the flip is this?
Tesla charging standard. Previously announced.
Google's down 2% off the bell. Almost. A percent and a half. And again, if I had any recommendations, it would be save your bullets. Save your bullets for later. Okay? Trade line VWAP cross to the downside on Tesla, gang. Trade line VWAP cross. Where can we take this to? It's got relative strength. You do have a gap. Yesterday's low. Alright, these are the places you're going to want to look for if you do. You're also fighting the trend. Remember that. Remember, you're fighting the trend. Okay, there is Target. There's news on Target. TGT. So, Target's gotten smacked. So keep your eye on Target, Tesla. I'm still watching Google. Yeah, Google's or Target's just. I don't know why it was so bad. You know, Target has a good thing. I don't know why they're failing. I mean, I kind of know why, but. Alright, so I'm going to go back to Tesla. Just, again, TGT, Target. There's news on Target. I feel like Tesla is you could get a few points to the short side here, guys. 38.2 fib lines right up with VWAP. You kind of want more than that, but you know, VWAP. It's hard to say because VWAP's also, you know, your initial morning. No, it's not necessarily initial morning low. Look at it reclaiming it, bouncing off of there, getting some volume. It's so weird. And then look at those candles on Tesla. Look at them candles on Tesla. That's crazy. There's a lot of things I like to ask myself during trades.
Initially moving higher, now pulling back. Sandy Michael X-ray.
This is so insane. The frustration. Unless it decides to put in like a nice double bottom or something. That would be cool too. If it sets up, bang, pulls back, still holds the low of the day and doesn't break it. And then, you know, bounces off, pulls back a little bit, boom. Catch it to the long. All right, so I got Google up here. I'm watching Google. It's not. I just don't necessarily see anything, guys. Like right off, like offhand. Let's see, where is. All right. Here we go. Look at the spies. Look at the spy or the IWM. The IWM is rejecting the top end there. We got some nice volume on the 3-minute. Let me go. I like the 1-minute. Sometimes it's got. It's so weird. It's a nice rejection. So there's Google's news right there. Not sure if they brought this out to try and pump it up a little bit. But they definitely just came out with news. With news. Look at coin. So we gotta watch, like, the IWM is pulling back, so we'll have to go see what the regionals are doing. The Qs. Okay. Now let's look at the SPY. Okay, so SPY still putting in low.
SAGL, Shell Upstream says, Shell Upstream Head says Namibia oil exploration flow tests are encouraging. That's sending out Echo Lima. EGT target making more new highs now, 132.70. Tango Golf Tango up right now more than 3% on that possible activist interest.
Nice job, bro. Nice job, bro. I'm on tilt right now. I don't know what... I don't see anything. I'm not sure what there is to trade. You know, I'm looking at this double bottom on Tesla. Looking at this double bottom, potentially support right here. If it pulls back into this area, you know, it's kind of got to see what pre-market is. What was it on? If you don't mind me asking. Nice. Yeah, I was looking at Target. I was looking at it. You know. We called it out when the news came out. This actually might be a good dip buy. Look, trade line VWAP cross to the upside. I had to pull it up on a different chart or like a different. Look at that. That's actually pretty nice. You might get some more upside there. You might get another. There might be another upside run on Target. Let's see the volume. Come on, man. I'm getting fucking irritated. Small pullback. It needs to be able to keep the volume. I gotta see how much they are. Remember, look at AI. AI had a run yesterday. I know. Remember what I said? I was thinking about shorting it. And then I was like, I want to short this thing because of the obvious reasons. And then it didn't show any signs this morning of God, my fucking mic wasn't on. I was saying that I was saying that Google didn't give me like any signs this morning that it was gonna fall out of bed, and I was wanting to short it, but look at pre-market. It kind of like it was a bit weak, but it didn't give you like you didn't see like massive candles like when it came out, like it wasn't getting volume, and then off the bell it just shit the bed with like no notice. I'm like, of course. I would look for this area right here, 123, if you wanted to get long, but I wouldn't be long up here. Maybe it's a good long for a swing trade or something. The S&Ps and stuff are still climbing. They're coming into resistance. Just keep your eyes on the Qs. There's a lot going on right now. I just can't. I just don't. I don't know. I don't know what it is. I don't know if it's just me. I have no idea. I just don't see anything that says like to short me or take something for the long. Like, I just don't see anything. I really don't. I'm trying my best to like be patient because there's going to be a trade this afternoon. But like Target, I want to watch that because it could get some follow through. It's hard to say. You have an increase in volume there. Maybe I'll go back to AI, see what it's doing, watch CRM and stuff. That would be nice if it consolidated right here for a minute. Dude, the fucking spies broke out. So here's Tesla kind of just sitting here, kind of like making up its mind on what it wants to do. Yeah, I'm gonna wait for Fed, I think. I don't know what, unless this thing starts to reject here, then maybe I'll take a break back down to initial opening candle. Right around back at this area. Again, I didn't really see anything. I don't know Other than Target, you know, I was kind of early on that, but I just didn't take it. There's Plug pulling back. I'll keep my eye on Plug. I'm gonna scan around and see if there's something I can or can't find. But so look, CRM. Look what happened, bro. Down at that level. I think we could get at some shorts starting to take profits for a long. That would have been a nice long this morning, and I was just talking about it. How funny. Let's see if Tesla can break through the high of the day, the initial morning high. We were saying, watch this small double bottom it was putting in here. Sorry about that. I thought it was. So I mean that's it in a nutshell. The market starts pulling higher. You want to stay with what's strong. You know, the market pulled back. Tesla pulled back. It's been one of the strongest stocks in the market. Look at the volume coming in. So seems easy, but you know, you just gotta. I had no. I mean, I had an idea. I kind of think that the market. I don't know. I need to pull up. I think I need to. I gotta go. I gotta go feed my cat real quick. She needs. Look at this. It's just nonstop. Just don't fight the trend. And that's the only thing I could say. Oh, cool, man. That's what's up, bro. I'm thinking about Tesla. It's up 0.8%. I mean, if it holds the high of the day, you could get a lot of people shook. you know, it just may still have some more upside. It's got to hold the high of the day though. So let me go get her fed. Like I said, I'm just saving my bullets and something will present itself. Okay, so there's all right, cool. So that kind of helps. And then what is this? The Qs are pulling back in. You see how everything pulls back in at like the same time? You know, it's why you want to watch the overall markets. I'm coming. So, I mean, you just look, if the Qs hold up and they break this, and then if the Qs break it, then you just gotta be long. You can't fight the trend, you know? Can't fight it. So, what level did we have? I think I had, see, it's different on the futures, but I think it was like right here. It was like right there. So if it comes back in, you want to watch for your break. You want to watch right here, guys. Watch for this on the Qs. If it decides to pull back in and hold, I mean, right around that area, right around here. You know, it's going to be an area. It's not an exact science. Pretty much right there. See, look at that tail. Look at the tail that just came off of that. All right. Doesn't mean that. See, you have crude and gasoline inventories coming up. Look at the break. For anybody that went long, they're guys, like I said, man, take your time. Either be like buy the pullbacks. You gotta be buying pullbacks, or just give it time for something to set up. You don't see it set up, you don't trade it. You know. What a day CRM's having off that area. Alright, she's taken care of. Watch the cues. They try to extend here. I don't know if I can pull the trigger on anything. Because you could just, it could just come right back down. We have, let's see.
Gasoline up 2.1 million versus a build of 637,000 expected. Distillates up 2.1 million versus a build of 922,000 expected. Crude is falling now on those higher than expected builds. $69.56 now, up 15 cents.
Me doing this tells me this is it's gonna reverse. Let me see. Yeah, 5 minute. Sorry, I'm just trying to get all this stuff straight. Again, save your bullets. Save your bullets. Yeah, man, rock on with that, bro. Just, they have a lot of legal shit going on right now, so. But that's cool. I mean, the overall market's going up. I'm personally, I'd be on the opposite side of that trade, you know. Catching the bounce from today and stuff. There's no problem with that. There's no problem swinging. Maybe you see something I don't. Maybe there's something there, but like swinging it's a good idea. Why? Because it's still sitting in the range. No matter what's going on, it's still sitting in the range. Bro, what the fuck? I'm just gonna flip out, I feel like. I don't know what it is. I know that there's it's like we go through times like this in the market. But like with these charts and it's just been weird the past couple days. Whether I'm not getting enough time in. So you did hold this upside right here. You never really cracked it, this line that I have up here. So yeah, I would look for this. I would look for the 125. 125.75 to 126 upside. Now, if you can't break back up above that level right here, then yeah, you might have some issues. Look at that tail. But you break this level, you break yesterday's close, and hold it, then yeah, look for some more upside. Do you see how there's that tail there on the 15-minute? Let's look at the volume. Yeah, see how it's climbing and there's a decrease in volume instead of an increase? Because usually you want to see an increase through a level of resistance. It actually might be a good short right here. I just don't want to step in front of it though. I don't want to step in front of it. Yeah, yeah, man, rock on, dude. I'm just telling you what I see. You know what I mean? I'm kind of just like, I mean, it's broken yesterday's close, so yeah, it's broken it. So let's pull it up on the 1 minute.
Two senators urge Justice Department to
So there's the break, and now we're going to see if this thing can hold it. There's the break. Look at the 90 MA. Watch that as an area of buying.
IONQ spiking here now, $11.46 on heavier volume now. IONQ. Goes up 7.5% for India, Oscar, November, Quebec.
IONQ. $11.50, $11.47 is the high. Hi, sweetheart. You're fine. I went out there and fed her. She didn't even eat it. She didn't even look at it. She said, Dad, I just want my yogurts. I just want my churros. I give her yogurt with like a little bit of her medicine in it. It's not like medicine, but it's like fish oil. And she didn't even go. I'm like, girl. So I think she's tired and she's just being like ornery. You want to go under the bed? Go ahead. Go ahead. Come on. Come on. Let's do this. Let's go. Yeah, I seen that too, bro. I was looking at that myself. I just don't know where my head's at. You know, I just know the market's like in this weird, just like uptrend. And I know I need to be buying pullbacks, but I don't know. I'm just not rushing it. I'll get one. Like, I know when I see something that's like, I can lay the hammer down on it and feel pretty good about it. And I took that small trade with the cruise lines the other day. I was kind of like, I made it quick because I had to also, the other side of me was like, man, I think these things can go higher, a tad higher. But they do have like, they did have, I don't know if they did it already, but I knew that like Carnival had like a bunch of bonds that they were going to issue to raise some money. So, and that usually, they do it every time the stock gets up around those prices. They want to raise money to do things and pretty much not necessarily dilute shares, but so IONQ, it's at 11:43. This doesn't have, I don't know if there's any news or not, but if it's got a double top in here, right here in this area. What, Turkey? Like, now she's trying to like get into everything, and she's like, she just wants to find a place to lay down. Did Target go any higher? I gotta get. She's gonna be knocking all this shit. I knew it. I knew it. That was the dip buy. That was my look. I was on here. It was either here or right here. I was gonna buy the dip right here. Further long. Why was I gonna do that? Why was I gonna do that? Well, because I had a lot of things line up in one area. And I thought that that's exactly what Target needed to break new highs. And that's exactly what happened. So I missed that trade. That's on me. It is what it is. Because I could have easily taken it. Easily have taken that trade there. Where was it? Was it on the 1 minute or 2 minute? Yeah, 38.2 Fibonacci. Or 38.2 and VWAP were there. This was the buying right here. Yeah, it was at 10 o'clock. I wanted that pullback. And I never took it. Google's at a new high. Good stuff. So, like, stuff like this, though, is like Target's going to see if it can break it. What the fuck, man? You guys are going to go. You guys might experience days like this, too. Like, where it's just like, I don't know if it's just because I haven't been able to spend enough time to go through charts and, like, you know, kind of like hone in. And it's only Wednesday. It's only Wednesday. We do have 3 more days left. Today's Fed day. Yep, there's the break and hold of yesterday's close, so. But look, you don't have an increase in volume, so just keep an eye on it. Hi, babies. I don't know if you guys can hear her purr or not. Hello. You okay? Yeah, I was thinking about Oracle too. I was thinking about that too. Yeah, it was. It was. It's because they said that, or the CEO said that they and it's up at all-time highs now. They said that they had like strong demand for their cloud and stuff like that. Look, so you see how, hold on. ML UNH down 7% again today. Um but yeah, I guess, yeah, their earnings was they beat across the board. And you had, wow, yeah, look at that. That's crazy, bro. They're buying the dip. It's up at all-time highs. It's one of the only stocks that I like, one of the few, I should say, that's put in new highs this year. No. Look at that thing straight up. That's relative strength, brother. That's relative strength. That's where you want to be on days like... See, the volume is so low, though. It's steady, but it's low. Go ahead, baby. Go ahead, Turkey. Go jump over there. She doesn't know what she wants to do. She gets like this. She's tired, and she doesn't want to go lay down. She's trying to find a place to lay down, and she tries to lay on the keyboard. She tries to lay on me. She can lay on me, that's fine, but... she just... And then she gets, like, grouchy. She's so funny. You're so funny. Yeah. Let me wipe your eyes. Yeah, come here. Let me wipe your eyes. She said, no, Dad. No, wipe my eyes. I'm irritated. Come here. Let me wipe your eyes. It's okay. It's okay. Daddy just want to wipe your eyes. She's being a little... I gotta get in the zone, and I'm gonna come up. I'm gonna show you guys some. I'm gonna transfer over some pictures, or like some charts of Fed Day, so you can kind of get an idea. So we've never really had a Fed Day that's been this like bullish and thinking they're gonna pause. This is a first. So there may not be a chart for this. I was thinking that last night too. Abby, you're killing me. She's knocking all this shit off my desk. All this change. I gotta get it off there anyway. OSTK. Overstock. Look at Overstock. Everything's just running today, guys. Everything's running. She's just slamming her tail around. She's mad. What are you mad for? Huh? It's like I think she does this shit on purpose. She's so funny. You hear her? Like now her tail's going even harder. She's just laying here next to me on the desk and just slamming her tail down. Girlfriend. What? Yo, I wish you guys could see this. This shit cracks me up. She cracks me up. It's everything. And you can just throw a dart at anything and everything and it should be running. Should be. Except Amazon. Of course, except Amazon. What's going to be even funnier, I hope to God, I wish that Powell would just give us a rate hike. I wish he would. I really do. I really wish he would. This one, so it broke through 108. 108 was a big level for Nike. I played Nike a few times, like through its earnings. Like, it's got a pretty big level here. Let's see. That's crazy. That's a huge candle. That's a huge candle for Nike. Okay, so it was 115 was the level. Yup, looks like it's on its way back to 115. So that's a good stock. You're going to start seeing money managers like this day. Keep an eye on, like, write this down. Like, write down Nike and, like, write down Oracle or, like, and, like, Overstock. Like, you'll start seeing these stocks because they're going to start taking profit from all these technology names like Nvidia, Microsoft, Apple. They're not going to sell it all, but at least like where they were heavyweight tech, they're going to start going into like Nike, consumer discretionary stuff. All right. And you could see these like, you could see these things have a really nice rally, and that's why you're seeing the candle that it's putting in today. Because you're gonna start to see a rotation. I want to see what Boeing's doing. Let me put this level in real quick. But wow, unbelievable! Great job. If you guys got this, great call out. If you guys were able to capitalize off of this, great job. Now you gotta watch. There's your 200 day. Yeah, I feel. Let me see. It should pull back if it that's this is what I mean. Like you might just get this rally in the morning and then we just pull back and kind of like flirt with like pre-market levels. But we'll see because again, like we don't know what the Fed talked about yesterday. They could have said, "Hey, let's do a rate hike." I think we're okay to do one. We'll do one more and we'll just get it out of the way. If something happens, we'll pause. But I guess because prices haven't gone up or haven't been going up, they've just stayed the same. They think that that's enough. I don't think it is. And I just selfishly want them to bring. I just want a recession to come. I don't want this bear market to leave. It brings so much opportunity, and it's selfish of me, but. Alright, so there's the Qs are pulling back. And you said Google pulled back too. I figured Google was going just to fill that gap up there. That was my thoughts. That Google was going up to fill the gap and whatnot. What's Tesla doing? So there goes Tesla. Tesla couldn't hold.
All right, Rivian will call activity now. The July 17.5 calls are going to be a picture in November.
Why do I feel like Rivian's gonna take off again? Like AI and stuff. So I have the 2-minute candle. I just gotta relax because I feel like let's see, so we held
FIVE 5 below, naming a new CFO, Foxtrot India Victor Echo, FIVE.
take like the lunchtime and stuff, and I'm gonna like go through my charts and I'm clearing all this shit out. You know, a lot of it's there for a reason, but I just think I can get rid of it now. And watch, Powell comes out and gives us a rate hike, and then the market's like, oh shit. Even then, even if we were to get a rate hike, I don't even think we get past 400, 495. I don't think we go any lower than that, unless something else happens. It's 11. Maybe that's why we rallied like we did this morning. Look at that. You're pretty much at like 100% chance that they're going to pause. 99% chance they're going to pause. I need something with a catalyst or something to get. WETG. IVA. Yeah, man. Sounds good, buddy. Looks like Baba wants to curl up. Watch AMD. AMD's right at the level where it might start going itself. Just be careful. You gotta watch your, you want on stuff like this with Nvidia breaking out and AMD potentially following behind it. You gotta watch. Like you gotta watch your level 2. You want to see your time in sales in your level 2 and see, like, you want to see some big orders coming. There was a 1,000, but there was 1,000 sales order there, but there was like a 13. Look, 4,000 share, sell, 3,000 sell, share, or 3,000. There is another 3,000. It's 2 and then 1. Right at this level, man. If it starts breaking it. It's going so quick. There it goes. See? Oh my god, I didn't have the fucking mic on the whole time. You gotta be kidding me. Do you see how... if you were looking at my mouse, I literally ran and described it to you just through the time in sales on level 2. Really through the time in sales. You seen there was a right here at like 126.93 to 126.95. There was 3,000 sell share orders going through, and then it broke. It sped up like quick as hell, and then bang, they just ripped it to the upside, and you just seen a bunch of buy in there. You know, you gotta know those things so you can react. You know, so you can react and catch it. You know. Look at it speeding up. It's still going, guys. It's still going. It's not over with. Look, 3,000 sell share. Where was that? It's going so... The tape is going so fast. Another 3,000. Where is it? Where was that 3,000 sell at? I know, I just seen it. I don't know. It's probably... I'm not going to go look for it. But I wanted to see where it was at. And watch your bid and ask also. 127.35. Look at the jump to 46. 49. So see if we get back to 127.49. We're at 36. See what happens if we get back to 49 cents. if it gets back. It should start to work its way back up that way. Doesn't have to. Alright, so 26 is on the low end, and then 49 is up on the high end. Okay, 23, 22. Oh, you know what? This is a beautiful pattern here. This is a beautiful pattern. Beautiful pattern. It's one of my favorites. Look at this. And then we're going to break on out. Break on through to the other side. Break on through to the other side. Let's see. Maybe it should be right around here, because that was the high of the of today. It wasn't pre-market. This was open, like, you know, during market hours. Let's see what we have there. Nah, not really anything. Not really much. Look at the SPY. The SPY's broken out. 438 now, gang. Do you see what I mean by how I said you're going to turn around? You're going to look back a week or two ago, or a week or two from now, and you're going to be at 445, 450, and you're going to be like, what the fuck? How did I not get long? How did I not get long? Because you didn't buy the pullbacks, and you were telling yourself you were waiting for a pullback, but every time it pulled back, you were scared to get long because you thought it was going to pull back. This is the psychology of the market. You know, and just knowing that, it makes everything a lot easier. So, I want to see if we start getting some big orders coming back in here on the buy side or sell side back down here to take AMD higher. I mean, this technically could be a longer pennant towards the afternoon, but we will see. This is just crazy. This is just crazy. Let's see it start speeding up there. 29 cents, 30 cents on the ask. See what happens if we can get back up to 49 cents. Starting to work its way back up there. 49 cents is the level it broke down from. 127.49. There's a 3,000 sell share order. 3,100. Look at it speeding up. This run is insane by Nvidia. This run is insane.
In today's session, and a new 33-year high. Apollo's Torsten Flock out with a note pointing out that international investors have become a big part of that rally, now owning about 30% of Japanese equities, which is just higher than the holdings of Japanese households and trusts. We continue to beat this drum because it continues to move higher, and now the market is up almost 30% year to date. A surprise darling on the back of a number of factors, but overall comes down to the animal spirits there within companies and the fact that it's the only major economy that has been easing and not tightening. The Japanese yen has been weak, and that certainly helps corporate profitability. And they've got a new Bank of Japan governor that seems very much on board with still trying to get inflation, even though they've had more inflation than usual.
The old joke around the street is about Mrs. Watanabe and how she's spending her cash. But you're right, the foreign buyer story is totally different. Although, you know what? Nikkei's up 28 for the year. German DAX, record high. NASDAQ, best first half since the early 90s. S&P, obviously 52 week high at least. So it's not like it's operating in a vacuum over
No, it's true. It's a good point that the global market has shown real signs of strength. The only warning I would give you comes from Matt Maley, who's looking at the technicals. The RSI chart weekly, most overbought it's been in 10 years. And after that's happened, you've seen some pretty sharp declines in the last 4 times. However, he says the longer-term outlook for Japan is quite good, so correction could be sort of less bearish this time around. But just keep in mind, this has been a hot market.
yeah, as we are 8 points away from S&P 4400. Let's get a news update this morning with Contessa Brewer. Hi, Contessa.
Hi there, Carl. At least 78 people have died after a large fishing boat carrying migrants capsized and sank in southern Greece. Search and rescue teams are scouring the water for survivors now, but they don't really know how many passengers are missing. Authorities believe the boat came from eastern Libya and was heading for Italy. The Italian Coast Guard first alerted Greek authorities about the approaching vessel yesterday. UPS delivery workers may get air conditioning. As UPS workers consider a strike, union leaders in the shipping company announced a tentative deal to add air conditioning to those iconic brown trucks. They also agreed to supply new heat shields and additional fans. UPS faces a July 31st deadline to agree to a new 5-year contract covering some 340,000 workers who are threatening to walk off the job. The last portrait by Austrian symbolist painter Gustav Klimt will go up for auction in London June 27th. The painting, called Lady with a Fan, last sold in 1994 for $11.6 million. Chump change compared to the current estimates. The experts think it could now fetch $80 million this time around. That would make it the most expensive painting ever sold in Europe. And if you're saving your $80 million to invest in, I don't know, treasuries, you can also think of Lady with a Fan by the Grateful Dead. I think it's less than a cup of coffee when you stream it on your phone.
Yeah, a lot cheaper. That's funny. I mean, what a distinction. Most expensive painting ever sold in Europe. Thank you, Contessa. Right. Contessa Brewer. The new CEA chair, Jared Bernstein, coming up next. It's his first interview since being confirmed by the Senate last night. We're live from the White House right after the break.
Plus, June is Pride Month, and CNBC is celebrating all month long and sharing stories of corporate leaders with you. Here's Folks Health CEO Liana Guzman.
I often get asked, why do LGBTQIA people need different health care? And the reality is that our lives are completely different by virtue of who we are and who we love. You know, we are more likely to suffer from heart disease and mental and behavioral health needs. When we build our families, it is a completely different experience. And so I think in a world where people like to think that maybe things are more equitable, and we've certainly come a long way, the reality is our experiences are still very different. So I would invite folks that are not members of the community to really elevate the voices of those who are and to listen when we tell you why it is different and we have different needs.
You know, it's kind of upsetting when we had that drawn out right there. We had that drawn out. It's all good. Let's see here.
Couple hours into trading, bulls definitely have 4,400 in their sights. Let's get post to post with Bob Bassani. Hey, Bob.
2-1 advancing the declining stocks. A terrific
2-1.
report. New high on the S&P. We are getting a modest broadening out of the market. Like to see a little bit more. I know we're obsessed with Nvidia as a super momentum stock. Tesla, super momentum. Apple, really big momentum. There's a dozen or so really.
Did he say volume or advanced?
Tremendous momentum ever since the jobs report. I just want to emphasize some of them because we don't pay a lot of attention sometimes to a stock like IBM, which we think is kind of staid and boring. You know, IBM was 128 a week and a half, 2 weeks ago. Look at it, 138 right now. That's a big move up for IBM. That's very, very strong momentum for a stock like that. That's not what we call a big beta stock. You look at some of the other names that are out there. American Express. This is one of the stars of the Dow in the last few weeks. It was 156, 57. Look at this, 176. Again, not a huge high beta stock. It doesn't move a lot. The S&P moves up. It usually moves closer to the S&P. That's $20 for a $156 stock. That's a nice move as well. Caterpillar's another one. We complained a lot about Caterpillar a few months ago, but ever since, again, look at that 247. Caterpillar was $208 a few weeks ago. It's kind of hard to believe, but I've been highlighting some of these really big, powerful global industrials, PACCAR, Parker Hannifin, Ingersoll Rand, for example, Rockwell Automation, Eaton, all that have been up 15, 20%, but that's even more. That's north of 20% in the last few weeks. So the bottom line, Sarah, is the jobs report kind of changed the dynamics of everything. That's when we started seeing some of these big, broader names, not just semiconductor names, starting to move up rather dramatically. Sarah, back to you.
Yeah, sort of soft landing scenario re-entered the market psychology. Thank you, Bob. Bob Pisani. The Senate narrowly confirming President Biden's choice for chief economist. Vote 50 to 49 after opposition from the entire Republican bloc and West Virginia Democrat Joe Manchin. Jared Bernstein previously served as an economic advisor to President Biden when he was VP, of course, during the Obama administration, also held the positions in the Clinton administration. Longtime advisor to the president. Joining us now first on CNBC, the Council of Economic Advisors Chairman Jared Bernstein. Chair Bernstein, welcome. Good to see you.
Thank you. That's nice to hear.
First time you're being addressed on television, so we should get.
I was gonna say I've seen that guy before.
Were you surprised at that?
Well, I don't really pay that much attention to the internal politics. I've got to stick with the economics. What I will say is, as part of the confirmation process, I spent a lot of time up on Capitol Hill in the Senate talking to members from both sides of the aisle. We were very careful to make sure we did that. And putting the politics aside, which I'm just not the right person to speak to, I had great conversations with everybody. I had really good conversations with a number of the Republican members on issues that I look forward to working together with them now that I'm confirmed.
So what are those? What is on your to-do list?
Well, implementing the president's agenda is obviously first and foremost. I mean, we're talking about an Invest in America agenda where we know that private sector companies, some of whom you were just talking about, many of whom are doing quite well, are investing hundreds of billions of dollars in domestic production. That's something that's very important to this president. Close to 800,000 manufacturing jobs since he took office. Now, what's so special about that sector? Well, historically, it's been a sector where average compensation has been above average, but it's also the case that that is helpful in terms of our productivity, our innovation. And if you look at the legislation we've passed, I think that there are many, I know for a fact, there are many members of Congress on both sides of the aisle who are very interested in making sure that's implemented. And to be frank, some of that's implemented in their state. They want to see that too.
You're also entering the office, Chair, I should say, Bernstein, at a time where the economic headwinds are piling up.
I'm so sorry for that fucking sound, but every time I try and put a ticker in it, like if I do one too many or something, it goes off. I said it yesterday. UUP, TLT, GLD, HYG were the things you want to watch during the meeting. Okay, they're gonna allow you to put on hedges and all that good stuff. Look at the volume today on the 3-minute. Oh, never mind. It's pretty. I thought it was. I must have been looking at pre-market or something. Look at all this green. It's actually pretty low. HYG, which is high grade, where I like to think of it as
wage gain beat inflation, so that was a real gain on monthly. It was a real gain year over year, slight, 0.2%, but nominal wages were up 4.2, inflation was up 4.
GLD.
That's a year over year real wage gain, and we've got some analysis coming out soon showing the connection between aggregate compensation.
Looks like it's getting ready to sell off.
Wages on consumer spending, and that relationship remains very strong. It's a correlation that's been powering this economy forward. By the way, excess savings has also played a role there. Now, some of that's burning off, but some of that's still there.
It's burning off, and there's also these new student loan headwinds that Bruce Richards mentioned at the top of the hour, and economists are trying to crunch the numbers because now that we're going to
Medical devices, Medtronic, 4%. I mean, it's like everything is green, other than healthcare. Like this is it from that news.
A lot of those numbers, and it definitely sounds a lot when you start talking about something like $5 billion a month with the restart, and you just mentioned 15. I mean, if you look at an economy, if you look at consumer spending on a monthly basis, it's obviously in the trillions, and so those magnitudes are too small a headwind to really slam on the brakes. What they will do is actually something important, and we've seen this in some of the GDP reports. Back, I think it was in March of last year, President Biden wrote an op-ed where he said some kind of remarkable things that have been somewhat underappreciated. He talked about how important it was for the economy to actually downshift so that we could ease into a transition that was more steady, stable growth. And if you grow below trend, the mechanics or sort of the hydraulics of the way the economy works is that if you grow below trend, some of that misalignment between supply and demand in the labor market becomes realigned more favorably. And I think we've seen some of that. We've seen vacancies come down some. We've seen quit rates come in some. And that actually helps. So the idea is to maintain growth. If it's below trend, that's actually not a bad thing in terms of the sort of realignment we're looking for.
Chair Bernstein, it's Carl. I see the IIF this morning says the U.S. will avoid recession in 23. They see inflation coming down to 3.1. You mentioned PPI. I just wonder, I mean, to the extent that corporates try to keep their pricing intact
and benefit on that margin on the backside of the cycle. I mean, will there be pressure from the White House for them to stop doing that, to have that producer inflation pipeline feed down to the consumer?
I kind of think that that's happening anyway. I mean, if you look at, there's been some margin compression. If you look at the deceleration, the slower growth of inflation, at least in headline terms, it's really been pretty significant. I mean, as you well know, in May, inflation came down almost a percentage point in terms of the CPI headline. And of course, PPI, I believe that the monthly number's been negative 3 out of the past 4 months. So we're not just talking about a monthly blip here. We have a trend as your friend kind of moment. I think that when it comes to corporate margins, one of the key variables here, and I don't think it gets enough attention, is the extent to which consumers respond to prices. So if the price elasticity of demand is very, very flat, of course companies are just going to keep raising prices without suffering any demand destruction. But as consumers, and we're seeing some of this on the lower end, begin to respond to higher prices, that's going to help probably in the inflation outlook going forward. By the way, a key point there when we're talking about lower income people is that they're the ones who've benefited the most from the tight labor market, and their paychecks have really made a big difference to them.
Really quickly, do you see the fallout have mostly subsided after the 3 bank failures that we got a few months ago, or are you wary that we might see some more pain in the banking system, especially in regional banks and the tightening of credit?
Yeah, I think that's an important question. I mean, I'm sort of paid to worry about everything, and so I do. Those headwinds have obviously been somewhat contained, and we're going to watch that very closely. Treasury, we know, is watching that as well. Thus far, the numbers I see suggest that the actions that were taken on that fateful weekend were quite impactful, probably even more so than I expected. But that's an area to continue looking at closely.
Jared Bernstein, Chairman of the Council of Economic Advisors, thank you very much for taking the time.
Meantime, the CEO of Global Payments is after the break. His first interview since taking over that job on June 1st. We'll get his unique perspective on the health of the consumer, not predicting a significant downturn.
Plus, we're watching Tesla again, lower for the first time in 14 sessions, opening for trade at 186 on May 25th. It's now above $255 per share. Stay with us.
Welcome back. As we head into summer, a lot of questions swirling about the state of consumer spending. Our next guest just took over one of the biggest names in payments. And as he looks ahead to the next few months, he's not seeing any signs of a severe downturn ahead. Joining us here at Post 9 and his CNBC exclusive is Global Payments CEO Cameron Brady, his first interview in the new role. It's great to have you. Thanks for coming in.
Thank you so much for having me today.
So we've been trying to get updates almost every day, it seems like, on the consumer and at what point there is a crack. And I mean, are we seeing the beginnings of one or not?
We're not seeing any of that in our data thus far. I would think the consumer by and large is hanging in probably better than I even would have anticipated as we started the year. Certainly there could be a slowdown as we get a little further into the back half of 2023, but I would say our data right now is very strong around the consumer and the trends remain pretty consistent. So my own view is obviously there's a lot of concern in the market around inflation and Fed action, and we'll hear more about that later this afternoon. But with the labor market where it is, the consumer's feeling pretty comfortable. And obviously that's good for our business and it's good for the economy overall.
So it is that dynamic of knowing that your paycheck is durable means it's not about excess savings or what's getting drawn down or anything like that.
I think that's a big part of it. And I think that's why we've seen the consumer hang in probably better than I think many people would have anticipated.
Some analysts that we talked to before were wondering about the leadership transition, saying that Jeff Sloan, the prior CEO, left somewhat abruptly, sold his stock. Should they worry about that? Is that a concern? Can you just take us through why the board made this call now?
Sure. I think we've been talking about this internally for some time. So it may have been more of a surprise to the street, but it certainly wasn't a surprise internally because this is something we've been planning for, frankly, for years. And Jeff and I have been working to transition me into this role over many months now. I think the reality is running large public companies for a decade like Jeff did, it takes a large toll on you. And these are stressful, strenuous jobs and they're exhausting. And I think we had recently completed a number of transactions in our business really to simplify Global Payments as a go-forward matter. We also acquired another payments business that's very complementary to what we do. All those transactions closed in Q1. We're now in a more normal environment. So I think the board and Jeff felt like this was a good time to make that transition.
Well, one of those acquisitions related to the B2B business, and there are a lot of questions about what that is looking like from here.
Yeah, I think B2B is really the next frontier for payments. And of course, many people would say it has been for some time, but I really do think we are on the precipice of seeing significant growth in B2B, particularly the digitization of B2B payments. Obviously, as we move forward post-pandemic, businesses are looking for ways to drive more efficiency in their businesses. And AP automation, AR automation, digitizing payments across businesses for wholesale goods and services, I think is one of those areas that they're really focused on. So B2B is a huge addressable market. It's probably 3 to 4 times the size of the consumer market. It's highly fragmented and underpenetrated. So from our perspective, it's a fantastic growth opportunity for Global Payments.
Where does the U.S. stand in terms of the ladder of innovating the fastest on that front?
I think the U.S. really is taking a leading role in innovating around digitization of payments more broadly. So I think we're seeing trends across both consumer payments and business payments, particularly post-pandemic, we're seeing accelerated trends around the digitization of payments. And clearly a lot of what we're doing in the U.S. is designed to make it easier, less costly to move money across businesses and from businesses to consumers.
Talk about the competition and what's happening with your market share, because I do feel like there's been a knock against you for losing share, and that's why the valuation has come under pressure.
Yeah, look, this is a competitive business, and it always has been, and it always will be. I would say I'm actually more bullish the competitive environment now than I have been in some time. We're coming off of a period of, basically no cost of capital, and when capital is free, everything's a good idea. And when capital's free, companies tend to focus more on growth at any cost versus having to balance growth and profitability and running businesses for long-term value creation. So as I look at the competitive landscape today, I'm actually more confident with where we stand in a more rational capital environment. I think we're poised to continue to grow and gain share as we have been over a long period of time. This whole idea that we're losing share in the market, I think, is completely wrong. And we've been gaining share in the areas of the market where we choose to compete. And I think we've done a terrific job of that as a company for many, many years.
Well, congratulations on the gig.
Thank you.
And we hope you'll come back.
I certainly will.
Regular updates.
Thanks for having me.
Thanks. Cameron Brady, good to have you.
After the break, American pension funds and their underexposure to VC. Some new reporting on how foreign dollars are getting in the way. Stay with us.
Time for today's Tech Check with Deirdre Bosa. And Dee, you've been following this story this week, American pension funds and their underexposure to VC, which they're trying to change.
Yeah, Carl, so we've been digging into this issue. Why have American pension funds and thus ordinary American investors missed out on the most lucrative part of tech investing? Well, it turns out that it doesn't just have to do with poor allocation decisions, but with disclosure laws right here in California. It means that sensitive private company financials and venture capital fund returns could be made public if they take investment from CalPERS or CalSTRS, the two largest pension funds in the country. So instead, they went elsewhere. They looked for funding from less transparent, less regulated places, hedge funds, and international money. They're the ones who have built up and profited from the American startup and venture ecosystem of the last decade, while the average American has sat on the sidelines. Take the Saudi Sovereign Wealth Fund. Long before it was trying to move into American golf, it was in American tech. It has poured tens of billions of dollars into startups like Uber and into VC funds, from SoftBank's Vision Funds to Andreessen Horowitz, some of the most prolific VC investors. In contrast, CalPERS, in a review, called their underexposure to startups a mistake and a, quote, lost decade of returns. The CIO of CalSTRS, the country's second largest pension fund, Chris Ailman, he put it this way to me.
It's very unique to California pensions, not just PERS and STRS, but even the counties. We have to disclose a lot of information about our private equity portfolio. And frankly, in Silicon Valley, they love to be private. They don't want to talk to anybody. So, maybe we're sort of the Rodney Dangerfield of the country club. They like other people more than they like us.
So they, meaning the VCs and private startups, and Rodney Dangerfield, of course, as in the character that in Caddyshack that was shunned by the richer country club members. Now, the disclosure laws that have led to this dynamic, they were put in place way back in 2005. It was criticized at the time by VCs for the potential to reveal investment strategies and sensitive data about their portfolio companies. But it turns out those companies, those VCs, they just went to the Saudis and others instead, and they continue to do so in 2023 as other sources of funding dry up, guys.
It's pretty remarkable. I mean, Ailman's always candid about this kind of stuff, Dee, but it does show you how, at least on a global basis, the U.S. kind of got shown up here.
Yeah, I mean, we barely scratched the surface here. There's the Saudi PIF, right, that's now moving into golf, but it's been in tech for a decade in some of the most lucrative funds and companies. But it's also Chinese tech companies, the Alibabas, the Tencent of the world, that have been really profiting from American innovation. And Chris Ailman, the CIO of CalSTRS, he said this yesterday. It's ironic because they sit right here, right next to Silicon Valley, and it's the Americans themselves, Californians, who have missed out on this very lucrative area of investment of tech.
Yeah, it's sort of ironic in that way. Deirdre, thank you. Deirdre Bosa. Wall Street is buzzing about Beyonce and why the artist may be partly to blame for higher inflation in Sweden. Of course, we are tackling that story for you right after the break.
inflation and not just PPI today. It's happening around the world too as countries deal with rising food, energy, and housing prices, and some particularly interesting data showing up out of Sweden last month, where core inflation surprised to the upside, rose 8.2%, more than expected. And now some economists, cited by Bloomberg this morning, blaming Beyonce for the miss because more than 80,000 fans flooded Stockholm for her world tour premiere. That may have driven an increase in hotel prices, which rose 3.3% month over month. It was an outlier. And now the Riksbank is probably going to have to hike rates in
Beyonce.
June. Thanks, Beyonce. Taylor Swift driving RevPAR with her tour. I mean, it's kind of the golden era with Beyonce and Swift on tour at the same time. Adele in Vegas, amazing, speaks to what consumers want right now, and it's costing a fortune and actually influencing.
Although I assume you would want to fold in soccer, F1, any kind of big live event that moves a local economy. Right?
And they're all packed, and they're getting such high prices for all of these events. And this is the part of the services economy that central bankers are focused on right now because it has been stubbornly high in the face of decline in, say, goods spending, because we already bought enough stuff at Home Depot and Best Buy during the pandemic. One thing that Fed Chair Powell, I mean, not necessarily he'll be focused on Beyonce and Taylor Swift, but services inflation, the expectation as he pauses, signals a hike coming in July.
Yeah, we're going to need a new index that's services, ex-housing, ex-airfare, and ex-Beyonce.
Yeah, exactly. Beyonce and Taylor Swift.
Yeah, Taylor Swift.
I still think Swift is a bigger economic driver than Beyonce. No offense, I love Beyonce.
Couple hours away from that decision, and the presser, of course, and historically, we'll see, equities have struggled post-presser this year. Let's get to the judge.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of the rally on this decision day for the Fed. The investment committee debating where your money might go from here no matter what happens in a couple of hours. Joining me for the hour, Stephanie Link, Joe Terranova, Carrie Firestone. Let's check the markets. Careful how you look at it today, too. You do have new 52-week highs today for the S&P 500 and the NASDAQ. That Dow decline right there is basically all due to United Health. So take that with a grain of salt. And we're going to talk more about that later. However, Stephanie Link, does anything about this rally hang in the balance today with this Fed decision? We think we know what the decision's going to be. We're not necessarily sure we know what comes after that, though.
No, I mean, look, I think we're all expecting a hawkish pause, right? And I think the inflation numbers from yesterday and today really give me confidence, give all of us confidence that they are going to pause. How hawkish are they going to be? That's
you mean
the biggest
hawkish
question.
pause is they pause now, but then they signal they may go in July.
They may go in July or hint. I think no matter what, they're going to talk about being data dependent. So we're all going to continue to be data dependent. So we're not going to really have answers about July.
But if they leave us believing that it was a hawkish pause, does that upset the rally?
No, I don't think so, because I think that's what we're pricing in right now. So if they're even a little bit more dovish, I think the market can go to the upside. And I think what's interesting, Scott, we've been talking about the broadening of the market, right, for the last couple of weeks. It's not healthy to have 10 companies, 10 stocks account for 90% of the returns year to date. So the broadening is very positive. Why are we seeing a broadening? It's a couple of things. We got through the debt ceiling. We got through the bank crisis. We now are getting through inflation. Inflation's not perfect. It's still high. The Fed's still going to be focusing on that, but it's coming down quite substantially, and that is good news. And so as we kind of get through some of these things and we check mark these things, I think that's the reason why people are willing to look outside. And it's not just cyclicals. It's not technology versus cyclicals. It's like technology can cooperate and continue to do well, but it could be also other parts of growth that can participate, right? Could also be small caps. It could be international, which is what we're seeing. So I think that's more healthy, and I hope it will continue.
Joe?
So I think the most challenged position to have, in particular after today's Fed meeting, is those that bought money market funds. I think if you are sitting in a money market fund after today, you have a real problem, because how are you now going to time your way back into the market? The Federal Reserve, for the better part of the last year, was behind. They were basically jogging when the market was running, the bond market was running. So therefore, they had to sprint. And it's reflected in the real Fed funds rate. Look at the real Fed funds rate, which is the Fed funds rate minus the inflation rate. This is now the second consecutive month that's in positive territory. 1 year ago, that was minus 600 basis points. So the Federal Reserve, they didn't have to go from jog to a run. They had to go from a jog to a sprint. So even if they were to raise 25 basis points at some point in the future, I don't see that as problematic for the recovery that we have had.
Yeah, why do you think people are going to pull their money out of money market funds if we get a hawkish pause? Why would they do that? I don't see that at all.
Those, first of all, if you're sitting in a money market fund relative to equities, you're massively underperforming. Now on the other side of that is fixed income. If we've seen the high for yields, if you have peak yields, peak monetary policy, what'll happen is credit conditions will improve, the soft landings coming back into play, high yield and investment grade, you're ultimately going to get a better return, and those money market yields are going to begin to deteriorate as we move forward.
Yeah,
because
but not if, Kerry, the Fed makes you think that they're going to keep rates where they are for a long time. They may be done hiking.
Yeah.
That doesn't mean they're cutting. They may be sitting.
Right, exactly. And that would, we expect that's what's going to happen. And I don't think the Fed is going to be particularly hawkish. And I believe that the rally does depend somewhat on the tone of hawkishness versus dovishness that we hear from the Fed. Because if we notice what's happened over the last month, we've seen some broadening of the market. Look at small caps. There's a chart we put together. It shows that small caps are up more than the S&P. Now, I understand that the mega cap, 7 are up tremendously, but there's been a move, it's 8% roughly versus 5-ish for the S&P over the last month. And that's because investors believe that the Fed's done for now. I mean, done, I think, for the rest of the year.
Well, look, because once you stop, I don't really care what they say. You can make the argument that once you stop, it's awfully hard to restart.
Sure is.
Yeah, exactly. And I think that what the market has been building up to is to let other parts of the S&P and the broader market catch up with these mega caps and start to see some participation. If it's 2% for the overall market and, it's three sectors, consumer discretionary, communication services, and technology that are up 35% on average this year. And the rest of the market is not.
I think
anything.
they can start and stop, Scott. I do. I don't think
it just makes it a little harder, sort of, once you stop. You would have done 10, okay, to this point. And if you say you're now going to not do one and you've had inflation data pretty good, it may be harder to just restart.
Right. My
again.
point being, like, they could stop and then restart if the data gets bad, right? If the inflation data starts to turn and go higher.
Yeah,
I think that gives them cover. I mean, this is a challenging time for the Fed. They were behind the curve on both sides. So I don't know if they want to get it wrong 3 times.
On the notion of, what parts of the market can do well, Kerry's chart was pretty telling, Joe. And Chris Harvey over at Wells Fargo says, we believe the rotation into mid and small caps that started earlier this month has legs. So this broadening of the rally, which has made the rally feel better and look more healthy to people, may have some legs, according to him, and maybe according to Kerry. Do you agree?
I do agree with that, and I think a lot of the reasoning goes back to my initial comments, where credit conditions are ultimately going to improve. The expectation that we would see significant defaults in credit, I don't think that's going to be the ultimate reality. And I think when you're thinking about this Fed policy and the effect on the select equity size classes, small, mid, and large, the real challenge for small and mid is if we were to go back to the days of the 50 and 75 basis points, and we're not going back to that.
That'd be tough.
And we're not going back to that. And I think you realize that the Fed has finally caught up to the bond market, caught up to inflation, and that's a good thing for small, a good thing for mid, because last year was all about 50 and let's go to 75 4 consecutive times. That was the challenge that small and mid have.
It's like you could make the argument, though, that the bond market's the one that caught up to the Fed, not the Fed catching up to the bond market. The bond market was the one that was out of alignment with the Fed more than the Fed out of alignment with the bond market. So, maybe they've come to, a bit of a closer view there.
I think the regional banking stress contributed to that.
So the other idea is whether you think the bulls are really in control of the market after coming back 20% from the bottom, this alleged new bull market. Wolf's Rob Ginsburg, man, have I been wrong? He said, tough month to be a bear. And they've been bearish. I mean, Wolf has been almost, I think, gosh, I don't know, for the last year, it feels like, and I might be wrong, and if I am, I apologize for that, but they've been bearish for a while, and every snippet of every note virtually that we've put in our show from them has been negative. They say we're firmly overbought. When you have strong momentum tailwind, though, these conditions can persist and become even more extreme. So, you know, even the bears are saying, I don't know, this might have legs.
They've been wrong for a year, and earnings have held up. We've talked about that. The economy has held up. It's stronger than expected. The Atlanta Fed GDP now at 2.2%. No one was thinking of that. And I actually think you probably could surprise to the upside, right? Inflation is coming down. That's good for companies and corporate profits as well. So I think the momentum in earnings can get better.
I thought higher inflation was better for corporate earnings.
Well, I think no, I would say higher inflation is bad for input costs. That's what I'm talking about. Input costs come down, and you still have some pricing power. Maybe not as much as when inflation was really booming, but I do think that you'll see better margins, or margins at least that will hold up. And so if you have an economy that holds up, and that helps the top line, and then you have this input cost coming down, you also have a dollar that's not out of control and a big headwind. It's not the tailwind it was a couple of months ago. You add it all up, and I think, yeah, you can make a case to continue to be bullish. And then as we're talking about the broadening, that makes me feel better. I don't know about you guys, but I don't think when you have 10 stocks that account for 90% of the returns,
up 73% this year.
That's troublesome, right? And so many other stocks are either flat or down, right? So I think that there's a lot of opportunity.
About that opportunity, do we think tech has run its course for a bit, or no? Market action would suggest the answer to that is no.
Yeah, it's hard to say. I mean, what we're experiencing,
How's
no,
it hard to say?
it looks like tech can continue to go higher. It doesn't have to go up at the rate that it's been advancing. I mean, it's been ridiculous. No, don't take away ridiculous. It's been great. But it's
because you own a lot of them.
Yeah, but it's been extreme, and so one would expect that if the market broadens, the money's going to come from somewhere. So some of it, I think, will come from some of the mega caps, even as other people buy.
Think so?
Oh, they can
Why
continue to go up.
Maybe it would come from cash. Maybe it would come from Joe's money market.
Check out Manu, guys. Manchester United. It's going pretty heavy to the upside.
Tesla up 13 days in a row.
Yeah.
Well,
13. Nvidia closed yesterday above $1 trillion in market cap. Wedbush, as Dan Ives said, can tech go higher? Yes. As the AI revolution takes hold and the Fed waves the white flag, says this is 95, not 99.
Yeah,
Don't be confused.
I think you need to think about technology in terms of where we're going to be at the end of the year, not so much where we're going to be in the next 90 days, because understand, within the next 90 days, when you study the historical statistics, this has the highest probability to be a flat or negative quarter, July through September. So we sit here on June 14th. If you were to tell me the market's in the same place on September 14th, I'll raise my hand and I'll say, I'll absolutely take that, because we never really got a significant correction. So you think about where we're going to be 6 months from now. Without question, all the evidence is suggesting leadership is back. It is in technology, and that is something that for the very first time since the pandemic is going to remain in place through the end of the year. The problem for most money managers is that they are turning a battleship, and battleships turn very, very slowly, and they are not able to turn fast enough into the technology trade. And I think that's why a lot of people are frustrated right now.
So there's no indication that Wall Street thinks that these stocks are not going to continue to go up. I mean, Meta, Piper Sandler today raises the price target to 310. They reiterated outperform. Wolf raises Meta's price target carry to 330. I feel like we have an opportunity for a good conversation here. It's maybe your largest overweight position, or certainly one of them, whereas Steph's been trimming that stock recently. So it's a tale of two perspectives on the same stock that's done real well. What's your take first?
So I understand why anyone trims a stock that's had the kind of move that Meta has had. So it's not as if we're not going to trim it at some point. The peak of the stock was about 380. The company is in better shape, in our opinion, than it was when it was at its peak, because it did not recognize at the time some of the factors that are playing in the market. It didn't understand that the metaverse was not where all their attention ought to be. They didn't understand that they had too many employees, that they had too many people in different directions that were not efficient. So cost cutting has been a factor. The focus on the businesses that are good businesses, and how to monetize Instagram and WhatsApp are more important to Meta and the management of the company. And it's not an expensive stock. It still trades at a market multiple. We think it has room. But if it were to get back to its all-time high, then I would think for sure we would consider.
I mean, as the stock went up, it became 8% of my portfolio.
Yeah,
and so that's a lot, right? So I'm just trying to control risk a little bit. But at the same time, you have to admit, Carrie, that a year ago, this stock was trading at 11 times forward estimates.
Yes.
Okay, granted, they were depressed earnings. I got it.
Yeah, no,
and it was a cost-cutting story, not a revenue growth story, which it is now. But it's now trading at 21 times. It was trading at 7 times EBITDA. It's now trading at 18 times EBITDA. So to me, that's a big re-rating. And I think a lot of good news, not all of the good news, because I still own a big chunk of it, but I think a lot of the good news is actually in the stock. I mean, no one was talking about the revenue side of the equation all year long, only until about a month and a half ago. And then all of a sudden, like the light turned on, and all of these things started to click for Meta, right? It was Reels, and it's click for message or click to message.
Well, let me just ask you this.
8% is a lot. 8% is also a lot. We don't have 8%.
The danger in thinking that all of the, in your words, good news is in the stock, conventional wisdom would tell you yes, but AI is the most unconventional of transformational things that we're talking about now.
Right.
So how do you know how to value something like that as to what it really means, to whether you know it's in the stock or not? Because what we thought was in NVIDIA was obviously not, based on the guidance that they gave.
Well, I just think up 120% on the year to date is a lot. So there's a lot of good news in there.
The numbers don't tell the whole story all the time.
Well, possibly. And I know the ad revenues, digital ads are actually on the rise. They were up 4% last quarter, year over year. I mean, prior to that, the prior 3 or 4 quarters, it was negative and there was no visibility in sight. So I'll give you that maybe not all of it is in the stock, but I think a lot of it is in the stock. But I still own a 5% position. So it's not like
I get the nervousness of saying, well, the stock's up 100 and some odd percent. I'd be crazy not to take some off the table. But I'm just suggesting we're throwing out the idea of the danger in that is we just don't know what the capabilities of AI are going to be in terms of earnings power for most of these companies. We just don't know. We're relying on what they're telling us. In some cases, nobody knows until you hear from the company. Analysts can't model it, obviously, or they would have known what NVIDIA was going to drop.
No, and then I mentioned digital ad. I mean, AI is really certainly helping them in getting that back to growth. So it's certainly helping. Where does it get to? Does it get back to double digits? It's entirely possible, especially against easy comparisons. But again, I think it's prudent to take profits. Nothing's really wrong with ever taking profits. And so I still participate. I'm still a believer. But no one was a believer a year ago. I was getting hit every single day. You and I were. We were getting hit every single day because we owned it. So now I'm willing to just sell a little.
Okay, that's cool. Let's bring in our headliner, Professor Jeremy Siegel of the Wharton School, Professor Emeritus at the Wharton School, Senior Economist at Wisdom Tree, of course. Professor, welcome back. We're talking about who's a believer and who's not a believer. Are you a believer in this rally? Or I see a headline that you said somewhere that the stock rally is going to end soon. Is that what you think?
Well, NVIDIA, which is a great company, I think is selling for 123 times earnings. NASDAQ is selling for 30.
Well, it's like 50 times.
S&P
for like 50
20.
times
Let
forward
me
earnings.
finish. The S&P, okay, a little less. S&P
A little
20, which is, by the way, where I think S&P should be at 20. And the small and mid caps are at 14 and 15. You know, if you're a long-term investor, you know, you got to take that into account. If you're a short-term investor, you got to take momentum into account. And, you know, being one of the older people, I think, that you interview, but I think most of the people on your panel, we've lived through the 90s and the internet, and it went much further in terms of dispersion of growth and value back then than it has now at this point. So, yeah, the dispersion is high, but can it get higher? Absolutely. Is the momentum there? Yeah, there are probably more momentum players now than there have been, you know, 20 years ago, although there have always been momentum players. So, you know, in terms of, you know, whether you're a long-term investor and, you know, the small and mid-cap, they begin to stir a little bit. Momentum is still with those high tech. And if there's any signs of recession, Last week people asked me what was the most important thing I was looking at, and I said, I think the CPI and PPI are going to come in nice. The Fed is going to pause very hawkishly, by the way. They may actually be, I think the dot plot's going to be startling to people because I think a number of them are going to raise their rate projections. But actually, I'm looking at tomorrow's jobless claims because that was a little bit of a shocker last Thursday, and that's the first indicator you might see of softness. Now, again, it's a volatile short-run indicator. But my feeling is what's going to be driving the Fed for the remainder of the year is going to be the real side and the labor market more than the inflation. Inflation is going to calm down. The inflation is basically over. Now, I think I have a chart. I think you guys have helped me prepare that. I don't know if you can show you. Yeah, that the blue, so that is core service inflation over the last year. The blue is shelter, which is the biggest single component. Now, that's because the Fed uses extremely lagged and I have to say faulty data on housing. We know home prices are down. There was an article in Wall Street Journal today about year over year, housing rates are zero or negative. But because of the lag way, that blue line is dominating. If you take the blue line out of that, you get core service inflation at 2% or less, which is exactly the Fed's goal. So, I mean, in essence, they have slew the inflation. It is basically gone. There's the residual. There's the data problem. They should stop completely. I think they should have stopped before.
Right.
And I'm worried about whether they stop soon enough, but we will see on that issue.
I'm still confused, though, as to whether you think, Professor, that this rally is about to run out of gas or not.
It doesn't look like it's going to run out of gas. Even with, there may be a little sell-off today at 2 o'clock when we see the dot plot. People say, oh, my God, the Fed is going to get higher. And he's going to take a very hawkish. He's going to say we're going to pause. But he's going to take a hawkish position. And, we know the last 6 sessions, we've sold off 200 or 300 points on the last hour of trading on the day that he's come in. So if you want to look very short run, I wouldn't be surprised to see the same thing happening today. Is it enough to slightly derail the tech move? Usually one strike is not enough. It usually resurges again and continues on. There needs to be more of them, and we haven't had more of them yet. So I can see the tech moving ahead and the spread widening in the short run.
The further tech runs, does it make you more nervous or not?
Yeah, it means it's more vulnerable to negative news in the future. And if some tech company that's doing so well, gets a report, oh my God, the competition is tough. Oh, they're not paying for the AI chips as I had hoped to. Are they finding the savings? What's happening to consumer? Those cumulatives cause the correction. It's just that you never know when that might come. Momentum is there for the momentum players right now.
You still think we're going to have a recession?
I think that there's a 50% probability that we're going to have one. I think it's going to be mild. And I don't think it's going to cause profits to go down more than maybe 5 or 10%. And by the way, I think small and mid cap are positioned for. I mean, when you're selling in value stock, when you're selling 14, 15 times earnings, you're saying, you know what? I'm worried about a slowness in the economy. Now, the big tech stocks are not worried about the slowness in the economy because they think they're priced for the mega trends and they're looking over that. But the small and mid cap people are saying, listen, I'm not going to touch those until we can get through that. It gives you bargains. They may go a little bit lower if we get that recession, but not much more than 5%. And then I still think 2024 looks good.
You think the tech is fairly valued here or overvalued?
Right now, I would say it is slightly overvalued from a long-term perspective. If you take a look at how tech is valued relative to the other stocks, that doesn't mean, again, that it won't continue to rise in the short run. And let's be honest. We compare with the past, but we are seeing changes in the economy, and you have to admit it. with AI and others that may be different than the past, enough to keep this story going for an awfully long time. But let me remind everyone, and we all know that, we live in a competitive world. If you really want to be a super growth stock for a long time, you got to build a moat around you that no one can compete. Just because a particular good is growing faster and the demand is there, if you can't charge a premium for it, you're not going to get a premium valuation. So the question is there a moat? You know, that's the famous Warren Buffett words, a moat around it, which is going to make it harder for anybody to attack NVIDIA's chips or any of the other stocks that are moving so rapidly today.
If you think there's a 50-50 chance at a recession still, would you urge people to buy, deep cyclical stocks, industrials, things like that? You like those here, even as you think
because they're selling at 14, 15 times earnings. So if they go down to 12, 13, 14, another 5 or 6%, I think that is foolish to try to time that. I think once you get out of the dip that we might have, because I think the Fed has gone too far, I think you have a really nice valuation and appreciation story later. And I'd rather people be in then than try to time any sort of recession right now. That's a fool's errand. I think almost everyone on the panel will agree that it's almost impossible to do. Get into the cheaper stocks now, and I think you're going to be rewarded in the future.
That's a good place to leave it. Good last word. Professor, always appreciate your time. Thank you so much. That's Professor Jeremy Siegel down at the Wharton School. He agrees. Professor Link and Professor Siegel sound pretty similar.
Yeah, absolutely. I mean, I totally agree. If we go into a recession, the cyclicals are going to get hurt for sure. But I do think they are already so incredibly cheap, so incredibly under-owned, and their balance sheets are much, much better versus the last cycle. So I thought his comments were interesting about 2024 and how excited he is about it. That implies he thinks earnings are going to really snap back.
Well, I mean, they're priced to snap back. They better.
There are parts of the market that are pricing it, and there are parts that aren't. We just talked about the cyclicals aren't pricing it, but the technology stocks certainly are.
Yeah.
So
I mean, earnings projections in general are, projected to rebound pretty substantially.
About 11% for sure. So, but that's good. That's good news.
Yeah.
That's good news for stocks.
Of course. All right. Well, still ahead. Our chart of the day. It's United Health. It is the worst performing stock in the Dow today, accounting for nearly every bit of that triple-digit loss for the Dow. That's the worst day in roughly 3 years for UNH. 2 of our committee members own it. We'll get their strategy on it next.
we're back. Let's check our chart of the day. It's sort of obvious by now what it is. There it is, 7% United Health. So, Carrie, you go first.
Great.
Okay?
Yeah.
You go first.
Go back. So obviously we're disappointed, but I think this is an overreaction. Okay, why is it an overreaction? Because this is about news that they're spending more money, that it costs more to have discretionary surgeries that people have postponed for 3.5 years. Well, of course it costs more, but guess what else is going on? A lot of the hospitals are supply constrained. They can't really do all of these surgeries that people would like to have done, and so that slows the rate of growth in expenses. I'm not saying they're not going to be higher, but insurance providers can reprice every year. So if the costs are going up, UNH has a chance to raise their prices. They also own Optum, and Optum has many surgical centers and outpatient facilities, and if there's more revenue going to surgeries, they will participate in that. But of course, it's not great to have, you know, one of the stocks that you really like in healthcare be down 7%, but it's
I know,
been
but it's not just one day, though. I mean, not that it's been down 7% other days. It's just this stock has not worked this year. Now,
Yeah,
it was
healthcare
like the
hasn't
best
either.
one. Well, I know, but
Yeah.
I think this was the best stock in the Dow last year.
Yeah.
Certainly one of them.
So defensive stocks worked last year, and they're not working this year. We have a portfolio that has many, many growth stocks, and you can't have just growth stocks that are high octane. You have to have a combination. This is a name that has been working over time. We believe it's still going to have the type of growth that makes it attractive to most institutional investors and a lot of individual investors. And so, you know, sometimes you have things that come into play because of economic conditions. And, you know, we think this will work itself out.
Joe?
I don't disagree with anything that Carrie's saying fundamentally. Here's the problem.
Okay.
The problem is we all have different strategies on the show, and I'm observing fundamentals, but I'm also observing the technical formation. So I have a problem today with UNH. I have a problem today with Humana, which is down 13%. I have a problem today with Elevance, which is down 7%. In the most recent rebalance, what did we add? We added Intuitive Surgical and ResMed, which are working based on your thesis today. Okay, great. Congratulations, but that's not enough. So what am I left with? What I'm left with is broken momentum.
You're left
And
with
you
left with a rebalance.
You cannot question, okay? You cannot dispute that you have broken momentum in a large majority of healthcare stocks. The fundamentals of these companies are fine, but the momentum is actually negative. Now, I can't do anything about it because I don't have the ability to speed up time. At the end of July, we'll see what happens. But I think observing overall, and the professor mentioned momentum before, okay? Look at momentum in the market. There's actually in the cyclical strategy negative momentum in healthcare, in energy, and financials. Industrials actually are maintaining positive momentum. So I'm not wildly optimistic about this cyclical story, and healthcare and the names that I own right now, unfortunately, they play to that, and I'm more concerned about the what, not the why.
Your strategy is kind of tough to execute in some regards on a consistent basis. If
Momentum changes.
momentum in this space has dissipated, disappeared, right? It has. So, like in tech, when tech lost all of its momentum, you did your rebalance. Then tech regains its momentum. The stocks end up 30% by the time you're able to do your rebalance.
You don't realize that you're lobbing me a softball. Let me answer that.
The problem too is that these stocks out of favor in healthcare, you never know where momentum's going to go. And by the time you're able to make a move on it, it may be, quote unquote, too late.
Not true. Not true at all. Okay, so
very nimble.
Not true at all. So Steph and I talked about this before the show. The moves that were made at the end of April were up 50% on NVIDIA. We're up 25% on Adobe. We're up 25% on Netflix. We're up 10% on Apple. We made the moves that needed to be made were made. Now, let's go back to your initial thoughts on healthcare itself. In 2022, it's the reason why, and I say this all the time, I'm on CNBC, so what do I have to outperform? The S&P, the NASDAQ, the Russell, the Dow, the quality factor and momentum, and maybe some overseas indexes. Because I sit on CNBC, I get it. The benchmark is momentum. We outperformed in 2022, the S&P in momentum. Why? because of the healthcare names like UNH. So now the strategy is telling me, okay, it's time to move to the sidelines. And what eventually happens is momentum, which has not been present in the market since the pandemic, eventually will evolve into a trend. And I want to be there for the evolution of that trend. I'll go back and we'll use Meta, for example. You could look at two things with Meta. You could look at the September high at 384, or you could, the September of 2021 high at 384, or you could look at the low from last year at $88. What do you see? Fundamentally, if someone looks at the market, they say, okay, eventually it's going to get to 384, but it probably needs to pull back first. When you look at momentum and you look at technicals, what you see is the stock is at 273, and the highest probability states that 6 months from now, that stock will move more towards 384 than it will to correct.
Very well explained.
Thank you. Appreciate the opportunity.
I'm glad to give it to you. Contessa Brewer has the headlines. Hi, Contessa.
Hi there, Scott. Here's our CNBC News update. Prosecutors coming out hard against a movie weapons expert who allegedly loaded a gun with a live bullet that resulted in the death of a cinematographer on set. Prosecutors accuse Hannah Gutierrez-Red of likely being hungover when she loaded the prop, and they say witnesses will testify that she drank heavily and smoked marijuana in the evenings during the filming of Rust. The weapons expert has filed a motion to drop her involuntary manslaughter charge. A Mississippi police officer has been suspended without pay for shooting an 11-year-old boy last month. The child had called for help during a domestic disturbance. The boy survived after Sergeant Greg Capers shot him in the chest, but the child was treated for a collapsed lung and broken ribs. The 11-year-old's family is demanding the officer be fired. The U.S. House passed a bill keeping the federal government from banning gas stoves, despite the Biden administration's insistence it doesn't have any plans to do that. This is a response to dozens of cities that have moved to ban new buildings from using gas appliances as a way to combat greenhouse gas emissions. Scott, not only that, but then there's all the new research that indicates maybe there's an effect on your indoor air quality as well.
Yep. All right, Contessa, thank you.
Sure.
That's Contessa Brewer. Coming up, a Wall Street shopping spree. Analysts turning more bullish on retail today. That sector tries for its best weekly win since January. Best weekly winning streak since January. We're going to break down the biggest moves in our calls of the day next.
All right, guys, girls, ladies and gentlemen, 15-minute or hour and 15 minutes. I'm getting the countdown, so I'm going to get my SPY. What was strong today? NVIDIA. What was Meta doing? Like things like that. Like what was weak? See what was weak, what was strong. Okay, put yourself on the side of strength and weakness. You know, when need be. as far as like we get a big upside move. Let's see here. So yeah, I'm gonna go over the SPY. I'm gonna go over like the daily. I'm gonna go get all my levels in. I just don't know if there's like what there is to price in with the pause. What if we get a 25? Like again, these this asset this stock market going up like it has been is asset prices. So not that they care about it, you know, but in a sense it helps create and how could I say this? Like I say, I think Powell and Cruz should still just do 25 basis points, but they've never done it. Like when you're reading is where it's at as far as the Fed Watch tool. Ever since Powell's been in office, they've never came out with a surprise.
What about TJX? Matthew Boss, JPM. He's the #1 retail analyst. He says TJX is best positioned to capture trade down demand. Overweight, $96 is the price target.
Yeah, they definitely will benefit from trade down. They'll also benefit from a recovery in new home sales, which actually are at highs that not seen since last March because they have a home goods and home sense. And they also benefit from all the excess inventory that's in the system. I think they can do 2 to 3% comps over the long term. I think gross margins have upside due to freight costs coming down. So I still like it. Not cheap, but I still like it for the long term.
Joe, Matt Boss also puts Dollar General on the focus list as a growth idea. He had removed it in January, so it's back. Target 187, overweights the rating.
Smart man to have removed it. Now putting it back on, I hope he's right. It's something that is one of the 7 consumer staple names that is in the JOTI ETF, and it is the worst performing consumer staple name in the JOTI ETF. Costco is the best performing one. So this is a company that has had significant challenges, both fundamentally and technically. Kudos to Matt for removing it initially. I hope he's right from here.
How long has it been in the JOTI?
It's been in the JOTI since last year.
Since last year, okay. All right, it's down 33.5% year to date. Stay tuned.
It's going to take a while. It's going to take a while. It's an investment. It's an investment cycle year.
I can't help myself.
I couldn't help myself either.
Tough chart.
Can't help myself. All right, straight ahead. We'll get you through the.
Wow, look at Dollar General.
The stock is up more than 40% in the last month. Joe and Kerry both own it. They do report earnings tomorrow. But first,
Tesla, is this Tesla? It is. So it did pull back. Damn. So Tesla did give me the pullback. Would have gave me a second shot at it. Not much, but 261, 50, and then 550, 257. So not really.
Where they feel that safety in being themselves. That is what companies can do right now to make sure that people can show up as their best self.
Like, check out EEM. EEM's been going, like, it's been something I think nobody's really talked about. There was a piece on the, I think it was like Wall Street Journal or something, where their debt was getting, like, bid up, or like the interest on the debt or something was pretty big. Look at that. So I was on this chart. I just didn't, so I'll do these things, and then like I said earlier, I'll forget about them. Like, or because I won't have them written down. Where it's like an EEM, it's not. It's something that's pretty boring, but boring makes you money. So how high can she go? That's the question. I think today it's gonna really help it. If we don't get 25 and they pause, I think it might have a nice run. It's already had a nice run, but I got that CNBC in my head.
Larry Fink says AI may be the tech that brings down inflation.
All right, we're back. Said Adobe reports tomorrow. There's the stock today. It's just shy of $500 or so. Carrie,
Write that down, gang. Adobe has earnings tomorrow.
43%.
Well, it's really up in the last 3 weeks, 40%. The stock.
No, you're right. You know what? You're right. It's up. It's up. Everything is in the last month.
Right, exactly. So this is a stock that has underperformed a lot of its peers because, they're in the design and content creation business. It's digital advertising. That is not where the market has been lately. It's gotten a boost both because it's been down for so long. It's really a great company. Earnings should be up about 13%. We would expect the growth to continue over the next several quarters. They made an acquisition that the market didn't like. We understand that, but it's really a leader in its field, and now it's getting a boost because it is involved with AI to the extent that you can use AI for creation of all types, including what you can do with design. So, we believe that this deserves to go higher. We like it still here. We think the next several quarters, year plus, is going to be solid growth, and that we're behind the stock here. We continue to like it.
So
we believe it deserves to go higher.
There's
after being up 40-some-odd% in a month.
Look at the chart. Look at the longer-term chart. This has been a really poor performer relative to other software stocks and what they've done.
Well, I mean, it's blown away the IGV. This
just lately.
Yeah, but at some point, all these stocks that are up 40-some-odd%. I know why you're laughing. All these stocks that are up 40+% in a reasonably short period of time. The bar just continues to go up, and they're going to have to continue to deliver in such a big way to justify these moves, are they not?
That is what I'm going to get into later on in the live about what the issue is that could bring us down. Like, what's the catalyst that's looming that could bring us to the downside?
Money on the stock. I mean, if you look at many of these stocks, Salesforce, Meta, you pick your tech name, depending on where you bought it, you might have made 40% or you might have made 5%. And for this one, there is room to grow because the fundamentals have not been with it over the last 2 years. The Figma acquisition was a bad acquisition at the time. I think they're working it out. They're going to make it happen. But the market hated it. So we're starting to resolve that. They're integrating it. They changed the model. So there's more to go for Adobe. It's one of the top names. It is the leader in its field.
Joe?
Regulatory approval for the Figma deal still is not there, so that's called into question. They'll just buy back their stock if the deal doesn't go through. Generative AI for this company as a contributor, that's a second half story, maybe a 2024 story, not really a story for here and now. Has the stock gotten a little bit ahead of itself?
Yeah,
it probably has. But let's understand, they increased prices last year on a lot of cloud products. That seems to be sticking. Spending's been more resilient than expected. So on this one, I think this is a wait and see what's going to ultimately happen post earnings. I would not be surprised to see the stock have a significant move in either direction, which means you probably buy some straddles in the option market.
All right, we'll take a quick break, come back. Final, no, not final. Grade my trade. Jumping the gun. Grade my trades. Up next.
So let's see if we, this is a 15-minute chart. I want to see if we roll it back over. What are we doing? We're sitting on top of pre-market highs. Yeah, sitting on pre-market highs. Sorry. Yeah. Wonder if we can pull it back in. We pull in the reins a little bit. I'm trying to hold off on the Red Bull.
Complimentary flight.
Grade my trade time. All right. Stephanie Linker first from Larry. Purchased IBM at 123.50 a few weeks ago. It's now at 138.
It's a good buy. I would give it an A, but of course I own it, so I'm biased. But this is a company that doesn't get credit for the transformation that it's doing, right? AI, cloud, blockchain, data center, and increasing their software business and recurring revenue as a result, and doing a little bit better on the top line as a result. It's not just a mainframe company anymore, and it trades at 14.7 times earnings, cheap.
Carrie, Holger in Germany, Blackstone. What should we do?
Yeah, Holger, I would buy more Blackstone here. Trades for under 15 times earnings with interest rates holding steady or perhaps, remaining there for the rest of the year. PE, private equity companies do better when interest rates are steady, and we think the portfolio and the way they run it is excellent.
Excuse me. I'm having a moment. Joe, Occidental Petroleum from Mark. I'm gonna.
Sorry, I'm watching these trades.
Go ahead, please.
So I wish I could turn back time and make this 2022, because I think that's what investors think the energy market is this year, and it's not. And sentiment and positioning still reflects that type of mentality. I said before the other day, if I could sell more energy beyond the Pioneer and Devon that was sold at the end of April, I would.
So I'm kind of curious if the best bet. So let's talk about what we got going on. We got 5 minutes till 1 o'clock. What are some things nobody's talking about? The dot plot's one of them. Okay, what if they raise interest rates longer term? What if like the year end goes up to 5 3/4, 5.5 median, 6%? They're not going to have it at 6, but 5 1/4 to 5.5 is very well, like, that's in the cards. but they continue, like, instead of these cuts later next year, later in the end of the year and next year and stuff. What if they raise, like, what I'm getting at is, what if they raise these interest rates, like these targets on the dot plot are higher? What if they don't mention the balance sheet and then they do mention it? Like, there's so many different ways, and we have to see Powell's demeanor. We have to see, like, what's the Powell we're gonna get. All right, was he in the tour bus smoking the reefer, chill, relaxed, having a good old time, or is he mad? He just got off of work, dinner's not ready, and he can't find the remote. You know what I mean? So we're gonna have to gauge him when he comes out, and I'm gonna set all that up right now for you, for us, I should say. So I want you guys to think about that, because we can always reverse, guys. We can always reverse. Doesn't mean we have to rally. I mean, like Google, we start coming down. I want to be short Google. Google is a weak stock. A lot of your other names, especially an AI name, Google is technically in the AI space. They can't get out of their own way. They've just been sitting here. They're at the lower end of the range. So if they can't get going and the market does turn around, I want Google to the downside. That's one of my stocks that I'm watching.
For your free consultation.
Now it's at 97. It's been flipping back and forth.
You.
Want to remind you to check out Carrie's new Pro article on why the long-awaited recession has not arrived yet. You can read it right now at cnbc.com/pro. Please check that out. Of course, a reminder to join me at 3 o'clock Eastern on Closing Bell, right as as Fed Chair Jay Powell ends his news conference. We'll be there with Jeffrey Gundlach, the Double Line CEO, of course, for his first words, as always, on Fed Day, and we're looking very much forward to that. Hope you'll join me then. Let's do some final trades. Stephanie Link, what do you have?
Zimmer, so higher utilization rates are very good for the device industry, and the recon market is growing 14%. This company's gaining share with operating margins and gross margins expansion as well. Good valuation, 18 times.
All right, Joey?
BlackRock, it's breaking out above all of its critical moving averages. And if you think about the asset managers themselves, they've struggled to grow AUM over the last year. So a second derivative trade on an improving equities market is to own the asset managers, and BlackRock clearly the behemoth in that regard.
Okay. Carrie?
Well, if there isn't going to be a recession, people spend money, and InMode is a medical device company. It focuses on aesthetics, and there are a lot of people spending money on keeping themselves looking good. It trades at 11 times earnings, and we think a lot of upside.
All righty. So we're going to get the Fed decision in about an hour or so. Market hanging in. Dow's down, but that's because of United Health. You did have new highs today, though. There you see for the NASDAQ and the S&P, new 52-week highs there. I'll see you in a couple hours on Closing Bell. The exchanges now.
Scott, thanks, and welcome to this special Fed edition of The Exchange, coming to you live from Washington, D.C. I'm Kelly Evans. Now I can say alongside.
This is when it starts getting antsy. We got 1 hour. Let's go. Ready to make this money. Okay? You guys better be on your game.
But we've got all the angles covered, from the stock market to the bond market to the economy and how rising rates are impacting you, the consumer. Plus the view from Washington, Representative Brad Sherman and Senator Bill Haggard.
I'm going to pull it up for us, okay? You're going to have your paragraph, blah, blah, blah. Summary economic projections, but really page 2. Page 2, very first square, you're going to have at the bottom of this is your rate hike decision. You want to see this. Year end, 2023, 2024, 2025, longer run. All right. You have your gross domestic product, GDP, PCE, unemployment rate, but GDP, Fed funds. Really, Fed funds, most important thing right there. All right, then you can go through all that whenever you want. So I'm going to start working on getting that up for us.
43.80, and just to give you an idea of the trading range, we were up roughly 22 points at the highs, down 3 at the lows. So again, fairly wait and see for the.
Tell me who hype.
Up about 1/3 of 1%, 48 points higher, 13,621.
I'm fucking hype. I always get antsy. It's like nothing new, but.
Government bond prices forcing yields lower. The 5-year and 2-year note yields you can see here, for the 2-year just about 4.63%, the 5-year 3.96%, the 10-year benchmark note yield drifting a little bit lower, now below 3.8%, 3.79 the last trade there. And I mentioned the Dow and the caveat asterisk that we'll put there. The Dow, as you may recall, I just showed you, is off about 100 points right now, down 100, the only major index lower. United Health, very largely weighted Dow component there, is down huge right now, about 7.5% to the downside, $455 a share. The reason why, at a Goldman Sachs industry conference yesterday, company executives had alluded to the notion that many of the folks out there, perhaps older Americans, who deferred some of those elective surgical procedures during the COVID pandemic era, might now be playing catch and getting those procedures done. Rising surgical costs, rising healthcare costs overall could be pressuring maybe margins a little bit there. Some of the health insurers are the ones taking it the worst. Now, United Health's a big story here, because Tyler, Kelly, if it wasn't for United Health, the Dow would actually be up roughly 140 points right now. So a swing from minus 100 to plus 140 just because of UNH. Watch the health insurers. I'll send things back over to you guys.
It's one of the things that explains the importance.
You see? You see here? June 13th, 14th, okay? Go to Fed Reserve, Monetary Policy, Federal Open Market Committee. Okay? Thank you.
After today's decision, and what Jay Powell signals on that front that investors will be watching for. What comes next? Senior economics reporter Steve Leisman is just a few miles away at the Federal Reserve with the very latest. Hi,
Hi, Steve.
Hey, Tyler, yeah, the pause is expected, but we're all on the edge of our seats to see if it's characterized as a skip en route to another hike or the long-awaited end to this very aggressive rate hike cycle. A warning? I don't think the Fed knows yet, and I'll explain why. So among the questions we're trying to figure out is, does Powell say rates are now, quote, sufficiently restrictive? That would suggest, hey, no more rate hikes are needed at this point. But do officials then raise their rate and inflation forecast in that summary of economic projections suggesting more hikes could be on the way? All of that is tied into the considerable uncertainty on the economy that supports the idea for the Fed to pause, at least for now. Among the things the Fed's trying to gauge are the economic effects of the 500 basis points of hikes they've done. Tightening at banks, which have led the Fed staff to...
Like over on my other computer, I'm going over these, like all the other Fed charts that I have. And there's nothing like it because we haven't expected a pause or a stop. Like we haven't had anything. Like I can try and show you guys. Hold on. Let me see what days they are because I have the dates on them and everything. I can probably just do it right on this.
Forecast a year-end funds rate below the current level of 5 1/8. 10 are at the current rate, and 7 see more hikes. Some of those 2 or more. So it won't take much to raise that median forecast. So we're watching 3 things today. First, the possibility of dissent from among the more hawkish Fed members. Second, a potential compromise where the Fed pauses but says, hey, the economy is on a very...
Look at this inverse head and shoulders, guys. This is beautiful. This is so beautiful. I love this.
Rises, signaling support for at least one more hike this year, guys.
You know, Steve, maybe because I don't follow it as closely as you do, but it's...
Maybe because I don't follow it as closely as you do. What the heck do you mean by that? You work for CNBC, my brody.
It felt like 6 weeks, 2 months ago, a pause really wasn't the base case. Now it is. How did we get here?
I just went over last night. It really was, though. A pause was base case because of...
If you follow the tail of the tape of this intermeeting period, remember, Powell came out and told us, hey, the rates are kind of balanced. And told
Ben Bernanke, right. And then Kashkari.
come out and say, you know what? We think we ought to do more. Then Jefferson, the nominee for vice chair, comes out and does like a legal redirect. He comes out, wait a second, remember the chair a while ago said pause? Well, that's kind of where we're going right now. And so you went up, down, and up, or down, up, and down, or pause, whatever you want to say it, 3 times in the course of this intermeeting period. So yeah, and plus...
Look, it's hitting that level and bouncing right off of it.
Meeting remarkable. Is this be the first time that the Fed makes a policy decision on the come when it comes to the issue of potentially lower inflation? They have not taken the forecast at face value yet.
Oh, I'm so excited.
You know what? We have some stuff in the forecast that tells us inflation is going to come down. For example, the base effects of June coming out. So that's one of the things that the Fed is looking at. And so they're going to do this for the first time on the fly.
All right, Steve, thank you. Our Steve Leisman reporting, and we'll see you in just a moment. Meantime, Citigroup is among the few outliers, very few, still calling for a hike today, to Tyler's point. They're saying, quote, core inflation by a number of measures has been at or above 5% for 2 years. Despite markets pricing very little chance of a hike, we maintain our base case for a quarter point. But our next 2 guests disagree. They see a pause today and no hikes for the rest of this year. Joining us here in the studio is Jamie Cox, managing partner at Harris Financial Group, and Subhadra Rajappa is also with us. She's head of U.S. rate strategy at Societe Generale. Welcome to you both. Jamie, I'll just start with you and kind of react to the atmosphere out there. This is widely expected, but Citi says, hey, there's still a chance they could hike.
Well, it's an asymmetric thing for Citi. If you're right, you're a genius. If you're wrong, nobody's paying attention. So to me, absolutely.
I think they look bad. They're the only one out. No, people like to go with the group.
People do this all the time. This is something.
It's too good looking. Look at that, ladies and gentlemen. That is a reverse, or that is a head and shoulders pattern if I had ever seen one. Hot damn. Watch out. We might get that 25 today, boys and girls. Sometimes you probably shouldn't just listen to everybody around you. But they did hit on it. So they hinted at it. They didn't hint at it. They kind of like told the market. I don't know.
Because right now the economy is okay.
Well, the economic growth is good because they printed ungodly amounts of money, right? I mean, you flooded the system with money.
Through quantitative easing.
But before that, I mean, before even the pandemic, you had QE and other interest rate pauses in 2019. So basically what happened was the Fed primed the pump, and then they waited too long, and then they had to raise interest rates rather quickly. So basically they created the problem, then had to fix it. So that's why I've been critical of it, because they were too late. They let inflation get stoked and actually become more permanent and entrenched. That's the problem.
I think that's a fair point. Subhadra, let's bring you in here. What are the implications across rates and the financial markets?
Oh yeah. Oh yeah. I love this pattern. I love this pattern.
For the remainder of the year. And as far as policy goes, I think the most important thing that I heard over the last 3 weeks is from Governor Jefferson, where he said that there's about.
What's up, bro? My fault. This inverse head and shoulders. But I have CNBC on here. I just have it up. But I'm putting up. I have the Fed. So when they release their interest, like when their interest rate decision comes out, it's going to be right here. It's going to pop up. I'm going to click it, and we're going to see what's going on. And then I have to bring up the actual Fed meeting too. But this is an inverse head and shoulders here. Like, this is a pretty good looking pattern on the 3-minute. I'm on the 1-minute right now, but if I bring up the 3-minute, like I say, when I tell you you can see patterns on all time frames, you should be able to see patterns on all time frames, not just one. There's your left shoulder, head, and then shoulder, right shoulder, whatever is there, but I messed it up. But look at the neckline. Most importantly, the neckline. And then now you see you get a big candle down through the neckline. We're going to go test this. We're going to go test the opening print. I want to curl back up. Boom. Hit it. I want to reverse. Give us 25, pal. Give us 25. Look at this. Look at this pattern, man. This is a pretty clean pattern. It's a little like dented, like it's a little beat up, but the neckline's there. The neckline is there. So it's pretty no, I don't want to fucking duplicate it. The only thing I hate about these charts is like you don't have like a I need to make a like where I can draw. You know, I could like draw a line or something to like show you guys. Like that's the left shoulder, head, right shoulder. I want to curl back up. Hit this. I want to test that neckline right there. It's picking up. This is Fed Day for y'all. This is Fed Day. This is what we do on Fed Day. Now we're gonna go back. What I tell you guys last night. We're gonna go right back to break even, right where we open. We're gonna bounce around. Well, it chose to go to the upside. And then you'll notice as we get to noon, about an hour before the Fed or before the release, we go right to where we opened.
Real quickly then, would anything in bond land for you be a screaming buy right now? I mean, if you think we're heading into a slowdown, I just saw the 5-year yield is still up at 4%. Seems like a pretty good deal in the environment.
No, I completely agree with that view, Carrie. Our view has been that
It's a form of price action. Like I say, like sometimes you'll see a pattern, but it won't. Let me see. So what makes the head and shoulders so accurate? Is it because a lot of traders spot it? So I just can't see. I don't know why there's a little thing there. Okay, so they either short or long it. Pretty much. Okay, pretty much. Like everybody sees it. Everybody sees it. And I was trying to say that like today we had like some decent sell volume. Let's go to the 15-minute chart. But the thing is, patterns can take place, okay? And it's kind of computers because you have algorithms. All right, it is. How do I explain this? See, it's not on the 15-minute chart, and usually an intraday pattern will be on the 15-minute chart, but it's not. It's barely on the 5-minute. So no, it's not a head and shoulders. So I'm going to get into this. This is probably going to make people think that there's a head and shoulders here. I know people are talking about it. Alright, I see it. It's got a nice neckline. But I don't think it is. I wonder if it bounces back through it. And I just don't think it is, because usually you'll see it on 15, 5, 3, 2, 1 minute time frames if it's intraday. Not always. I don't know. Like, you should be able to see it on a 5-minute chart, and you don't. You know, this looks totally different. Looks like you kind of just, you know, it comes down. You know, it's just not as clean as if you were to say, like, pull up a 2-minute. You know, it looks a little bit better on the 2-minute. But what happens is like, this is price action, like the sellers, and you got to add all of it up with the sellers and volumes, because sometimes they shake them out. Like this pattern, if this was a clean and good pattern, like we should get, like, through this break and retest, like, and on the sell side of this side and on the sell side of here, like, you should have more sell volume than you do buying. And that's where you could get a pattern that's real ugly and it's trying to put in a pattern, but the volume's not there. Like, things, like, it's just hard to explain. It's just hard to explain. Like, see, like, this sell side of this head, like, because this is a bearish pattern. Okay, so a bearish pattern means you should look for further downside. But if you don't have the volume with it, it's probably not going to happen. You know, it's probably not there. Or it's a fake out, like, whether it's algorithms, trading desks, whatever. Now look, we're almost right back at the open where we opened. I'm going to go grab a Red Bull. I'm going to go grab a Red Bull, and I will be right back. I'm going to go bring up the Fed thing. God damn it, I should have took that short. I had a feeling it wasn't going to bounce back because it's just an ugly chart. But we're going to get things ready to go. You did have some big selling here. But, oh my god, I'm so fucking excited. I always get not the jitters, but it's like, every time there's something, like an event of some sort, it's like, it never gets old. It never gets old. No matter how many times you do it, it never gets old. Never gets old. Yeah, I'm gonna go grab something to drink. I'm looking through the pictures too right now to see if I don't know if we've had, I don't think we've had this kind of, like, price action for a Fed meeting. Where's menu, files? So you'll notice this. Now remember this, like, next time we have a Fed meeting, like, if they start, let's say next Fed meeting, they start talking about going into a, like, they start talking about doing our interest rate hike. If they don't do one today, watch how, like, we'll probably sell off, and then we'll get bought right back up into the, we'll go right back to the opening print. Come on, pal, guys, give us 25. I think they can do 25. I really do, guys. Like, for some odd reason, I think they could do 25, but what's bothering me is this. That. It went down a little bit to 94. These always change because the Fed funds rate is traded. I feel like they know that they're okay to do another rate hike. Like, if they're going to do it now. Just get it over with. Do it now, and then you can always cut rates. You can always cut. But I think Powell was talking with Bernanke the last meeting when Janet Yellen was talking about needing more money for bank liquidity and shit like that. So I'm not sure, because he doesn't want to, like, you know, they come out and they talk and do this and do that. They do it to kind of, like, give the market, like, a heads up on, like, the decisions that they make, so that the market can price it in, and then, like, the market doesn't get something that is like, they get caught off sides. They don't want the market to get caught off sides and surprise the market. So they try to let the market know ahead of time the decisions that are going to be made, what they're going to do. Kind of like these banks. The banks listened to the Fed when the Fed told them that they weren't going to, they like their plan to raise interest rates, so the banks followed it, and then came COVID, and then came a bunch of money, and then came the 0 to 5, and now you have banks that don't exist anymore because of it. So like, don't listen to a lot of shit that you see on TV and stuff like that. Like, they're going to say it's the bank's fault, this and that. Well, it's really not, though. The banks didn't decide to go from 0 to 5 just like that. The banks didn't decide to have COVID. The banks didn't decide to listen to the Federal Reserve when they were told the plan that they were going to, like, stick to, and they positioned for it, and then, the Fed felt like they were in a hurry to, like, raise these interest rate stuff. This guy is on the monetary committee for the policy. I think he's like a Senate. I don't know if he's in Senate. I'm just kind of curious. Republican chairman on. I think. All right, so yeah, give me 1 second. I'm gonna grab my Red Bull. From California.
There was no Fed then. Yes, there was no Fed then. Yeah. So nobody really knows how to run an economy during a pandemic like. Sure, somebody will write a little bit more here, a little less there. Yeah.
So many different topics we could touch on. Crypto should possibly be one of them, given the massive crackdown we've seen all of a sudden by the SEC. Is this the end of crypto in America?
Hope so, don't think so. But
you hear that? He just said, hope so, don't think so. Where's Coinbase at? Why do they hate it? You know why they hate it? Because they don't want nothing happening to the dollar. They were trying to fire Gary Gensler. They're trying to get him fired, and I don't blame them. I don't blame them.
So that the U.S. no longer has this major role in international affairs. And the definition of cryptocurrency, what does it mean? Hidden money. Who needs hidden money? Tax evaders, sanctions evaders.
Let me just try to paraphrase their defense, which might be, hey, we're actually trying to keep costs down for the average American. That the current financial system, it charges, look at the payment networks and the interchange fees they charge just for access to it. Look at the banks, which basically charge you for checking or have all sorts of hidden ways of doing that. Whether it's superior or not, their argument goes beyond just disintermediating America from the global financial system.
They've been around for a while. At one point, they were $3 trillion, and they didn't make it easier or cheaper to buy a sandwich at Subway. You go to Subway, you can use a debit card, you can use a credit card. If you've got crypto, what do? You have to change it into money, then transfer it to your debit card, and then buy a sandwich. It is not a payment system. It is not a currency. It is an attempt to make trillions of dollars by creating a currency.
Does it need to be regulated out of existence, or do you think that the market will take care of?
And you guys elect these people in office, man. This is crazy. You listening to this bum? It should not be up to him. That's the thing. It shouldn't be up to him to what he's doing right now, or what he did a little bit ago, because this is a little bit behind. What he's doing is putting his ideology on you. That is not what a representative should be doing. It shouldn't be up to him. He should be saying, well, me personally, I don't really care for it, this and that. But yes, we need regulatory things so people don't get hurt. It's here. It's here to stay. People are going to use it. Let's do what we can do. No matter whether I like it or I don't like it. Okay, that's the politician you're getting because of the U.S. dollar. Again, you should not be voting for people that put their personal ideology on you. Whether it's with you or against you, whether you're for it or not for it, that's not what they should be doing. Okay? They needed to be doing their job, and their job would be to making the United States like, a place where there's regulation for crypto. but because he doesn't think that crypto is necessary, because he doesn't like it, because of his own personal opinions, he doesn't want to have any or care. He doesn't care to have any type of regulation for it. But again, it should not be up to him. The masses want it. Just like, let's just say, LGBTQ. Okay, I live my life the way I prefer to live my life, but I don't put my feelings and the way I do things on other people. I want other people to do what they want, whatever makes them happy. Okay, as all the way to an extent as if it doesn't intrude on someone else and it causes a big issue. Okay, because I have a girlfriend / wife doesn't mean that I go and put my opinion and say everyone should have, it should be a boy and a girl. You know, like it's not up to me to decide whether or not, because I don't trade. It's not that I don't trade crypto. I don't trade crypto. Okay, but I can trade crypto through the equity market. So just because I don't trade crypto doesn't mean that whether I like it or don't like it or whatever, let's just say like I felt like him, I didn't care for it. That doesn't mean that it should be just thrown away and not given a shit about. Like, this is what the ideology, personal opinion, should not be the matter of what you go about your voting and you start implementing things that should be implemented. All right, like it's hard for me to get it out, but this is my guy, Jeffrey Gunlock. I really like him. You know, like, so this is why you don't have regulations, because you have guys like him that you guys vote for every single election, and it gets you nowhere because he doesn't care about crypto. Well, he needs to care about crypto. Look at all the people that got hurt from Sam Bankman-Fried, this and that. It's here to stay. They need to, if they're going to tax it, then they need to regulate it. Like, do you see the asinine shit that's going on here? They're okay with taking your taxes or taxing you for it if you have any type of gain or any, if you just, you know, you have access to crypto, whether you're sending it to a friend or you receive it, they want to tax you on that. But in the same sense, he's like, I don't like it. I don't think we need to do anything with it. Oh, but it's good enough to tax? Like, stop putting these people in office, please. Just, you guys have to stop and start being real. Stop letting the cop shootings, like the stories about Trump and just all this stupid shit, and really worry about what matters. Like, put a freaking realist in there, please, guys. I need you to. The world needs you to. The United States needs you to. Like, seriously, this AOC shit. There is no reason why we can't do. We have innovation to get us there, but this ridiculousness of some of the shit she was coming up with. Like, let's be real. All right, we need regulation. They don't want to regulate it, but they want to tax you on it. What? Come on, California. I know you guys can do better than that. That's really who you have in office. That just tells me a lot about you guys. And there's a lot of crypto people in California. Like, so next time, vote for an individual that the news doesn't have on, okay? Find out who's going to be the best person to be able to say, well, if the United States says that we're going to tax crypto, well, we need to regulate it. And we need to count it as either a security, a commodity, or make up a word for it. All right? Whether we just don't label it as anything, we label it as a currency, and we are going to tax it, so we're going to regulate it. You technically have to. I mean, they don't have to, but it's theft. Like, this is what I'm getting at. This is so ridiculous. It's so absurd that, like, and people let this shit happen. You guys are going to get taxed on it at the end of the year if you don't know how to hide it. But yet, in the same token, now, well, I don't give a shit to regulate it. All right, like, it's crazy. It's just crazy, man. You guys got to think about that shit. I can't wait to play this back in the next terms. Yeah, dude, I know. You always go, and it never ends. But it'll like it won't always be like Fed meetings. It'll be something else. Like we'll get to a point where Fed meetings won't even really matter. You'll watch them and stuff, but it'll be the same old song and dance where they really don't do anything and kind of just, there's no like inflation or anything to be worried about. So let's see here. So again, I'm looking at these charts. So
is what's happening overall with the bank sector. The largest banks in America, like JP Morgan, Chase, Bank of America, just fractionally up, down. Again, wait and see mode. Citigroup, 0.1% advance there. Wells Fargo flat on the session right now. But the regional banks, undersized performance here, down about 2/3 of 1% for the S&P 500 regional bank ETF, ticker KRE. So Tyler, Kelly, that is your market reset with just about a half hour to go before that big announcement. Back over to you guys.
All right, Dom, we'll see you in a little bit. Thanks very much. And coming up, a change in stock market leadership could be around the corner as...
So I'm going to repeat this, guys. So remember how I told you yesterday we're back at the opening print? I'm probably just going to go to one screen. I'm sorry. Now I kind of regret it. Now I want two screens up. Shit. Yo, guys, I have this on my... Look at this chart. Do you see this face? Do you see the face? Like, look, this is the head. Hold on. Or like, yeah, that's... Hold on, I have this. Like, this would be like the nose. Comes down, there's the mouth. There's your chin. Bro, I was just looking at this. I swear to God. Let me bust out the camera. Yo, that's insane. But it's on like a 2-day. It's on 1, 2, 3. Hold on. All right, guys. I'm gonna grab the Red Bull. I'm gonna get this up. I gotta get things going for us. Let me stress to you guys real quick, okay? If we get a ton of volatility, you do not need to position yourselves to the gill. Look at TLT ripping. This is where's my shit at? I have no moving averages. No. No. I don't know what happened. I do know what happened, actually. Okay. There we go. Look at that failed breakout on AMD. It's turning into resistance now. Level 2. I gotta hurry up. Well, I don't really have to hurry up, but I want to hurry up. Settings, appearance. That Treasury General account's gonna potentially take out $1 trillion of liquidity.
Why do they want money out of the Fed's reverse repos? It seems to be a pretty good deal for the banks, maybe too good of a deal.
Yeah, so the reverse repos are sitting on the Fed balance sheet. And so if you take the money out of reverse repos, you're not taking out of the banking sector. So you're preventing a liquidity drain on the bank reserves. And in light of bank failures, you don't want that to happen. And they're having some success doing that. But if the Fed is going to continue to raise rates, that reverse repo rate's going to go higher. And investors may want to keep
Right.
money parked in that reverse repo rate and not in the Treasury rate. Or it would force Treasury to continue to have to try and drive up those rates. So that to me is the biggest issue. It is impacting growth versus value. It's impacting the dollar. It's even impacting Bitcoin. And Treasury's had a lot of success over the last couple of days, but the real test will come in the next 3 weeks. You got 80 billion of QT. You got corporate tax collections coming in. So we expect liquidity to be drained in the second half of June and early July.
Shit, my guy. Liquidity's already getting drained. This is what I've been saying. This is what I've been saying for a while, is liquidity issues coming up. I mean, if you guys tune in, we've talked about it. I've said it every night. I've talked about liquidity every night.
Financing the U.S. government at an over 5% rate on the short end of the curve, that is going to drive up the net interest costs, which we have spoken about. And so we're just trying to find the least bad option. We're just and the least bad option.
What was that, M2 money supply?
It could work its way back over
I
time.
missed it.
But in the short run, you're in a liquidity squeeze, and it looks a lot like Y2K, where the Fed flooded liquidity into the system before Y2K happened, and then they pulled it back, and then you had the tech sell-off. And we're approaching a similar situation.
So let's go to the question of the fiscal side of things. We had the debt deal. We had agreements on what the spending cuts were going to look like. Now it feels as though through the appropriations process,
You guys can watch the dollar. If you want to play the dollar, you can play UUP, TLT, HYG, LQD. Alright, there's all kinds of ways to play this. You can play double leveraged, triple leveraged, SPXX, SPXL maybe, SP500 long term, Splunk. I haven't played. I traded Splunk before. I didn't even think. I have to go see what the triple leverage is. All right, so I'm gonna go get my Red Bull, but this should still be roughly 90. Look at it; it's just going higher and higher and higher for a pause. So if you want to know what the ETFs are, they're here. Like if you want the United States, or like you have inverse, okay, leverage, okay, SPXL. This is 3 times the S&P. So if the S&P goes up 3%, you're going to get 6. Or if it goes up 1%, you're going to get 3%. Okay? Things like that. QLD. You have DDM. And you obviously have SQQQ, TQQ, UPRO. Inverse, and these are inverses also. SPXU. There's all kinds of ways to make money in the markets. Now we can see like TLT and TMF, directional 20. TMF is TLT, but it's 3 for every percent. It goes 3%. So maybe I might want to look at this. Maybe I buy it. Maybe I just buy the stock alone. You know, so we just gotta watch, because look at this look at this pattern. That's insane. So there's all kinds of ways to play it. Oh, I'm getting excited. China FXI. So this is their large cap ETF, yen. 3 times bull, yin and yang, yin and yang. Brazil, EWZ. I'm trying to think of That's your semiconductor, shaking my head, SMH, GLD, SLV, etc., etc., etc. All right. If you don't know where this is at, oh, here you go. You can play futures also. VIX futures, that is. UVXY, VXX. All right, VIXY. That's for the VIX, volatility. There's a lot, there's a lot of them. Like pretty much for any, like Tesla, like S ST is short Tesla, I think, right? What is it? Or TSLAS? Am I right? Am I wrong? Tesla, what's short? TSL. Yeah, right here. So you have TSLL. Like Tesla, in and of itself, in and of itself, has its own whatchamacallits. So I think it. So you can look at other countries' currencies and how it affects. Like there's so many different ways to play today, guys. So I just want you guys to like keep that in mind. Okay, keep it in mind. You don't have to just play the SPY, the Qs. You can hedge yourselves. There's all kinds of ways to play. You can play currencies. You can play currencies in the equity market. You can play other countries' currencies, because if our currency is going to go up, theirs is going to go down. If ours goes down, theirs goes up. Short and sweet. I'm going to go have a Ben Mallow real quick, which is a Newport. I haven't had one all day, which is okay. I actually haven't been smoking but a few in the afternoon. So, not that I'm trying to quit, but I'll quit whenever comes the day I want to quit, I will. So I will be right back in 5 minutes, gang. Let's get ready. It's almost game time. Almost game time. I may put up 3. I might just put up 3 and get rid of this, and I'll have the Fed up. Unless it's too much.
But that trip was scrapped after the Chinese spy balloon incident. Tensions have only ramped up since then, with the two countries at odds over Taiwan, trade, and tech, to name just a few ongoing issues. Here to talk about all that and more, Senator Bill Hagerty of Tennessee, member of the Senate Banking and Foreign Relations Committee, and he's a former U.S. ambassador to Japan. Senator, great to have you with us. Why don't we start with China, because of your experience in that part of the world. Secretary Blinken going there later this week. What do you think his goals are? What do you think they should be? And are they attainable in any sense?
Well, I think the clearest thing to me is the fact that China, it was reported in the media, had demanded that the FBI not release its report on the spy balloon. And as everybody on this show recalls, they violated our sovereignty by sending a spy balloon floating over the United States, hovering over places like Oak Ridge National Lab in my state. They did it for days, and the FBI reports out. China's demanded that it not be released, and the consequence would be no meeting with Secretary Blinken. I hate to see us kowtow to the Chinese Communist Party and accommodate this. It feels to me like this is a stretch for some type of photo op diplomacy. It's not serious when we're not speaking from a position of strength. If we look at what China has done, in fact, take a look back in the previous administration. The United States Trade Representative undertook a study to see the cost to America of the intellectual property theft.
Come on. Let me see here. MACD.
Roughly $600 billion a year. That's the combined profits of the top 50 of the Fortune 500 combined. That's almost the size of the Defense Department's budget. China has been predatory in every respect, and we should be dealing with them from a position of strength, not again.
What does that look like then? What does that look like, that position of strength? We all agree that we would like to clamp down. Our colleague Eamon Javers has a document.
All right, gang, I'll be right back.
On China and industrial espionage. It is a big topic, and it has been for decades. But so what does getting tough on that look like?
We've actually seen it. I served as the ambassador to Japan in the last administration. The proximity to China is obvious. That's why we have the largest component of U.S. military stationed anywhere in the world, in Japan. It's a very tough neighborhood. China is right there. They move through the South China Sea, the East China Sea. They harass. They create a lot of challenges. When we stand tough militarily, China takes notice of that. I saw that happen in the previous administration. I saw the Chinese back out of the Senkaku Islands and back out of the South China Sea. That aggressive behavior responds to power and strength. When you saw our United States Trade Representative go over and negotiate the Phase 1 trade deal with China, that was tough talk. That was tough action. And we saw China respond. We need to continue to maintain that type of pressure. And I hear the Biden administration talking in ways that I would agree with, but I'd like to see them follow up with more action.
Do you think it's safer for us to make sure that we send a high-level official there now versus pulling that trip? And I take your point. I mean, no one wants to feel like we're in a situation where we have to agree not to release a key report like the one that you mentioned. It also comes this week, as the Wall Street Journal is reporting, there could be an eavesdropping base 90 miles off the coast of Florida in Cuba. So the timing of that and the fact that we would still go ahead with this trip, why is this trip so important, do you think?
Kelly, you're absolutely right. These are deep, deep concerns, and I don't understand why, if diplomacy was your real aim, you would be doing this right now. Frankly, if you're trying to advocate America's interest, a strong American interest, I think you would take exactly the posture that you're suggesting. You'd halt this. You would demand that the Chinese stop this behavior. The proximity of Cuba to the United States, as we know, is roughly 100 miles. And China setting up a spy station there, just wholly unacceptable. Again, the spy balloon released the report, demonstrate to the world that we're not going to kowtow to the Chinese Communist Party. That hasn't happened. So I'd like to see a little bit of a shift in our posture there.
Let's transition a little bit to the appropriations issue, which we were talking just before you came on, and we talked with our previous guest. There's action in the House. They're going to send you a bill that may cut more deeply than the original spending deal in the debt ceiling would cut certain areas. What happens when it comes to the Senate?
We're working through that process right now, Tyler. I've met with my counterpart on the committee that has to do with financial services and general government. I'm the ranking member on that subcommittee. And I just met with our ranking member, Susan Collins, on the overall appropriations committee. We're working through the process right now. Our goal has been to go back to what is known as regular order, where we actually work through each normal committee process. We have the opportunity to amend, to debate, and create input. What I don't want to see is a train wreck like we've seen in the past, where everything gets pushed off till the end. You wind up in the waning days of December passing an omnibus bill, as it's called, with everything piled together in a 4,000-page bill. Everything that we can do to avoid that, I think we're going to undertake that.
Very quickly, you had a long career in private equity in business, and you're new to the Senate. What has surprised you the most?
Well, I've been pleased in one regard with the caliber of my colleagues, both Democrat and Republican. A very, I think, intelligent group of people who I think for the most part are trying to do the very best they can. The process itself, though, and the challenges of navigating Washington are quite different from anything I've ever experienced in business. And the impact of media, not only traditional media like we're discussing here today, but also the digital media environment, very different. And I think it puts a great deal of pressure, and frankly, it introduces a lot of acrimony into the system that I wish weren't there.
All right, Senator, thank you so much for being with us.
Very good to be with you.
Senator Bill Hagerty of Tennessee, thank you so much.
Thank you so much.
Still ahead, shares of SoFi higher today after BTIG called it a long-term winner in the neobank space. Remember, about a month ago, Mizuho's Dan Dolev told us he thought SoFi bears were mathematically and intellectually off. And well, sure enough, the share price has nearly doubled since then. Both analysts also expect SoFi to get a boost from the resumption of student loan debt repayments, prompting the need for some refis. While it may be bullish for fintech, Moody's Mark Zandi warns the end of that moratorium is one of the most immediate headwinds to the economy. There he is, walking on over, striding in here to discuss it with the senator. We're back after this.
welcome back to a very special edition of The Exchange. The Fed's fight against inflation has had ripple effects across the economy and the consumer. From what you pay for your mortgage, your car, the rate on your credit card, the cost of living has gotten a lot more expensive as a result of all of these rate hikes. Now, despite that, the consumer has remained resilient. After accounting for inflation, real spending has grown at a steady pace around 2% this year. Our next guest says the prospect of a recession is off the table, but a pause in rate hikes is still the right call here. Mark Zandi is with us, chief economist at Moody's Analytics. Off the table.
Did I say that?
Did
Where'd you get that?
Did
Off
you?
the table. I mean, I think we can avoid a recession. Odds are that we'll be able to avoid it because of the consumer. I think the consumer.
All right, gang. I ain't gonna miss it. Shit, I gotta grab my Red Bull. Sorry, I had to use the bathroom and whatnot. So let's go. Let's get ready. It's game time, guys. Get ready. Game time. So we're gonna look for the summary economic projections, but we want to read the release. Okay, you have your press conference, you know, your SOMC and blah blah blah. See, there's all kinds of stuff, guys. So get ready. You're going to look for restrictive policy. I'm going to help read it over. We'll have CNBC on here. We'll let them go. But remember, this is going to be a little bit behind. So for the meeting, I'm going to take CNBC off. We'll go right to the Fed live. Okay. Let's go, gang.
I think it depends on the data. You know, between now and I guess it's late July is the next meeting, and we'll get another jobs number. We'll get a couple more inflation reports. I think it'll be a close call, close debate. You know, sitting from where I'm looking, I'd say this should be the end of the story. I'm a little confused. Why one more rate hike? I mean, in the grand scheme of things, why would that make a difference here?
That was my thought. Is why one more rate hike? Why? Like, just do it. If you're going to do it, then just do it. Or you guys are done. So if they think that if they're talking about pausing and stuff and skipping, then they're done. Okay, you're either going to do one more and give it time. Let's get it, guys. I'm so fucking ready. I'm going to need a second to read it. Okay, I'm going to read. I'm going to react. Listen, keep your risk down. Okay, you're going to get... The real move is going to be at 2:30 when Powell talks. So don't get over your skis on the release. It'll move around and it'll come back. Okay, it's going to move. I'm going to go to 2 because I can't really see the SPY. All right, it's going to move and then it's going to move and then you'll notice it'll probably come right back down to the release. We'll see if it does, unless there's a surprise in the release, whether it's the Fed balance sheet. We get information on Fed balance sheet reduction. We get insight on everything that the markets are looking for, because nobody's talking about like, all right, okay, interest rates, they're going to stop. If they stop, but what does that also doesn't mean that the market can just go up, because the balance sheet, it's so important. There's so much money on the Fed's balance sheet, which is so much liquidity. And they just had a guy come on talking about liquidity, but like it's very important. Liquidity is the financial system of it in and of itself. It's the money that exists. All right, I will probably have my thing going off too. There's going to be a lot going on. There's going to be a lot going on. But again, like if you're new, you don't know what you're doing and stuff, just wait. The real move, again, the real move is at 2:30 when Powell comes out and takes questions. The questions is what is going to move the market. You're going to get a move on the release, okay? You're going to get a move at the release, but when it like dulls out, it'll like get bought back up or it'll sell back off, and it'll go right back to the release unless there is a surprise. Unless there's a surprise.
Stand tall.
All right, welcome back to a special Fed Decision Power Lunch. I'm Tyler Matheson along with Kelly Evans here in Washington, D.C. Glad you could join us. We're just a few minutes away, of course, from the release of the Fed's decision on interest rates. Most expect a pause, i.e. no change in rates. We'll see what our panel is predicting, but first let's check on the markets. The Dow is lagging today as it has almost all day, down about 100 points. United Health, the main contributor there. S&P 500 hitting its highest level since April of 2022. The NASDAQ with another gain, now up 30% so far this year. So let's bring in our panel. Julie Beal, portfolio manager at Kane Anderson Rudnick. Michael
3 minutes, gang. 3 minutes. This is big. This could be the end. But it's not the end. It's just the end of one thing to lead to another. Look at the MACD on the 15-minute. I don't know, guys. We're going to find out here in a minute. Just give us the 25, pal, please.
Well, if you look at the current configuration of rates and what the economy is doing, it's hard to make the case that they've managed to accomplish a lot. Inflation, core inflation seems very sort of sticky around the 4 to 5% area. The economy seems to be doing just fine. Very strong job growth. And look, the stock market is up 22%. Like in my book, that is not the sign of a market that's worried about like a really vice-like grip coming from the Fed.
And you look at the regular CPI, including energy.
430 is my downside target.
Right, so I think people might be getting a bit of a head fake. It's great that
Now you're probably not going to get that today, but if there's something crazy in it, you might. Now see how crazy that this looks? This is what we were getting all of 2022. We were getting 10-point moves in a day. This whole range, 1, 2, 3 days worth, we were getting this in a day. We were getting 6 to 8 points in a day, guys. Okay?
1 minute to the Fed rate decision.
Here we go.
Give us your setup here with 2 minutes to go, quickly.
Sure, I think there's a good case. I think 60-40 that they pause, or I should say skip. Skipping me. I think skipping is different than pausing. Pausing may mean they're stopping. Skipping means we're still in the process of raising rates, but we've done.
Again, I'm going to read over this. It's going to pop up. I'm going to go over it, and we're going to watch the markets.
Inflation has come down a lot, as Greg said, but on the other hand, major components of it are not decelerating very fast. And if you compare today's data with what they were projecting back in March, the last time they put together their projections, inflation's higher than expected, unemployment's lower than expected, growth is stronger than expected. So from those perspectives, you would say their job is not done, but we're getting close.
Julie, let me ask you, as if this is a castle built on sand, as we emphasize the strength of the market, we're also approaching, the 15% post-inversion rally everyone said we should expect. So do we have this run its course and then revert to the bear market as the economy slows?
Good luck, gang.
Sector specific. I think there are already pockets of the S&P that are in a clear earnings decline, where margins have been super pressured by not just overall commodity price increases, but wages as well. And so it hasn't really rippled throughout the economy, but I think there's going to continue to be these uneven sections. So unlike most recessions where we kind of all move together in concert, I actually think they're going
There goes TLT down to the downside.
Says inflation remains elevated. Policy setting committee remains highly attentive to inflation risks. Says holding the target.
Come on! Here we go. Here's the statement. Recent indications suggest economic activity has continued to expand at a modest job rate.
Returning inflation to its 2% objective, says banking system.
there probably are more rate hikes to come. I want to see if they revise up the terminal rate forecast in the projections that they give us. There's a good chance that even if they pause here, the signal from the statement and from that those projections are that they think they have 1 or 2 more to go.
I told y'all this morning, if you seen my short, we were coming down. I told y'all. 5.6 instead of 5.5, guys. If the year end has changed to 5.6 instead of 5. So they want to raise another half a basis points. We might get 25 today. Hold on, I gotta look. I haven't looked. There's so much going on.
For at least 2 more rate hikes this year, I think this comes under the definition of a hawkish pause, maybe a very hawkish pause. FOMC statement saying it's holding the target rate steady, allowing it to assess additional information, including the cumulative effects of tightening and lags of monetary policy. I want to go through in detail here the summary of economic projections and the funds rate. Only 2 members of the committee are forecasting the rate at the current rate of 5.13%. 4 support one more hike. 9 or half of the committee.
I'm going to wait for the retest, and then I might try and grab some puts, guys. I might try and get some puts at 436.
4 percentage point higher or 4 quarter point hikes in the funds rate. The committee sees more inflation this year than it previously did. Forecasting
Actually, I might wait because, like I said, we might just sit up around here. We make the move, and then we'll come back.
Versus 4.5. And moving on, they did see better economic growth this year. Not tremendous, but 1% versus 0.4%. The statement said the economy continues to expand at a modest pace. Job gains have been robust. Unemployment has been
It's pretty weird to see TLT and SPY going down. Usually they're supposed to be inverse to an extent.
as if they will. Decision was unanimous, guys. I just say, in terms of a hawkish pause, this is for sure that with at least 2 more rate hikes forecast by the majority of the committee, and some want 3 and some want 4. And also one other thing you want to look at is if you look at the real rate forecast, the one that was the nominal funds rate minus the core PCE they forecast, they're actually even tighter still. They had been forecasting 1.7. Now they're forecasting a real rate at year end of 2%. So that's even tighter than they had.
Here's your summary of economic projections. Has changed again. Like I said, this was where you needed to see it. All right, it went from 5, remember 5 yesterday, to 5.5. So that's 2 more rate hikes.
4,400 now at the lows, down 15.50.
Jumping to 384. Let's bring in Bob Pisani, Rick Santelli, along with the rest of our panel. Rick, what are your thoughts?
You know, my thoughts are, considering how Steve presented what the Federal Reserve is not only doing now, but what they intend to do. Of course, it makes the data-dependent part of me explode. But how could the markets not see interest rates rise in the
I said it this morning, guys. Watch for downside today. Don't get lulled into these longs. Okay? I came on and I put out a short. I said the market, I think, is going to come down.
Seasonal adjustments. Okay? One of the big issues that pushed CPI into hotter territory were used car prices. First of all, Manheim used car prices are seasonally adjusted. All of our jobs numbers, for the most part, are seasonally adjusted.
5.25%.
Seasonal adjustments aren't what they are.
I'm just randomly shouting shit out. I'm sorry. I know.
Looks a lot different. And I think when you go to July 12th and you see the June CPI report, you're going to see a significant.
The Fed funds rate again is unchanged. We knew that coming in, but I'm trying to find where.
Let's think about the trim mean, the 16% trim mean put out by the Cleveland Fed. If you look at that,
I'm trying to find out their balance sheet.
Food, energy, and used car prices, what you see is on the quarter-over-quarter annualized, it's now under 3%. So I think there are a lot of reasons to be nervous if you look at more stale data and you assume that these numbers are going to perpetuate themselves. But I think the reason equities were so strong yesterday is some of the traders have looked through the numbers and are trying to look towards the next several reports. And I think the future they see is different than the past.
So there's your reverse repo right here. Agreement operation to an offering of 5% with a per counterparty limit of 160 billion per day.
Yes, but only about 25 points in the S&P. That is not a huge move. So remember last time we had a dovish hike, and this time we get a hawkish pause.
Don't just, if you went long or short, take your money. It's going to flip. It's going to flip. Now, where do we flip at? TLTs are putting in a lot of tails.
Dramatically changes the situation. What we've seen here is the S&P right now is trading at nearly 19%.
We're only
That is not only not a
down 0.4%, believe it or not. Okay?
30 points on the S&P isn't going to appreciably change that. The problem right now, and maybe this is a good pause right now, is the S&P and the markets are really pushing the limits of the soft landing story. We've moved up 5% just this month because the jobs report is so strong, the numbers are so strong, and the belief is
431 and 430 is my target. My other downside target is here at 433. 433. Let's see if we take back yesterday. You want to see if we break and close the day below yesterday. All right, then that's going to give you the direction. Where we close today, we still have to have Powell. Powell still comes on at 2:30. All right, so this is pretty bearish. I had a feeling it would be. This is like why you don't fall into sentiment. Everybody's talking about pausing, everything's Gucci, market run to the upside. No. Doesn't mean we can't still sit at 4:30 and float here for a little bit, but
Not really. I was just actually looking over the numbers here, and actually, if you take the numbers at face value, they almost sort of strengthen the soft landing story. They've got GDP growth up more this year, like I think 1% versus 0.4%. Tiny little trims to it next year and the year after that. Unemployment rate lower over the forecast horizon. So actually, if I look at the unemployment and the GDP forecast, the Fed seems more comfortable with the soft landing story. The weird thing is
now there's the face I was talking about. You see this forehead, nose, lips, chin, and then this is the chin. I've seen this chart pattern before. I'm telling you guys, it happens like that. You might get some call buying in this area here. Or you might get some buying. I don't know why I said call buying.
I think that the rate increases, as was mentioned before, are more about messaging than they are about their real financial impact.
Come on.
I think what's actually more meaningful going forward is what happens
Nope.
with the Fed balance sheet.
Nobody is talking about the balance sheet. I don't understand. I'm trying to find it, so I'm trying to like.
So I think that's really important, and what this is about.
Yeah. Good job, bro. Good job, bro. I didn't even get a chance to scalp it because I want to. I'm gonna wait for the bounce back if we get it. I'm not sure if we will though. But I mean, I know we will, but to where is the question? I was kind of hoping to hit, this level up here, the low of the day, but.
But the plotting of future rate increases was anything but unanimous.
I don't understand why they wouldn't just do it now. I don't understand. That's what's got me like. I don't understand. This is what they said they didn't want to do. Was pause, start, like pause interest rates, start interest rates, pause. Like it doesn't make any sense.
Going to have a 3 handle next month after the next inflation report. However, the Fed has to make sure that the market doesn't, or the economy and market participants don't get complacent that all is well and done. It's just going to be this super soft landing and that inflation is going to come down to their target without much trouble. And it is a soft landing. The things are better than expected, as I mentioned before the release, that they're revising up all the positive things about the economy except for inflation. But they're dealing with that, saying, look, if inflation does not come down, we're not hiking rates today, but inflation does not start coming down as we project, we will hike rates some more. And that also means that we're not cutting rates as much next year.
Steve, I'm just going to bring you back in here. If you can give us some more context. I just want to make the observation that this is a bit odd that everything in the report that Greg's describing, GDP goes up, the unemployment rate goes down, inflation goes up, and they're pausing, and yet at the same time they're telling us they're going to a 5.6% terminal rate. That seems like totally bizarre messaging to me.
Once again, like I said about Tyler in the last hour, you're confused, Kelly, because you're paying attention. That's exactly what's going on.
I like I said, guys, so what's going on is they're pricing in 2 more rate hikes, okay? But they're not doing one today. But they're pricing in 2 more. I don't get it, man. I don't understand. They're not going to give it. This is what they're doing. This is a head fake. I assure you.
On making policy on the forecast of inflation coming down, and instead I very much agree with Rick that it's ignoring certain indicators that suggest inflation is about to fall.
So we're going to get Powell at 2:30. Okay? We're going to get Powell at 2:30. That's where the real move is going to be. I'm telling you. The real move is going to be with Powell. So if you have positions on, be careful, especially if you're up. If you're up, take them. Take profit.
In the economy, I mean, really, to plunge it into recession, and it seems to me that there's a decent contingent, a hefty contingent of the committee right here that does not want to stop until they really break the back of economic growth here. And I think that's their outlook.
No, and it's not. Steve Leisman, stop. They're just saying that they're going to just because if something happens, like if CPI happens, they can't say that they didn't tell them. They're done. I'm telling you, guys are hearing it first. They're done. They're not going to do this. I don't know. I was actually looking for a reversal up here around 435. It is messaging, exactly. They're done. Right.
Considering everything, why would they pause? Because they want to be done. They just
Exactly. Exactly. This is exactly what I'm saying. They're done. They are done.
Kelly, I think Kelly raised exactly the right question. Given all the data says they should go further, why pause? Let me just read from the statement. Holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. In other words, we want to see more information. We want to see if that 5 percentage points of cumulative tightening has...
Because, listen, by year end, guys, if they were to add more interest rates, they're already going to have unemployment start to tick up by that time. So it's not happening. It's not happening. I assure you, it's not happening. They're done. They just don't want to say it.
All three of us have been through these crises before, right? You think it's over, it's not over. And I think there's a large feeling among every member of the committee that they really don't want to tighten into an incipient financial crisis, give themselves a little bit more time to make sure that's not what they're doing.
Greg, I'm sorry to interrupt, but the effect of this is to tighten financial conditions, right? So it's not like they get away with just forecasting 2 rate hikes scot-free, right? They have an effect when they forecast these 2 rate hikes, and they do that for a reason. So I just don't think it's a...
Well, now I feel better that if anybody took my advice when I sent out that short on YouTube, and I said early this morning around 7:30, I was like, I think the markets have a pullback and some downside coming today into tomorrow. If not, I'd seen it coming. I can't tell you exactly what my words were, but I said, I just looking at the charts are telling me that we have some downside coming in the near future. Not like a pullback. Well, it was either a pullback or it was just saying that we're overextended. We need to come back and retest 430.
And I think that's what they have in mind. They're terrified to say mission accomplished and see all the mistakes that were made in the 1970s. I think that's their primary concern, right? Because credibility has been an issue for these guys. So I think I'm willing to say, trust them when they say they're going to be higher for longer. This is the credibility that we've assigned to them is like 1999 high school Julie. Don't believe her, but do believe them. They're going to stay up here for a while.
Or Michael Kushma, I'll paraphrase our Mike Santoli, who's saying, kind of to Greg's point, is the hold the most important thing here? Yes, they're
Look at TLT to the upside.
The cost of getting a unanimous decision on the pause that they ultimately, or the hold that they've ultimately delivered.
I think that's true. They wanted to square the circle and get everyone on board to a policy projection going forward, and this satisfies everyone. People who didn't want to hike rates right now, they didn't get a rate hike, but for the Hawks, they didn't promise, but they forecast that they will deliver rate hikes if needed down the road. And what's important is that the economy has not. It's difficult for the Fed to use their forecast for inflation run policy, because they tried that for 15 years or so after the global financial crisis, forecasting higher inflation, and never showed up. So I think they gave up on forecasting, and this has been a theme for a while now, that they're not going to stop until see the white of the eyes of disinflation. They're going to see when inflation's down where it's supposed to be, then we stop.
Bob Pisani, final word to you.
Well, just look here what the market is doing, okay? The S&P 500 is down a little more than 30.
Look, TLT's already back up to where it closed at when the statement came out. All right. Bonds are saying, we don't believe you. You're done. So that was a chance to get long TLT down there, but I'm going to wait. I'm going to wait for Powell. So let's see if the SPY does the same thing. It's going to be hard to say because you need to watch NVIDIA. You need to watch AMD. You need to see what those stocks are doing, because the people that are up on those stocks are going, at least the institutions, they're going to sell them. They're going to take that opportunity to sell them while they're up at highs, just in case Powell comes on and says something that the markets don't want to hear. Okay. So like I say, like where's Google? Let's find out. Where's Google? This is AMD. I know that. So this could be a nice rejection for AMD if the SPY comes down, and there goes this. You gotta watch because it'll break down, it'll pull back to retest it, and then the break. I can't believe we got a 7. Isn't that crazy, guys? We haven't had a move like this in a minute. Now you had implied volatility kind of step in front of it, but this is bigger than what we've had in a while. A 7-point move, 4-point move in a few minutes. And look at Google. Look at Google. It's a weak stock. Google's been weak. As you know, it's not like it's down on its lows, but it can't move up with the rest of the market. That's telling you something. They have so much going on. So Google's back down to the low of the day. I'm gonna look and see if I can't. I'm gonna. It's hard for me to sit here and talk and pull up the paperwork and go through everything and try and make a trade with you guys, but I will be on when Powell talks, and when he comes on, I will be letting you guys know what I do decide to do. So I want to see by 218? Let's see, 220, 225. I want to see this thing try to pop back up. Pop back up a little bit for the questions, and then we should get the real move. And look, TLT is coming back down. TLT is on its way back down. All right. Shit. Again, if we continue to the downside, watch NVIDIA, watch AMD, watch your AI stocks, watch Google.
Green light.
Welcome back to Power Lunch. The Fed leaving rates unchanged, but signaling that more rate hikes could be ahead. Let's get some reaction from David Wessel, Senior Fellow in Economic Studies at the Brookings Institution. Greg Ip is also with us still. And I feel like the only one who's never worked at the Wall Street Journal here. David, let me begin with you. It is unusual, it would seem to me, to have unanimity on the overall decision, but the kind of scatter in terms of the predictions of where the terminal rate may be and how many more interest rate hikes there are likely. Have you seen a Fed like this in your recollection?
Well, first, Tyler, was that your job application for the Wall Street Journal? Would you like to put in a good word?
I'm happy where I am.
That's pretty unusual. I think that often it's said that the argument at an FOMC meeting is not about what happens at the current meeting where the signal has been sent, but what's going to happen at the next meeting. So it must have been that enough people were comfortable with the chair and the vice chair designate's call for us to skip a meeting. Everybody agreed to that, but they don't all agree on where we go from here.
Guys, I need somebody to help me understand. Why don't they just do it now? Because they're done. If they're not doing another. The whole point of pausing is to give them time. They've done a whole lot in a year. There's no reason to continue. They're just putting it on the table to say it's here if we need to use it. So, but I want to find what's going on with their uncertainty risk projections of the Federal Reserve Fund rate. I want to know where their whatchamacallit's at. Okay. I'm going to read this implementation note. Again, if you guys don't know where it's at, just go to the Fed site, go to home, go to news and events, Press releases, Fed Reserve FOMC meeting. Federal Open Market Committee is what that stands for. Let's see if we start trying to go back up to the upside for the next 10 minutes for Powell. I need a retest of something. I might pull up futures and see where my retest is going to be for a short entry.
I think the equal weighted S&P is actually kind of flat for the year, right? So it's basically
10 stocks
it's like
that
10
are
stocks,
90%
right? It's like
of the
Nvidia
return.
and then a bunch of other stuff, right? So, I mean, if you're a stock analyst strategist, you say, this market's not carried away. It's just like 8 stocks. To which the Fed's response is, well, yeah, well, Nvidia's worth $1 trillion, okay? And like Intel's only worth like 1/10 of that. So I care about the fact that there's $1 trillion of stock market wealth out there that's having an effect on people's propensities to spend, you know? They can't wish away the fact that almost all the contraction in equity values that happen.
This is a key level. If we close under it, you know, we wicked it. We wicked it, but...
And the multiple for the market undeniably high. Go ahead, David.
I think, look, the real thing they're looking at is that the pace of the economy remains surprisingly strong. The job market is strong. Vacancies have come down, but not a lot. And inflation is coming down, but painfully slowly. So that's a recipe for we need to do more. And I think that's what the message they sent today.
Do they land the plane? Do they land the plane smoothly, David? In other words, avoid a recession. It is a tough one to do.
You know, it's kind of funny. All these recession forecasts keep getting pushed out. First was going to be the first quarter. I still think we're going to have a recession because I think they will do what it takes to get the unemployment rate up to the forecast level. But I agree that there's a better chance than I used to think of a soft landing. I think the thing to watch for in the press conference is if we can tell where Jay Powell is in this spectrum. Is he in the raised rates twice?
Again, this is my target right here. I want to get to 429, 430. Ultimately, whether it's by the end of the week, whatever. This is our first level to contend with is 431. But that's just crazy. This is literally 1 point, 2 points.
Powell often has a habit of like whichever direction the statement goes, he tends to dial it back in the presser. So like my sort of, non-specific prediction would be that it's probably a little less hawkish.
He's going to sound a little more dovish than
the statement did,
Why does he do that? You're so right, by the way, Greg. It feels like we have one sense of things at 2:05 and another one at 2:45 every time.
It's probably just that when you talk for an hour, you're going to give it more nuance.
If we can't hold 433, 898, 431, here we come. There's nothing here to stop us from falling. So 431 and then 429, 430.
And the chair can choose to emphasize or not emphasize those conflicting factors.
All right. Thanks, Greg. Thanks, David. Appreciate it.
You're welcome.
Just a couple minutes away from that press conference. We'll hear from Fed Chair Jay Powell himself. He usually speaks for about an hour, taking us inside the decision, the Fed's forecast. He'll explain the projections and maybe how they're looking at the stock market. We'll take you there live as soon as it begins. And there's more of this CNBC special, The Fed Decision, after this break.
I love how I've seen this face because I've seen this before. Like there's your like forehead hair or whatever. Yeah, I know it might be hard to see it, but there's your eyes. There's your nose. There's the mouth, like right here, and then the chin.
SAGL Shell says concerned by the amount of government intervention in.
I'll have to try and bring that other one over. It looks just like it. Looks just like it. I wonder if it's traded to the downside too. Yeah, we're getting a lot of selling here, guys. See, it catches a bid and then it just quickly drops. And then look, 76. I'm looking down here at the bottom right on the ask, the bid in the ask. And believe it or not, we're only down 0.6%. Just over 0.5%. And here comes the upside. There's a double bottom. right off of that level, scalp along. You could. We just got to watch that trade line. Trade line's curling up. All right, Powell is getting ready to come on. We gotta watch for how, like, what is his demeanor? It's important. It's so important. It's gonna dictate what he's trying to do. Is he trying to talk down the markets, or is he not worried, and is he dovish, going to talk up the markets? It doesn't matter. We just got to read it. You got to see what he says. He's the first thing that he says. It's about a paragraph. It's for a little bit before he takes questions. It's a pre-written statement, just so you guys know. So wait for the questions.
The thing I want folks to focus on is that inflation number in the SEP. They raised from 3.6 to 3.9%. Here we are 3 years past the start of the pandemic. Core inflation is still double their target. I think that is the most important fact to emerge from this.
Do they need to change their target? Is 2 too low? Is 2 too aggressive?
Look, I personally think that a 3% target makes more sense. This committee has been asked that question repeatedly. Powell is emphatic. They are not changing the target. Changing it now would be terrible for the credibility. Right. What's to stop you from raising it again, right? So,
but 3% a year, all of a sudden, you're talking about 10% price hike in the economy every 3 years, basically.
Maybe so, but I don't think you can point to strong empirical evidence that economies perform worse with 3% inflation.
I just don't like it. I don't like the price tag of stuff going up. I like the, that 20 years where it seemed like they went nowhere.
Okay, so like in that case, you're going to like it when Powell gets asked that question, because I'm confident he will give the same answer he always gives, which is we're sticking with 2%. But that just brings me back to my point. A 2% target and a 3.9% inflation rate forecast, there's a cognitive dissonance going on there.
And that's why 9 of them want 2 more hikes minimum, right? Yeah. Because they don't see the lowering that they expected to have been inflicted on inflation so far.
The inflation has been higher for longer than they had anticipated, and the simple message from that is, folks, absent something really unexpected like a banking crisis, we got to do more.
5.6% is probably the biggest jaw dropper so far when that came out of 2. That's now the median place where they sort of think.
Here we go. Ivy League Trading, YouTube.com. Guys, hit the like button. Let's get some more people over here. I am going to look for, what am I looking for here? I want to read Powell. I want to get a bounce back. I want to see where we go to, like, as far as yesterday's low in
Fed Chair Powell begins the press conference.
Yeah, so this level right here, guys. Come on, where's it at? Let's go. Here he is. Here he is, gang. There's the man. Let's go. Good luck, gang. Good luck. I'll go over it as he goes through. I'll interpret it for you.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed.
Again, this is pre-written.
Back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy.
We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy...
Oh, no shit, bro. Yeah, that's probably a hedge, though, bro. They might have 800,000 on calls. That's the thing. Don't just look at it one way. There's two sides of trades, especially with 400,000 on 475 calls, especially. I don't know what the dates are for those, but and are they buying or selling them? Someone put 400 on 75 calls. Yeah, I don't know the date for those, and you just gotta watch because there's probably a reason for it. They're probably short, like twice as much, and it's a hedge.
Picked up this year. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
So right now he seems pretty dovish. He's pretty dovish. So the market might go up a little bit. We might get a bounce, but not that he's dovish, but he's calm. He's in a good mood. Like, look, what did I say? As soon as I say it, the market starts going up.
The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years.
Again, it's going to be important when the questions are asked, okay? Have your marks, have your levels, what's resistance for the downside, and what's support for the upside, okay?
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year.
It's important what he says, like their projection. Doesn't mean that that's going to happen.
Well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic.
If there was something to short, and if it's going to go down, this is the place. Your risk to reward here is beautiful. So if it breaks it, okay, you stop out real quick. If not, it rolls over. But I don't know if it's going to roll over because of AI and all. But yeah, the risk to reward there on AI is beautiful. You know, if you think you're long, okay, if you want to be long AMD, I don't want to talk over Powell, but you could technically still come back down here to put in a double bottom. If you're short and you can't get and hold above VWAP, like this is your stop. This is what I'm getting at. Your risk to reward.
Half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust.
Now I'm looking for the rejection. I'm looking for the rejection.
We will continue to make our decisions.
Just wait. This could be a shakeout for questions. Again, guys, wait for the question. This is pre-written, and this pre-written statement has already been released.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you
and Financial Times, they were the ones with that bank.
counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this.
So he's explaining why now.
Of that process.
Right. See, he just explained why they're pausing. It's just slowly doing it.
Policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables.
So he makes a good point there. This is why they're the best. This is why they do. This is why they are who they are.
I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not.
So we know where they want to be. The market's going to price it in 5 to 5.5. That's it.
Or really any other approach.
Anything over 5.5, I don't see it. 5 3/4 even. So 5, 5.5. That's it. That's where they want to be.
Sense of the initial support at this stage for that move.
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Kind of hitting. We might get 25 in July. I think we might get 25 in July if everything stays the same.
The narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there.
Time, my guy.
It's not coming down
Time. It's not. It's starting to, and it's coming down slow. I don't know about that.
The data came in, I would say, consistent with, but on the high side.
There's our resistance. Keep these levels up, guys.
The former SEP.
This could be a double bottom failed breakout. So if we come back down, test this flag here. Let me move this over.
Estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates.
We come back down to this level of 434, and it holds. I might take a long, like a scalp. I might.
More restraint will be necessary than we had thought at the last meeting. So, although
Shit, I didn't know I had 3 minutes on.
the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator.
I am really curious what we do at this, at today's low. All right, do we reclaim it? What do we do?
They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue.
He's dovish, so I want to get the bounce backs, though. I want to bounce back.
Housing services inflation.
I want to pull back, I mean.
That's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time.
And listen, it could take one sentence out of that man's mouth for this market to flip.
Inflation coming down this year will contain a big dose of,
So if you're green, take it.
Contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs.
We're at VWAP. Does it reject? All right, I want to be long here. If we're gonna go higher, I want to come back down and hold.
Loosening in labor market conditions, which we have seen. We have actually seen. I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
So I think he's told us that we're probably going to get a rate hike in July. He just told you why, Nick. Apparently the Wall Street Journal doesn't fucking pay attention. Are you serious?
16 of your colleagues put down a higher year-end 23 rate today. A majority
majority of you think you're going to have to go up by 50 basis points this
Did
year.
I mean? Was it just me, or did you guys not catch it also?
I would say that the question of speed is a separate question from the question from that of level. Okay?
You know,
and I think if you look at the
he explained why in the beginning.
It's really accumulation of our individual estimates of how far to go. I mentioned how.
I think the Wall Street Journal should fire him and let me take his place. And see, he just said it. He said he already talked about it.
And according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting.
He just embarrassed the Wall Street Journal. That's crazy that he would ask that question. Or if somebody called him or texted him to ask that question. Like, he's doing it, they're coming out of restrictive policy slow. They're doing it slow. Like, they went from 75 to 50 to 50 to 25, and then from 25 to pausing, maybe have a little bit, or have a rate hike, pause, have another rate hike. Like, time. It's about time.
But we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
So he must have just said something with that candle. Or it's a shakeout for the shorts. VWAP was resistance, okay? This pink line is VWAP. Where's VWAP line up with? VWAP lines up with the low of the day.
Any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
And we're at 50, okay.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, and marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy is the labor market.
Why would the market go up, guys? Why would the market go up? I want to ask you that. I want you to ask yourself that. Why would the market go up? I'm going to come back in 5 minutes and try and help you answer that. You need to ask yourself, why would the market go up and why would the market go down? Not like thinking about like things that could happen. We're talking about what we have right now in the flesh, in the time. Okay.
We always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today, and as the data come in.
Okay, see if we hold this. I might take a long here.
But it really will be.
Dude, actually, there's no way. If you guys are playing dailies, please be careful. Okay, the 440s are trading at 15 cents, but like the 437s are at 80 some cents.
You had said back at the end of May that you thought were getting closer to being into balance. Is that
I guess that's not too bad.
Has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Is obviously the current rate?
Oh, come on, Steve. You know what it is. It's 5 to 5.5.
Sufficiently restrictive. Thank you.
I would say again that I think that over time, the balance of risks as we've moved from from
Look at the VIX. It just fell off a cliff.
5 percentage points with an SEP calling for
Hello, upside.
We've moved much closer to our destination.
But keep in mind, we're going to have a rate hike next month. If everything stays the same, I think we get a rate hike next month.
The risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. If you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And
there you go, guys. Look, you just turned that into resistance. This is why I say take profit. Doesn't mean we're going to come down, but you got to take profit, guys. That was support. Now it's resistance.
Much of the tightening took place over
Because I think the market's going to start pricing in 2 more rate hikes until something happens. There's the sellers again. But where can we pick up a buy possibly? Like I said, I'm still in the camp for a buy down here. If I'm going to take a scalp long, I want it where I want it. I don't work for the market. The market works for me. I went along there. If we can't hold it, I'm going to be shorting the market. Okay, that is a failed break attempt back up above VWAP is what that is. If this does not hold.
Come into effect that would inform your decisions. Have you learned things over the past year that give you some sense of timeline for when to expect the flags to come into effect?
If we get small, like light volume down here, this could be a cup and handle. Kinda. Not really, because of this. This is what's messing me up. But instinctively, you get a light pullback to like here, 434, then you could get a big long. Could put on a nice long there and get up to high a day. But again, I'm not.
Policies had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than
There is some buying there, that's for sure. But there's also some selling along with it. Because you got to think, like, if you look at the candles, like look at this candle, okay? It's green, but the candle's green, but the thing is the people that were short, look at the tail. So this is all selling, and then you just had one last minute of buying, So it's because there's support there. Now, do we turn the opening day into resistance and VWAP? We might stay flat, guys. We might just stay flat.
To go at a slightly more moderate pace now as we seek that ultimate.
So the destination is almost over with interest rate hikes, and then give it time.
Data point. I think we'll see it when we see inflation. Really.
I can, pal. We show the members here. We show the members the data that we look at.
And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents for March, and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean, and that's something we're going to be watching, of course. And if we were to see what we would view.
I want to know about the balance sheet. I don't even think the Fed knows what they're going to do with the balance sheet. If nobody asks the important questions, then I will just go try and search for it myself.
That's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question. why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or I mean, it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so we've remember we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently.
I would say a year, my guy. I would actually say a year, maybe a year and a half, actually, not 2.25.
Typically forecasted that it would.
Been a lot sooner than that.
So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to.
Market doesn't know what it wants to do, guys. Look, it's just sitting at VWAP. I told you we could get this type of day, guys, where we just sit where we open. It's priced it in. Not sure how much upside we have. Haven't gotten an interest rate hike, so yeah, there's one sitting on the table for next month, but we're not getting towards next month. We still have a couple weeks for that.
You mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be important. An important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2%.
This area could be a nice resistance. I'm actually going to grab a put because the risk to reward is worth it. I got to get some puts. I got to get a put.
The finding of the Bernanke
And put her down.
Paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in.
No, I'm going to take profits on these whenever I get them. If I get them.
Inflation down, you reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November,
then we're getting a rate hike. This guy's from Bloomberg. This guy's from Bloomberg.
Movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what
it is. He's telling the market, hey, we're going to do.
And we'll just have to see. I think you'll see the data. You'll hear Fed people talking about it, and markets will have to make a judgment.
See, I tell you guys that. You got to be able to find and try and watch these Fed meetings that are live. A lot of them are on Bloomberg Terminal, and you can't really get them on the internet and stuff. It's hard, but it sucks. But maybe there's a place you can go to that has it.
Point you to the forecast. So inflation is running core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. You know, we do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking?
There we go. I knew it. My girl. Thank you. That's what we need, baby. Right on time. Let's go. That's going to get these puts going, if anything.
Also, are you considering lowering the RRP rate?
Finally, somebody says it. The balance sheet.
Let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plan.
Weirdly, I thought it was coming because of where we are right here. We're putting in a double top. Like I have my order up. I haven't clicked it yet for my puts.
So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both the reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be.
They don't know.
Which will be greater.
I don't think they know.
Starting at a very high level of reserves and still elevated RRP to take up for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year.
So they're going to wait.
That's the
Treasury part of it, but
we will of course continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah, the Fed balance sheet.
Are you considering lowering the RRP rate?
RRP, yes.
So we have a number of. I would say the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think
It has been. I've showed you guys that. It's shrinking slowly, though.
over time. It doesn't.
And what are you going to do? Just keep it there? Just let them run off at one time? Like.
If we want to use it, we can. There are other.
Oh, so they're not going to. Market might go up on that. Market might like that. That's liquidity. Weird. So they're not worried about the balance sheet. I had a feeling they weren't worried about it. I had that feeling. They're just going to keep it up. But what happens when those securities get to maturity? Like, are they just all going to run off and get reinvested or not? They need to think about that.
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit.
We're struggling up here, guys. This is where I got this area. You see how we're just wicking it and we're having trouble up here? We kind of have
house prices filtering into
like a bearish pattern here, believe it or not. Kinda.
I don't see them coming up quickly. I do see them
All right.
kind of wandering around at a relatively low level now, and that's appropriate.
It's an ascending wedge.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it.
So it looks like we might just creep higher.
So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects.
So we've pretty much recovered it, guys.
In 10 years, the CBO
We've pretty much recovered the downside meeting.
Do you talk
We have a Fed rate hike on the table, though, so do not forget that. I think we get one next month.
Handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really
I'm in the 25 basis point camp next month if nothing has changed. Inflation continues to come down the way it's been coming down, blah 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 blah. I think we get another rate hike, and that could help us get some downside. But until then, gotta go long. Like, we've already taken back this whole downside move. We've taken back the note or the FOMC, whatchamacallit,
inappropriate given our independence and our need to stick to
the release, I guess you want to call it. And look, now or this is our retest of the head and shoulder. But I think we're going to sit here. You might get a pullback here. Should get a pullback here, and we'll come back, test this area 437, maybe. Maybe.
GDP for this year was raised significantly. Your forecast for GDP this year, the unemployment rate, meanwhile, was pulled downward. And so, should we take that as a sign that the committee is more confident about the prospects of a soft landing? At least.
Great job, bro. I was kind of unsure what I wanted to do. I kind of just. It's a little hard trying to be on here, clicking to find the screen, getting the stuff, listen to them, blah blah blah. When usually, when I wasn't on YouTube, I would just sit here, I'd be listening, I got my levels, boom, throwing, I just would scalp it. But we're getting a rate hike next month. Mark my word. If nothing changes, we're getting a rate hike next month. You heard it here first, so no matter what you hear from now until then, I don't know if you watch CNBC or Bloomberg or anything, you're going to hear them all talk and see the sentiment as we get into July, and you're going to be like, they're all going to be wondering, like, that's going to be the question that the news outlets are going to say, are we getting 25? They're going to go to the Fed funds rate. I'm telling you right now, if we're still the same, we're getting 25 basis points next month.
To get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's
Watch for this area to become support.
Families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, since we're probably going to we're having real rates that are going to have to be meaningfully positive. And significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie.
That was key there. So, God damn it, why have, that's what I was going to say, guys. Why have they not priced in a rate cut this year? Because they know it's not enough time for the unemployment rate to get to a point where they got to worry about it and lower interest rates. The more you know. Watch this area. My computer, I think, was trying to freeze on me. So, just, God damn it.
across.
Like I said, gang, if you guys were doing things, just make sure you're taking profit. Just scalp them. And listen, you see these moves here? You can buy 1, 2, 3, 4, 5 like, I don't know what your position size is, but keep it small, and you can still get a nice move, and you know. But you want to have a reason why you're doing the trade.
Near historic lows, historic modern lows here. So
I still can't necessarily.
I mean,
I need a test of this area to go long.
A half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming, or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's...
Oh, sorry, I didn't know the mic was on Eaton. I don't know why the market is going up when we're getting a rate hike next month. I mean, I don't know. I have no idea. I'm going to have to go through and figure some of it out. But it looks like we're going to close and sit right around. What did I tell you guys yesterday? And you could have played this range. I told you guys yesterday. What time is this? 13:58, 13:59, 2 o'clock, the release. Where are we? Right where the release was. We are break even, guys. And I told you this. So all you had to do was just wait for the move, play the opposite direction off of a level. That's it. That's all you had to do. Wait for the move. Okay, now it's easier said than done. I know this, but if this is the whole point of probabilities. We put in a double bottom at this level. It didn't break. You had a nice big tail, some buying. We retested, couldn't break it. That was a signal to go long, at least back to the 2 o'clock meeting or the low of the day, which is right here. So now where do we go? I think we kind of just float between VWAP and in this level. You know, I think it just kind of sits. I really do.
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue.
At all about the labor market and there's strikes now, and now the United Auto Workers are talking about
I don't know what happened. I'm sorry, guys. Well, I know what happened. I accidentally clicked X. I clicked out of it by accident. What did I say I wanted? I wanted to be a buyer here, guys. This is why it pays to be patient.
Utterly central. It's half of our mandate. So we spend a lot of time talking about that. I think, there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about that, about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk, now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically...
Premium is going to start getting eaten, so watch yourself. You only got 45 minutes left. So for every 5-10 minutes you get, theta's going to eat at it. So just be careful.
So, we're trying to think where to start. I'll start with commercial real estate. We, of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's, do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool is it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering.
I want to see if we can reject here. Oh, Powell, we need more of you. We don't get you that often, bro. So it was a good meeting. We're getting 25 next week is what I got out of it. Not next week, but next month. That's what I got. If we're still the same, we're getting 25 next month. Hello, might get a little more downside, gang. That means treasuries go up, TLT comes down, SPY and M comes down. That's the gist of it. We're taking it back. What I say, man, I told you guys. I didn't know if anybody was on here. I had my little circle. I said, yo, wait for the pullback. Scalp it long. What happened? Mother sucker did just that, bro. What up? That's all it takes is one trade, bro. That's it. I try and tell y'all. Right there. That's the target. I don't give a shit what it's doing. Now, if it extends to new highs, then yeah, I'm going to have to take that little circle and just remove it. Alright? We're going to act like we didn't even put that there. But until it's in the range, that's where I'm a buyer. And then guess what? I'm a seller. Right there. Unless it breaks. Because my risk to reward. Even if I'm right, even if I'm wrong. You know, I'm not instinctively. I think we might go up. But the market's just. How does the market react to tonight knowing we're going to get 25 next week? The real ones know. The real one knows. The real ones, I should say, took what Jerome Powell said and he fed us the information that we need to know that the market's going to take. And I couldn't believe the guy from Wall Street Journal asked that question. Why would you do this? Why would you raise interest rates in July? What? Bro, he just explained why. He explained why they would do that. It goes along with policy. And taking the policy and slow, you know, he mentioned they started with 75 basis points. They went to 50. Then from 50, they went to 25. And then from 25, they're going to pause, possibly do a 25, and fade it out. Okay? They attacked it quick, and they're going to fade it out. Okay? So we're getting 25, I think. As long as nothing has changed, we still have 2 more rate hikes I think we're going to get. We're going to be at 5.5. 5.5. I think right now we're about 5%. We're at 5% right now. 5 point something. I'll have to look. But so that's that. All right. I'm thinking. I don't know if the market prices in this rate hike just yet. I don't know. If it cannot hold this, and it starts trying to extend to the downside, we have 40 minutes left. We got to see. We just got to wait and see, guys. That's all. Don't be in a rush. There's always Adobe has earnings tomorrow. Like, there's all kinds of things to do and ways to make money. So, just like I said, I don't know. That's all. That's all I got for right now. I got to go get something to drink. Oh, it's my guy, Jeffrey Gunlock. Shit. I forgot they were having him on.
Maybe I'm just a mathematician or something, but I see a trend here.
I do too, Jeff. He did tweet that out, but we're getting 25.
I'll stop and you can probe further. One thing about I almost feel when every meeting you knew they weren't going to raise rates. I think it was universally believed that this would be a pause and that this would be a hawkish statement to try to offset the complication of having a financial stress with conditions tightening and 3 bank failures while inflation.
See if Gunlock picked up on this.
But I don't know if many were expecting the idea of 2 more rate hikes before they're all said and done. Steve Leisman's made his way, Jeffrey, out of the room. Let me bring him in if I can quickly. And Steve, you seemed genuinely surprised when this statement came out.
So Jeffrey Gunlock is he's from Buffalo, but he runs Double Line Capital, as you can see in the back. Double Line Capital. Look it up on YouTube. There's a lot of stuff on there. If you want to get like some education and kind of get what's the mindset of the big money, and I mean big money. Big money.
They're probably going to do 1, maybe 2 more. And that what I think happened in the intermeeting period, and the reason I asked the question I asked is, I wanted to know, did Powell change from the way he sounded in a more dovish way at the end of May? And I think he did. I think he went in there to herd cats and ended up becoming one of the hawks, if I could mix a couple metaphors.
He's not hawkish. See, this is why you don't want to watch TV. None of this is going to do anything for you. No, he stated why they paused. They paused because they want to go. They went fast into it, and they gradually want to get out of it.
That the risks to inflation are to the upside still. So we don't think we're there with inflation yet because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going.
And just getting on a theme that Jeff
I feel like the market doesn't know what to do, but it knows what it should do. It's not going higher. We need to go down lower. I might get some 430s for the end of the week. Wait, today's what? Wednesday, and we're going in tonight. Maybe I'll wait and get them in the morning because you'll have theta just getting you. But I want some puts. Because I don't know if the market has priced in 2 more rate hikes that we're going to get.
Again, I think they're making the reverse mistake that they made about a year and a half ago, a year and a quarter ago, where they were too slow to raise rates because they're looking at lagging data. Employment is lagging data. We already see some signs.
Yes, he's right. Lagging data, exactly.
Let's look at the inflation.
Jeff, can I just stipulate? I'm not saying they are not making a mistake. I'm just saying that I think they mean to do it. You might be 100% right that it's a mistake.
Steve, I think you and I agree more than you realize on the kind of the messaging here. The Fed, I agree with you completely that the pause, obviously, is more dovish than if they had hiked, obviously. And I agree with you that there were people in the room. I mean, there's somebody there's one of those dots that's up above 5% for years to come. So one way that you heard the cats is you actually do a dovish thing. You do the most gentle, non-hike, the most gentle actual...
If you don't know what the dot plots are, I showed you guys, that's the dot plots where all the Fed puts where they want the Fed rates to be. But you don't know who it is.
The Fed funds rate would be at 50 to 75 basis points at the end of this year as of 2 years ago today. So talk is cheap. So let's look at the inflation data. The BCOM, the commodity index, has been below its 200-day moving average for a long time and is barely off its low of the year. Let's look at the PPI that came out. It's 1% year over year. The core PPI is 2.8% year over year. The CPI is at 4, but the number that's rolling off from a year ago come the next report is 1.2. And we expect maybe it's going to be around 0.2 like it's been registering lately. That means the headline inflation rate is going to be in the low 3s in a month. So they're looking at the core rate, but the core rate is always lagging the high frequency indicators. And so lastly, import prices and export prices, which are my favorite high frequency inflation indicators, they were up at 15, 18% a year or more ago, and they're now negative 5 and 6% year over year. And those are my favorite numbers because they're real numbers. They're not adjusted. They don't take in all these substitutions. They're not seasonally adjusted. So I just think that we're looking at a environment where we're talking about an inflation rate and I'm talking headline CPI here, that's going to be in the
10-minute rig, gang. 10-minute rig. Oh no, it's only 3. Why did I think it was 350? Oh my gosh, I'm sorry.
So the Fed funds rate, if they actually do those 2 hikes, is going to be incredibly restrictive. It's going to be a negative 200 basis point type it's going to be a 200 basis point real rate. 575 or so on the Fed and 375 on the inflation rate. So I don't believe the Fed's going to raise rates again. I think Jay Powell has a really difficult job right now because, as Steve is correctly pointing out, I think he realizes that we're at a turning point potentially on the inflation situation and on the economy, and yet there are people that are dedicated to these lagging indicators like employment, labor market, and certainly looking at core CPI. Well, it lags. It just does. So I think the used car thing, which is part of the CPI problem, stickiness we have, I think that's going to ease, and shelter is there. So that's going to be, I think, the last man standing on inflation. But I think the Fed is overstating the inflation risk at this time when you look at all of the more high-frequency indicators. I'm sorry to go on so long, but I think it's a very important point.
No, it is a good one. And Steve, before I let you go, it's kind of why Rick Santelli as well suggested that this is kind of bluster more than substance. And I don't think he believes that they'll necessarily do what they suggest they might either. How would you respond to that?
I don't have a big argument with what Jeff is saying because I think fundamentally you count on the Federal Reserve to at least follow the data in front of them. And by the time July rolls around, we talked about this morning, this idea that the big June number, that 1.2% inflation from June 2022 rolls off and plunges.
I'm watching to see if we close lower, gang. I want to see if we close lower.
In July, especially if they get some cooperation.
Yeah, man. You take care, buddy.
Yes, if the data does turn, then in fact maybe they'll pause again. But I just need to. I don't know enough right now to gauge the strength of the commitment of members of the committee. If you look at it, there were 9 members at 2 hikes or more, and I believe the total is 12 who are at 2 hikes or more. That's 2/3 of the committee, and that's where they are right now. Maybe they're playing a game here. I don't know, but I guess my initial inclination is to take them at the word that they mean to hike, and I will watch the data. If Jeffrey's right and the data erodes in front of them and takes their case away for hiking, then they won't do it.
Yep. Steve, I appreciate it. Great stuff, as always.
Pleasure.
That's Steve Leisman, our senior economics.
Absolutely, Steve. Finally, you're finally getting it after all that.
That the Fed's going to hike 1 or 2 more times, but one in which they would cut because you think the economy is much weaker than they want to believe, and that inflation's coming down much faster than they're willing to admit.
Well, I think that I think the Fed will cut rates if the unemployment rate goes up to what they forecast. I mean, it's really fascinating that the Fed is forecasting a recession in their dot plot. People are acting like they've upgraded things, but they're still talking about an unemployment rate that's basically about 75 to 100 basis points higher than what the trough was. And historically, when you get an unemployment rate that goes up by 50 basis points off of its trough, you have never failed to have a recession. And usually it ends up going up by 200 basis points or more. And I think that's what's in prospect here. So yeah, I think they're clinging on to the core inflation data, which is I think kind of misleading. It's pretty random when you think about it. All the slicing and dicing of inflation data, where you take the headline number and then you strip out food, then you strip out energy, and you strip out shelter. I mean, you end up talking about like really contrived aspects of prices. I'm going to say one more time because it's really important. Look at commodity prices. Commodity prices are just dead in the water. We keep getting OPEC cuts, or at least stated. Who knows if they're really cutting? But rhetorically, maybe they're like the Fed. They say they're going to cut, or in this case, they say they're going to cut production, not raise rates. But they maybe don't cut production. But oil prices just don't really go up. we see persistent weakness. And so that's just a telltale of coming lower inflation. So I really believe, as we talked about 9 months ago, Judge, that I think Treasury yields peaked last year, not on the short end, of course, but even they're down substantially. On the 2-year Treasury, it was above 5. Sure, it's up at about 4 3/4, but it's below where it was before 6 months ago or so, or last meeting anyway. And the 10-year Treasury hasn't seen 4 in a long time. It's range bound, but it's not going anywhere. I think that if the Fed follows the path that they're talking about, I think Steve Leisman is right. Maybe their intention is to break something, but if they do that, they are going to break something. And we already see lending conditions getting much tighter in these surveys of lending officers at major institutions. They've been tightening credit conditions for a long time, and that leads to a credit starvation for the engine of this economy, particularly for small businesses. So I just think that, again, just to repeat, the Fed was way too slow in raising interest rates. Back when they started, I somewhat facetiously, but I really did mean it in my bones, I said they should raise rates 200.
Wonder where he's at, because wherever he's at, it's definitely popping off. He's at like a restaurant, bar, or something.
And that led to this banking crisis at the regional banking level with 3 banking failures.
I'm actually gonna send out an email to Jeffrey Gunlock, and if you're watching this, Jeffrey Gunlock, which you probably aren't, because I ain't that big in the game, I'm gonna send an email, see if I can't get a job working for them.
Who's going to keep deposits at banks that are paying almost no interest rates at all when you could get, under that scenario, 5 3/4 rolling T-bills?
Well, what would you say to the pushback to the idea that they've over-tightened, to the fact that we're talking about a stock market that is in the midst of a pretty strong rally? Some would suggest is in a new bull market. So, and yields have not exploded higher either. So couldn't you see how they could look at all of that and say we haven't done nearly enough? I know that labor is a lagging indicator, but nonetheless it's still strong enough at this point, and certainly stronger than they expected to be at this point, that they would say there's the evidence, all you need, all those 3 metrics, that we haven't done enough.
Well, if you want to talk about the stock market, I think you've got to divide it into sectors. You've got the S&P 7, which is the mania craze regarding anything. If you say AI, your stock goes up 20%. And then you've got the S&P 493, which have gotten a little bit of tailwind lately, but as of a few weeks ago, were basically unchanged year to date. So the stock market, frankly, is exhibiting signs of a mania, where you have a very concentrated part of the market that is driving the entire train. And it leads to a valuation which is pretty scary, with an inverted yield curve and the Fed raising interest rates, or saying they're going to raise them further. The S&P 500 is a PE of 19 on a forward earnings basis. And if the economy weakens or goes into recession, those forward earnings are greatly exaggerated. And so the S&P 500 is really overvalued because, you've got NVIDIA is up over 400% year to date. I'm going to say that's a lot. And so there's stocks like that that are leading the train. This is feeling a lot like the lead up into January 4th of 2022 in terms of the action of the S&P 500. So I think that there's been a lot of, there were a lot of shorts. There was a lot of pessimism. We've had the type of retracement that one would expect. To call this a new bull market, I think, is really pushing it, with the S&P 500 at 19 times forward earnings.
I mean, I'm just going off what, technically they suggest 20% off of the low is a bull market. We've been having debates almost every day on this network as to whether it is really a bull market or not.
So you're telling me Pac West stock is in a bull market?
Your point is well made. So in this environment, then, you obviously don't like risk assets. If you think that the stock market is in, at least part of it is in what you're describing to be, I don't want to use, you didn't use the word bubble, but it sounds like you're describing something like that in a certain part of the market. What do you like here and now?
Again, I haven't really changed my game plan for about a year and a half, maybe even coming on a 1 3/4, and that is systematic upgrading in fixed income portfolios. this is the perfect time to do that because we've had, with the stock market going up, a pretty nice rebound and a bid that was completely absent a few months ago, even in triple C assets, which are doing well in the junk bond market. But I think this is the time you want to have a barbelled portfolio with some risk assets, primarily in bonds. In the past, we spoke, Scott, of a 30-60-10 type of portfolio, stocks 30, bonds 60, and then something like gold, maybe 10%. That's just a proxy for some sort of real asset. Take your pick, your real asset of choice. But now I think you should be 20% stocks, 60% bonds, and 20% in that real asset. The fixed income market is very cheap compared to the stock market. I've talked about this. You can get 5% in a very high-grade bond portfolio with no default risk. You can get 8, 9, 10% in a well-positioned, actively managed fixed income portfolio that is taking middle part of the capital structure. At this juncture, triple C, I don't like at all. You know, even single B, I think is starting to be something you might want to upgrade in away from higher up. You can get all these yields, and you have all this upside. What people don't understand is thanks to the fact that rates went up a lot, and the fact that spreads on risk assets and bonds are somewhat elevated. They're down from where they were, but they're at about 450 basis points. I mean, you're talking about prices that have went from 100 on these credit bonds down to 80, 70, 60, 50 because of those rate increases and some of the fears. When you buy risky credit or moderately risky credit in fixed income at a price of 100, you've got a really bad proposition because they can't go up very much. If the prices go up, they'll just refinance them because the prices going up means that they can do new issue bonds at lower yields. And so they'll refinance them and they'll take your coupon away. But and you have all that downside. If you're start out at 100, you can go to 80, 70, 60, 50, which is what happened. But if you start out with a portfolio of bonds at 60 or 65 cents on the dollar, you've got 50% upside to par. You have stock market like upside, maybe even I would argue even greater upside than the stock market from these valuations, and the downside can't be any worse. Stocks can easily drop 50%. We've seen it so many times in my career, and the bonds aren't going down to 32.5 unless there's a massive default problem. If there's a massive default problem, stocks are going down more than 50% because they're junior in the capital structure. So fixed income right now, it has 4 times the payout of the stock market if you do this kind of barbell I'm talking about, and you can hedge it with treasuries because long bonds are not at 1% or 2%. 10-year treasury is up near 4%, and it could very easily fall to 2% in the wrong type of economic environment for stocks or risky assets. That's a 20% gain plus coupon. The long bond could give you a 40% gain plus coupon. That can offset your risk. This is an exciting time for the fixed income risk parity, if you want to call it that trade, because we're back where we were in 2012 or so, where you can get yields and you can risk manage very, very precisely.
And you still like the longer end of the Treasury curve rather than the shorter end, where you've got yields at 5% in some cases?
You do a mix there. I don't think you want nothing but long bonds. So you can take short-term, medium-grade sort of credit and asset-backed securities that amortize very quickly. So you don't have to really worry about it because they're paying you back very quickly. The job really is to keep invested because you're getting so much payback. Those are up at around 6.5%. And then you can marry them up, and you can do that in other areas of the bond market too. But we're talking about short-term assets. So you're getting the benefit of the pricing, the base pricing off the inverted yield curve. But the long-term bonds, they can go up in price. Sure, the yields are only around 4%. But whatever, you're not really talking about yield here. You're talking about a risk management vehicle. So you end up having a portfolio that can yield in a low-risk sense. You can have a yield of around 6%. And in a high-risk sense, it can be double digits. But you're going to have to deal with the volatility there if you want to take that kind of income stream. So that's where I am, Scott. I've been here for a while. I'm just getting more vehement about it.
Yeah. What about emerging markets? Are you still there too?
Well, emerging markets have been very volatile, and emerging market currencies have really not gotten into the gear on the upside the way, say, the euro has. But I think emerging market stocks over the past 6 months or so, since November anyway, they're up 20% on the EEM ETF. And that's actually more than the S&P 500. They've been challenged more.
I was just talking about EEM, guys. I was bringing that up.
But as a long-term play, I really think you should own emerging markets on a kind of a dollar cost averaging basis from this point. Not China, but Southeast Asia, Central America, South America, excluding a couple of basket case countries that seem to always default. And then India, of course. India has a very, very bright future, I think, over the next 2 decades, call it. And so that's a sort of a core holding.
You're obviously, quite critical today of the Fed in some respects, but I want, before I let you go, to sort of look at all this in total, because we've done 10 straight rate hikes before today. We've done 500 basis points in a little more than a year. We have a stock market that, as of today, has hung in there pretty well. An economy, yes, it might be weakening, and the LEIs that you suggest are weaker, are obviously such. But nonetheless, we have not had the recession that so many have called for or thought would be here by this time at minimum. Can you assess Jay Powell's job and that of the Fed in saying that they've done actually a good job to this point to be where we are with what they've done and have those things that I just told you we do?
I think that they started out a year and a quarter ago doing a terrible job. We talked about that all through 2022 until about, I don't know, maybe it was November meeting or it was December meeting, where I said, I really feel like he's found his footing. Jay Powell has got himself in the right place. And I think they're still okay. I think where they are right now is okay, but if he follows that rhetoric, that hawkish rhetoric, I think he's going to make a mistake. And so I think he's walking on eggshells here. He's got a lot of cats to herd. He's done a good job. If he stops, if he doesn't hike rates and starts looking at high frequency data, I think he can go back to kind of that spot where he was, where I was complimentary of him, Scott. You'll remember that. I'm not always critical of the Fed. I'm not a big fan of the Fed as a mechanism, but I think Jay Powell started out badly a year and a half ago and got himself to a good place. But the hardest thing to do in the investment business, and I'm sure for the Fed, is after you've gotten yourself to a good place, if you see storm clouds coming around the actions that got you that good place, you got to make changes. And one of the hardest things to do in the investment business is to make changes after you've done well, because it's just such a good friend of yours. It's gone well. I've got this in the portfolio. I feel economically I've benefited, psychically I've benefited. But the hardest thing to do is to change. And so when I bought European stocks about a year and a half ago, it felt really, really weird. I was losing my old friend of being totally out of the European stock market, but it's been a good place to be over that time period. So it's hard to do, but I hope Jay has the courage to do it.
Jeffrey, I appreciate it as always, and we look forward to visiting with you every Fed Day, and I know our viewers do as well. Thank you so much.
Tell your viewers to look up Buffalo AKG Art Museum and go to the images and try not to say, wow, we just opened it this week.
I seen that, Jeffrey.
Jeffrey, thank you.
Thanks a lot, Judge.
All right, that's Jeffrey Gunlock joining us from Double Line once again. We're now in the closing bell. Market Zone, New Edge Wealth's Cameron Dawson.
Read and react. That's all you gotta do. Read and react. You couldn't stay above. We're gonna get rate hikes next month. Read and react.
What's your takeaway here?
This has been one of the most interesting Fed meetings I've seen in a long time. I think Jeff had it right. Hawkish in the rhetoric, but not in the action. Put up the S&P 500. Immediate reaction, S&P drops 30 points as soon as they say...
Read and react. Read and react. Read and react. How many times do I gotta say it? Read and react. God damn it. Get your goddamn puts. Alright? Told y'all. We're gonna have a down day. Get your goddamn puts. You couldn't hold. Read and react. Oh shit. Yeah, hold on. I want to get like up here or something. I want the 90 EMA to come back down.
One explanation. The other explanation is the market believes that after 500 basis points of rate hikes, it can withstand another 50 basis points. And again, here's the argument. S&P 500, Jeff mentioned this, 19 times forward earnings right now, and it's held up during the day. That is not only not a recessionary multiple, that's an expansionary multiple. And so far, the market's been right on that.
Well, there's a belief, Cameron, that he was, to Bob's point, genuinely, I underscore genuinely, data dependent.
For 36 flat. That's where I want it. For 36 flat. Short side.
Going to continue to work in the favor of the Doves rather than the Hawks.
Well, it's interesting in that context because you're actually seeing economic surprises surge higher, which means that data is coming in better than expected. And I think Jeffrey's comments about data being weak or signs of weakness, a lot of that is either market-based data or soft data. If you look at the hard data, things like instead of looking at PMIs, looking at industrial production, they remain resilient. So you haven't seen enough weakness in the data to really suggest that the Fed needs to make an about-face.
Bob, the other point that, the Bulls have had to contend with as we've wrestled with this idea, who's really in charge of this market now? Have the Bulls gotten it back? Jeff makes the case. Now, obviously, he's the bond king. He's a bond guy.
Yeah.
He's going to make the case in some respects for bonds, as he did. But it is a hurdle to get over that there are other attractive securities to be investing in besides equities still, whether it's cash or fixed income.
I think the real question and the issue for the market, if you want to try to get the market higher, if that's what your goal is all those people who were buying 4.5% one-year treasuries in the middle of March that were flooding the market and pulling money away from the stock market. We are up 500 points on the S&P since the middle of March, and everybody started doing that. 500 points, that's 13%. Are those people who are sitting there saying, I've got a 4% one-year CD and we're up 13% since I pulled all that money out, are they going to be dragged into the market right now? I would make the argument.
Unless they think it's too late, that they missed it, so they're going to stay safe,
The
so to
FOMO
speak.
never dies. Even at the top, FOMO never dies. Now, so let me just go one point about Powell. What's really motivating Powell for being so aggressive, for the group to being so aggressive? And he hinted at what they were really afraid about. He says, forecasters, including the Fed forecasters, have consistently thought inflation was turning down and have been wrong. He says, we have been wrong. It's better to over-tighten than lose credibility. That seems to be what his message is today, and I think that's what's motivating.
Look, he said, Cameron, the risks to inflation are still to the upside. I think it's pretty obvious, too, at this point, that what they thought was going to be restrictive wasn't restrictive enough. If you look at the fact that the labor market, I get the idea that it's a lagging indicator, it's still hung in there pretty well. Stock market's up 20% since the lows.
Well, they seem not to believe their own forecast. They talked about how PCE would go down to 3.9%. And he goes, that's a pretty aggressive forecast given where we stand today. And I think the thing that's interesting is that we're at the same real interest rate that we were prior to the SVB issues, and yet valuations for tech stocks are up 30%, which just means that this rally has had nothing to do with the Fed. The Fed's not been the key source or driver of the upside. It's all been positioning, FOMO, AI optimism.
Gundlach says no more hikes. What does Dawson say?
I think it's still very potential that we could see more hikes. I think that the Fed still has a credibility problem. It's why we thought that they would get to 5.25, that they wanted to make sure that they delivered on what they said they were going to do. So I think that if data continues to be resilient, the big question I have is that if we have a strong jobs data but softer inflation just because of those tough comps year over year, what does the Fed do in July with that combination?
I mean, are they going to go overboard, Bob, trying to save their own credibility, as Cameron kind of suggests?
Yes, that's what he seemed to imply.
Their credibility is more important at this point than doing what's right?
Yes. And remember, square this circle, Cameron. They raised their estimates for GDP, they lower their estimates for unemployment, and they act like something imminent, dangerous is coming. They want to slow down the economy, trying to raise 50 basis points. It seems a little
which is to your point, though, that the market probably doesn't believe it, which is why the S&P went positive momentarily and is only down not even 3.5 points.
Yeah,
because the market still doesn't.
That's my view on the rest of the week. Well, we have Adobe. That is funny because tomorrow, what's tomorrow? Tomorrow's Thursday. What do we get tomorrow? I think we get interest rates for Europe. I'm going to do a video on it tonight. I'm going to do things a little different because I've been watching the videos back like last night and stuff. And if I'm turning it, y'all turning it. So I'm just going to like, maybe this weekend I'll start recording. I want to see where we close. Like, these puts are done for now. I just grabbed some right here. I grabbed some. I scalped them. I took profit. But I just grabbed a couple more right here. I got a little time with it. But this is what I mean. I want to see where we close. I want to see where we close. We're getting a rate hike next month if nothing changes. Nope. Like, I have CNBC on and they just don't want to. They're talking about, like, killing the economy and stuff. No, they want to just gradually get out of this shit. I think we pull back. We need to pull back. I think the market's going to see these rate hikes as, okay, they're not done. It's mixed. I honestly, I don't know yet. Earnings were still good. I mean, honestly, Europe's going to be raising interest rates. Like, we put in a double bottom. So the market's going to start price. This is what the market has to do. The market has to price in not 5%, but 5.5%. Where does 5.5 interest rates put the S&P? Where does it put Apple? Where does it put Microsoft, Nvidia, all the other ones? Where does it put them? I don't know. And then you have AI. So this week, I don't know. These fucking puts, man. I'm not selling them because I think I have some downside left. I think I have some time to get these. So this is the area right here. We're going to find out. We're going to find out tomorrow. Look at that volume, but I still don't trust it, guys. I really don't. I think. Yeah, I know. The fucking thing over here. I know. Look, I'm hoping that we get our pullback. Let's read the price action. Let's see where we open up tomorrow. Because here's what happens. We got to see how the European market takes it. We're going to get another rate hike or two. Europe's going to be doing more. Like, policy is tightening. So, here comes the bell. I want to get this right here. I want to get it. Oh, come on. I want to get this 430 level. I don't know if we get it, man. I think we got some indecision. Look, as long as we keep this as resistance, I'm looking for puts. 437, I'm looking for puts. We break it, we pull back and hold it, then that's a different story. Okay, that's my game plan. All right, sorry it took me forever to get it, but I had to look at the chart. This is what I'm calling resistance right now. So that's what I think. And look, we're gonna fucking break it, you assholes. Fucking futures, man. I'm just gonna cuss and cuss and cuss for no goddamn reason. Alright, well, we broke that. Look, we literally closed flat. Look at the daily chart. We closed flat. Are you kidding me? That's an indecision candle. If I've ever seen one. Oh my god. Fucking Morgan Brennan. Morgan Brennan's who's talking. This broad. Oh, so we did close higher. What? I thought we closed 437 was the level. So 437. So we closed 10 cents higher, 16 cents higher. So I guess we're still bullish. So my puts will be down tomorrow. Alright, I'll see y'all later on tonight. I'm getting off here, go smoke a cigarette, because I'm getting pissed. For no damn reason. It's not like I'm losing any money. I have something small on, but I scalped some puts here. And then once we got here, I grabbed some more, and then it just decides to rip on volume. But again, that all could be taken back tomorrow when we have ECB. European interest rates are tomorrow. Christine Lagarde is her name. So, and then we get the European market, we'll get the China market, we'll get the Australian market. They'll all start pricing in a rate hike. So let's see where we open tomorrow. See where futures are at later on tonight, in the morning. That's it. You guys have a great day. I'm going to see what the hell's going on with this camera. I'm going to make some changes to this channel. Alright. I'm just going to get into like trading, tape, level 2, price action charts. I don't know. I'm going to figure it the fudge out. Thank you guys for joining us. I appreciate it. You have a good one. I will see you guys tonight if I come on, which I will be on. Just how do I do it? Do I go live or do I, I don't know. But I got to make a change. All right. You guys have a great night. I will see you all later tonight. We're going to make it for like, honestly, I'm going to make it for like 8:30ish because I keep staying up late as hell. I don't get to bed till 12:30, 1 o'clock. And then I wake up at 5:30, 6 o'clock, and then I'm sitting here in the chair tired as hell, watching little squares on the screen. So I will post it up here in about, I don't know, give me a half hour, give me an hour, and it'll have the time. So it should be, I'm going to say 8. We're going to say 8, and I'm going to make it 45 minutes. I'm going to write everything down. I'm going to get straight to the point. If you guys have any questions, jot them down, whatever. Thank you guys so much for joining us tonight. Today. You guys have a good afternoon. I'll get into what I think about the markets after I can digest this all. I'm going to go back. I'm going to look at some things and read it because it's a little hard to read it and like try and commentate and then try and make trades at the same goddamn time. So I'm a little hyper because I'm a little frustrated. I had a Red Bull and whatever. So I just didn't like the fact that we closed higher. Well, we have a rate hike decision. Like, I knew the market was going to do this. I knew it. I knew they were going to close it up, but in the morning it might go down. Or, like, we might close lower. Like, we're getting another rate hike next month as long as nothing changes. But that's the principle of the thing. You guys have a great night. I'll see you all in a couple hours. Thank you so much for joining.